Yes, good evening all of you dear students. The new topic is cost of capital. Cost of capital is our new topic. What is this cost of capital? In simple words, cost of capital is the minimum required rate of return that should be earned by the company in order to satisfy its long-term investors. This much return you should earn from the projects to satisfy the investors. That's why in capital budgeting, we usually compare the returns from the projects with what cost of capital. Now in this chapter, we have to understand what is this cost of capital, how it should be calculated component wise and at the end average, and how it should be interpreted. That's what our discussion. Okay. Let me tell you one important point. Financial management is all about estimations, right? In the similar way, here also, this cost of capital is all about estimations. Every chapter is all about estimations mostly. Am I right or wrong? Yes. So, in cost of capital, first let us understand what it exactly means. You see, dear students, if you deposit any amount with you, if you deposit any amount that is with you in a bank, that bank will give you a return for your investment, right or wrong? So you're the investor, you're investing some amount of money in a bank. This is your investment deposit, and in return the banker will give you what? Return. Generally that is simply known as what? Interest return. Am I right? Usually this is interest return. Interest rate, or this interest rate is your return. See dear students, here if interest rate offered by the company is 10% per annum, then this 10% per annum is an interest income to you and it's an interest expenditure to the banker. Since it is accepting deposits, automatically as it is retaining the money which belongs to investors, it has to pay annual compensation which is known as interest. So that interest rate itself is a cost to the banker, right or wrong? It's a cost to the banker and return to the investor. So now the discussion is not about investor, it's about the banker. So the banker is paying cost on its capital, nothing but the amount which is being deposited by investors. So as it is receiving money, as it is carrying the money which belongs to investors, it has to pay cost, and that cost should be expressed in percentage. That is generally expressed in what? Interest rate. In the similar way, how a bank can carry the money which belongs to so many investors? A company can carry the money which belongs to so many investors. What do you say? So it is going to carry the money of equity shareholders. It is going to carry the money which belongs to preference shareholders, which belongs to debenture holders. What do you say? And which belongs to bankers. So it is going to hold the money which belongs to so many types of investors. For everyone, it has to pay annual cost. For equity shareholders, the company will pay equity dividend. Am I right? This is a cost to the company. For preference shareholders, it will pay what? Preference dividend. It's a cost to the company. For debt holders and bankers, it has to pay interest. Am I right? That's a cost to the company. So this company is paying cost to the investors, and that's a return to the investors, simply speaking. And this particular cost, equity dividend, preference dividend, interest cost to the investors, should be expressed as a percentage on per annum basis, and that too it should be estimated at the beginning of the year itself. At the beginning of a year, every year at the beginning of the year, we have to calculate this cost of capital. So here the company is carrying the capital, right or wrong? So on this capital, the company should calculate what? Cost on its capital. That's what the chapter name, cost of capital. Since the capital which is being carried by the company attracts some cost, it has to pay cost, but on different sources it is paying different cost based on the risk taken by the investors. Basically, equity shareholders will expect more return because they are going to take total risk of the company. Preference shareholders will take moderate risk, so they'll expect reasonable return from the company, whereas the debt holders won't take any kind of risk. They will expect least return from the company in the form of interest. So here every cost should be expressed as a percentage. So now, my dear students, whatever the cost you're calculating, that should be calculated on capital only. That should be calculated at the beginning of each year. So it's an estimation. Remember that. Okay. So my dear students, this capital, the chapter name is cost of capital. So we have to calculate cost on our capital being held by the company. This capital is classified into different sources held by different types of investors, which is known as equity share capital, reserves and surplus, preference share capital, debentures, bonds, and loans, long-term loans. Got it? All of these sources together will call it as LTD, long-term debt. The company has to pay cost on all these sources. So it should estimate cost at the beginning of the year itself with respect to all of the sources. So it should calculate cost on its equity, which is known as cost of equity, KE. So this cost of equity should be expressed as a percentage that should be calculated on per annum basis, per year basis, and it should be expressed as it should be denoted with KE. Okay. And reserves and surplus, on reserves and surplus the company will pay nothing. It belongs to equity shareholders only. Any cost is applicable to equity share capital, the same cost is applicable to reserves and surplus also, KR. Usually KR and KE are equal, subject to some adjustments. Okay. And we have to calculate preference share capital cost of preference share capital, KP. And we have to calculate cost of debentures, bonds and long-term debts, which is simply known as cost of debt, KD. But usually we'll calculate all the sources cost separately based on the nature of the instrument, because the commitments being offered by company for all its debt instruments changes from one type of instrument to another type of instrument. Cost of redeemable debentures cost is one type, and whereas cost of convertible debentures cost is another type. Basically it is all coming under what? Cost of debt only, KD. Are you getting? So now I have to calculate KE, KR, KP and KD from all the sources at the beginning of the year itself, and on percentage basis that should be expressed as a percentage. Okay. And once we're done with these computations, if you're done with these computations, take the average of all these sources, because my job is to calculate average cost on my total capital that I have raised from the investors. Okay. Take the average plus. If I take divide by 4, if I do like this, it will be a simple average. That's not good. Then what I should do? Simple average cannot represent the cost of whole capital, because the amounts of each source that we are using in the company changes, right or wrong? I can use more equity and less debt, or I may use more debt and less equity. So I should consider those amounts also. So the appropriate average cost will be weighted average cost of capital. What's that? Weighted average cost of capital. That's what I need to calculate. WACC, which is known as KO, overall cost of capital, or weighted average cost of capital. WACC means weighted. So instead of taking simple average, you have to take weighted average cost of capital. And this KO is also known as overall cost of capital. What is this, my dear students? Overall cost of capital. Are you getting? Yes. This is what you need to do. The chapter's objective is to calculate cost of capital, which is nothing but weighted average cost of capital or overall cost of capital. For calculating weighted average cost of capital, first I should calculate cost of debt, cost of preference share capital, cost of equity and cost of reserves. So I'll start with debt cost, then I'll move to preference and then equity and reserves. Once that is over, I'll straight away move to what calculation of weighted average cost of capital. With that, this chapter will be over. My dear students, let me tell you one important point. This chapter's objective is determination of cost of capital or calculation of cost of capital. That's what the chapter's objective. That's it. Nothing else. Okay. Cost of capital calculation is the objective. Is that clear? Let's start with the first source. Debentures. See, you better write heading cost of debentures, right? These debentures are classified into two types. One is irredeemable debentures. Another one is redeemable debentures. If you don't repay the principal in the lifetime of the debentures, then that is irredeemable debentures. Means forever I'll pay interest only, I won't pay any principal. That's what irredeemable debentures. In case if there is a definite life like 10 or 15 years, then such debentures are known as what? Redeemable debentures. Under both the cases, I have to calculate cost of debentures. Are you getting? Yes. This redeemable debentures is classified into two types. Redemption in lump sum. You can redeem your debentures in lump sum amount. Or redemption in installments. Getting? Lump sum redemption means if I raise 100 crores debentures, the maturity period is 10 years. If the maturity period is 10 years, exactly after 10 years, I am going to redeem the debentures. During this tenure of 10 years, I won't repay any principal component. That's what redemption in lump sum. Whole 100 crores will be repayable at the end of the 10th year only, nothing else. That's what redemption in lump sum. If I repay this principal in installments, like 100 crores is going to be repayable in 10 installments, 100 by 10, every year 10 crores principal repayment, then the second case is applicable, redemption in installments. Anything can happen, but in examination they are covering only redemption in lump sum only. Okay. Under all these cases, I have to calculate cost of debentures. Okay. Irredeemable, redemption in lump sum, redemption in installments. But redemption lump sum, redemption in installment is not covered in our study material. Is that clear? Let's talk about the first instrument called irredeemable debentures. Listen dear students, irredeemable means lifetime there will be no repayment. But I need to tell you one important point. Simply, see, if I am issuing debentures for the first time for the first year, I can issue the debentures at face value or at premium or at discount. What do you say? Debentures can be issued at face value, premium or discount generally, right? Then after issuing debentures, I'll get proceeds that is simply known as net proceeds, NP. For example, 100 rupees face value of debentures were issued at 110 premium and all. Okay. While issuing the debentures, I'll also incur some expenses called issue expenses, because basically I can't approach investors directly. I need merchant bankers as a support and also underwriters as a support, so that I'll incur some brokerage expenses, commission expenses. What do you say? That is simply known as flotation cost. See, I'll offer some, simply speaking, these instruments are offered to the investors with the help of what? Prospectus. The prospectus printing cost, compliances cost, commissions, etc. All these expenses comes together as which is simply known as flotation cost. If I say flotation cost, that covers all expenses. Is that clear? So, after incurring all these expenses, I mean for face value of 100 rupees I can add premium, and I can incur some expenses. After recovering all those expenses, means after incurring all those expenses I'll get net profits. That's my amount that I'm receiving at the time of fresh issue. It's a clear case of fresh issue first of all, right or wrong? I will get net profits, if I go for fresh issue. And exactly after 1 year I'm going to pay what? Interest. Students, what I'm going to pay? Interest. I'm going to pay interest. But this interest is a tax deductible expenditure. Am I right? Hello. But this interest is a tax deductible expenditure. Can I get some tax saving because of interest payment? Can I get tax saving because of interest payment? Yes. Every expenditure is a tax deductible expenditure. Sorry. If it is allowed by the department, what do you say? If the department allows any expenditure in the company, that will be a tax deductible expenditure. Why, sir? If I pay interest, can I enjoy tax saving? Yes. Why? Because if I pay interest, what will happen? For example, if I pay interest like this, interest paid on the debt, 100 crores. If I pay 100 crores interest, the profit will be reduced by how much? Reduction in profit will be, because it will be debited in P&L account. Am I right or wrong? Profit reduction will be 100 crores. If the profit is reduced by 100 crores, you don't need to pay tax on this 100 crores, right? Then reduction in tax liability, or reduction in income tax liability. Your tax liability is 30%, at the rate 30%. Since interest payment is 30 crores, to that extent profit will be reduced, so that on such profit you don't need to pay tax. So 30% is a tax saving, so it will be 30 crores. What do you say? If you don't pay interest, the profit increases by 100 crores. On such 100 crores, you should pay 30% tax. That is 30 crores tax liability. Are you going to pay this tax if you pay interest? No. It becomes a saving, right or wrong? This savings arises because of what? This interest payment. Now apply this tax saving percentage on this 100 crores itself, because payment of 100 crores reduces profit. Tax saving 100 crores into 30%, how much? 30 crores. So I can say tax saving on interest is equal to, what's your tax saving? How much interest you are paying? 100 crores. What is the tax rate? 30%. Your tax saving on interest will be 30 crores. Am I right or wrong? Any expenditure if you are paying, if that is allowed under the provisions of the Income Tax Act, salary paid, rent paid, if that is a business expenditure, such payment of expenditure reduces tax liability. Can I tell you the formula for tax saving on any expenditure? Expenditure into tax rate. If you don't pay such expenditure, there will be no tax saving. You can say one thing, sir, I am paying interest unnecessarily. No, you are not paying interest unnecessarily. If you don't use debt, what are you going to use? Equity. Because I need fund ultimately for running my business, right or wrong? If I don't use debt, I'll go for equity. If I use equity, I'll pay equity dividend. If I pay equity dividend, that is not an expenditure at all. Department won't allow you to get tax saving. Department won't allow you to deduct this equity dividend for calculating taxable profit. Have you ever debit this equity dividend payment amount in the P&L account before calculating PBT? No way. They don't allow you. Why? Because equity dividend is a bonus payment, appropriation, that is, I won't allow you. That's what department says. So if I don't use debt, substitute fund I should use equity. I'll pay equity dividend. For example, if I pay 100 crores equity dividend, can I reduce my tax liability? No. So the source debt is creating some saving to you. Am I right or wrong? Such saving should be recognized while calculating the cost of debt. While calculating what? The cost of debt. Hope you got it. So because of this reason, even though you are paying interest for this fresh issue of debentures, you will also enjoy tax saving. Interest is a cost, tax saving is a benefit. Deduct such benefit from it, minus interest into tax rate. Am I right? Students, what is interest cost? Minus interest into tax rate. Means interest into tax rate is what? This is interest into tax rate. What? Tax saving, right or wrong? So interest is cost, interest into tax rate is what? Tax saving. I'll write it here. Tax saving on interest. Covered so many times. This was, what do you say? Tax saving on interest is equal to formula interest into tax rate. Am I right? Now tell me, after 1 year, the company is going to pay interest cost, right or wrong? The company is going to pay interest cost. And also the company is going to enjoy tax saving. Saving should reduce your cost. That's why from interest cost, I have to deduct tax saving on interest. Then I'll get after tax interest, known as simply interest after deducting tax saving. Interest after deducting tax saving. That is my net interest cost. That's my cost actually. Effective cost. Hope you got it. Now, I'm going to calculate cost of debt here. I'm going to calculate cost of debt here, KD. Here I'm going to calculate KD. For which instrument? Debentures. For the first time fresh issue. Okay. For the first time fresh issue, I'm doing this. Once 1 year is over, the instrument becomes, this debenture instrument or debenture security becomes an existing instrument which will carry some price called market price, MP. Market price. Either this market price can be equal to face value or more than face value or less than face value. It all depends on the demand for this particular debenture in the market and the yield which is being offered by these debentures. The company can offer more interest or less interest. Based on that, based on market conditions, the expected interest yield can differ from 1 year to another year. Based on that, the prices will fluctuate. Is that clear? So because of that, the prices usually fluctuate in the stock market, because once this debenture is issued, it will be listed in stock exchange. It will be listed in the stock exchange. So in the stock exchange, you can buy and sell. So automatically it is going to carry some price, which is known as what? Market price. For example, that price can be 105 or 107 or 112 or 95, 97 like that. Is that clear? It is always near to face value. Again, for second year, you're going to pay interest, and also you can enjoy tax saving, and also you can enjoy what? Tax saving. Again, same calculation. Interest minus what? Interest into tax rate. Hello, all of you. Tell me one thing. Tell me one thing here. For the first time issue, your investment is net profits. Am I right? That's your investment. I mean, the investor's investment is net profits. That's what you're receiving. So you're using this money in the company. You're using this money. For that, you're paying this cost. If you want to calculate cost, this cost divided by the amount that I've received, the amount that I've received should be written in the denominator to get what? Cost of debentures. If you want to calculate cost of debentures after 1 year for existing instrument, means once 1 year is over, it becomes an existing instrument. Then for second year beginning, if you want to calculate cost, then interest, this cost divided by the amount that you're using in the company is market price. And simply speaking, price is a basis from second year onwards. Is that clear? For the first time, it will be net profits, but for second time, it will be market price. So simply, I'll write the formula, you'll understand it so easily. There will be two cases. There will be two cases in case of fresh issue. In case of fresh issue. Cost of debentures. I'm talking about irredeemable debentures. Okay. KD is equal to, tell me one thing, how much you're receiving net profits, write it in the denominator. Hello. In the numerator, how much cost you're paying? Is it interest only, or you're receiving some tax saving? You're receiving some tax saving. So I can say I is my cost, I into T is my saving, right or wrong? Then the formula will be, take the common term I out of it, I into 1 minus T divided by net profits. This is a formula for cost of debentures in case of fresh issue. For the first year, it is. For the first year, it is. Is that clear? In case of fresh issue. And I'm going to the second case. In case of existing instrument. Existing instrument means an old instrument. In case of existing instrument, the old instrument, it is. Old instrument means what? Already 1 year is over. No net process and all. It is going to carry some price. Then the formula will be changed. Cost of debentures KD is equal to Cost of debentures KD is equal to, simply the formula is I into 1 minus T divided by MP it is. Market price. You have to use market price instead of what? Net proceeds. Hope you got it. Now for existing instrument, the cost computation is I into 1 minus T divided by market price. What is the difference between first case and second case? In both the cases, my cost remains same. Interest into 1 minus tax rate. Interest after deducting tax saving. Interest after deducting tax saving. Net interest cost or after tax interest cost. That's my numerator. Denominator. If it is fresh issue, net process as a base. If it is an existing instrument, it is carrying some price at the beginning of the second year or at the beginning of the third year. That you have to consider. MP. Okay. With this we understood what? Redeemable debentures. Let's write the terms one by one, where I is equal to interest, T is equal to tax rate, NP is equal to net proceeds. I need to give you a format for calculating net proceeds. That will be our discussion. And MP is equal to current market price per debenture, because it is going to have some price in the stock market. Consider that price, current market price per debenture. The price will fluctuate based on the expected interest rates by the investors in the market. The company can offer higher interest rate or lower interest rate. Based on that, the prices will fluctuate based on demand and supply. Is that clear? The prices of the debenture will fluctuate based on demand and supply. Simply, any instrument price will fluctuate like that only. Is that clear? Market price per debenture. And now I have to explain how these net process can be arrived. Is it over? NP, I need to explain. My dear students, for face value of debenture, either you can add premium or you can deduct discount while issuing debentures, or even preferentials also. That logic is applicable. Is that clear? Hello. These debentures can be issued at face value or at discount or at premium. If you issue these debentures at premium, add it. If you issue these debentures at discount, deduct it. Premium or discount. Then after adjusting this, I'll get what? Issue price. From this, please adjust issue expenses. So what are the issue expenses? The issue expenses can be given like this. They can give you issue expenses in the form of flotation cost, or they can give you issue expenses in the form of underwriter's commission, or they can give you issue expense in the form of brokerage, like that. Is that clear? They can give you issue expenses in any form. Deduct those issue expenses from the issue price to get net profits. Tell me how to calculate net profits. Face value plus premium or deduct discount, plus or minus premium or discount, issue price. Tell me. Issue expenses, flotation cost, underwriter's commission or brokerage. Then you'll get net profits. Is that clear? This is for which instrument? For debentures irredeemable, right? Let's go for the redeemable debentures. Cost of redeemable debentures. Redeemable debenture status. Dear students, redeemable debentures means debentures can be redeemed in lump sum and installments. Our discussion is purely on lump sum only. Okay. So again, for this case also, the debentures are the situations are classified into two types. In case of fresh issue, for the first time issue, and in case of existing instrument. Is that clear? In case of fresh issue, we have a formula, shortcut formula. It is an approximate formula that gives you approximate answer, but you will get full marks in the examination. Okay. Cost of redeemable debentures KD is equal to I into 1 minus T plus RV minus NP by N whole divided by RV plus NP divided by 2. Is that clear? So what are these terms? I as usual interest, T income tax rate, RV means the redemption value, at what price you are redeeming. Are you redeeming the debentures at face value or at premium or at discount? You have to know about it. Okay. NP means as usual net process on issue of debentures. N means life of debentures. Since these are redeemable debentures, there should be a life. For irredeemable, life is not applicable, right or wrong? Denominator terms, same terms, RV plus NP divided by 2. Now dear students, look at the formula, which is just similar to previous formula only, but subject to lot of adjustments. What are those adjustments? See, for redeemable debentures, in addition to interest cost, you can also pay some extra cost. What kind of cost you can pay? Look at this. For example, I've considered this RV minus NP by N, right? So what is this RV minus NP by N? Let's say debentures are assumed to be redeemed at premium. For face value of 100 rupees that I have received, I am ready to pay 110, excess 10 rupees money. Are you getting? How much I have received? Assuming that the debentures are issued at face value and no expenses are applicable. How much money I have received from the debenture holders? 100. How much money I am ready to pay them? 110. Extra I am paying how much? 10. After how many years? 10 years life. The debentures life is 10 years. Now tell me one thing. For 10 years life, you are paying what? A premium amount of 10 rupees. So are you going to pay interest? Of course, annually I am going to pay interest. In addition to that, I am paying premium here. This premium amount is an expenditure to the company. Premium on redemption of debentures. It leads to some extra cost. Am I right? But I should annualize it. This is what the premium cost, 110 minus 100, 10 rupees. Per annum cost means 10 divided by 10. Per year cost is how much? 1 rupee. Is that clear? That's what I am adding it here separately. I into 1 minus T, interest after deducting tax saving. In addition to that, I am adding what? The premium for the whole 10 years, which is being annualized by dividing that number with what? Number of years. Annualized premium cost. Are you getting? Instead of that, if you are going to redeem these debentures, at face value only 100 RV, whereas I have received, wait, RV 100 rupees I am redeeming, I have received, wait, 110 I have received, premium I have received, I received 10 rupees extra, divided by 10. Now look at this. How much I have received from the investors? From debenture holders I received 110, but I am paying only 100. How that is possible? Yes, that's my credibility. My company is a long standing company. I am offering debentures at premium and redeeming debentures at face value. Debenture holders are ready for that. Excess, see, look at this, 110 I am receiving, 100 I am paying. So this premium is a benefit or cost to me? Benefit. How much benefit I am receiving here? 10. Per year, how much benefit I am enjoying? 1 rupee. Is it going to reduce my cost or not? Yes. That's why if you take this 100 minus 110 minus 10 divided by 10 minus 1, it reduces cost. In this formula, the second term becomes minus. You don't need to do it. If you solve this, you'll get it, it gets executed. Is that clear? So sometimes if I issue the debentures at face value, if I issue the debentures at premium and redeem the debentures at par value, I can enjoy this annualized premium benefit that will reduce my interest costs. Are you getting? The same logic is applicable to discount also. Debentures can be issued at discount, redeemable at par value. 90 rupees issue price, 100 rupees payable value. So RV redemption value 100, the issue price is 90, difference is 10. Discount cost I am paying here. Okay, annualized discount cost. Sometimes the second term can be annualized discount cost also. If you are issuing the debenture set discount and redeeming the debenture set face value. Are you getting? So what are all these? See, these are all logical explanations. That's it. Ultimately, if you substitute the formula, it will do it. Whether you understand it or not, it doesn't matter. You will get the answer. Okay. So the first term is interest after deducting tax saving. The second term is premium cost on per annum basis, annualized premium cost. So interest after deducting tax saving plus premium cost divided by, you can't write net profits here. You should take average. Why? Because you're receiving net profits and redeeming some other number. Take the average of it. Okay, receiving net profits, redeeming some other number, take the average of it. So that gives you on an average cost of redeemable debentures. Hope you got it. Yes, this is a way to remember this formula. Now tell me, what is the formula for cost of redeemable debentures in case of fresh issue? I into 1 minus T plus RV minus NP by N whole divided by RV plus NP by 2. Hope you got it. In case of existing instrument, what's that? In case of existing instrument, what is the formula? Same formula. KD is equal to I into 1 minus T plus RV minus MP. See, instead of net process, I am going to use what? Market price. MP by N whole divided by RV plus MP divided by 2. No change in the formula. Are you getting? That's it. This is for redeemable debentures in case of existing instrument. Let me define every term clearly, where I and T I've defined. R net process and MP also defined. What are the new terms I should define? RV, where RV is equal to redemption value, right? Usually in the problems, they don't give you redemption value. At what price I should redeem? If they don't give you redemption value, always assume that debentures are redeemable at par value. Okay, par value means face value, and N is equal to life of debentures. Apart from that, every term is defined, right or wrong? Yes. With this we understood. In case of redeemable debentures. Got it? Let me go for the next source, preference share capital. My dear students, for preference share capital, again the instruments are classified into two types: irredeemable, redeemable, right? Preference share capital is classified into two types: irredeemable preference share capital and redeemable preference share capital. This is again classified into two components: redemption in lump sum redemption in installments. Okay. So for this instrument also I need to calculate cost. Is that clear? Yes. Irredeemable preference share capital. Cost of, yeah. Okay. Now, this is again classified into two types. In case of fresh issue, cost of preference share capital is equal to, my dear students, this formula is so easy. Same previous formula. Denominator, write net profits, NP. Numerator, which cost you are going to pay on your preference share capital? Is it interest or preference dividend? Preference dividend. Write PD. Sir, into 1 minus tax, what will you write it? No, because preference dividend is not a tax deductible expenditure. I cannot enjoy tax saving on preference dividend payment, so it remains same. So you can't write into 1 minus tax rate. Okay, tax saving is not applicable here. The tax saving is applicable only for one source. What's that? Debt. In case of existing instrument, same formula. In case of existing instrument, cost of preference share capital KP is equal to preference dividend PD divided by MP. Is that clear? Let me write for redeemable debentures also. Then we'll define the terms. Cost of redeemable preference share capital. Again here the classification in case of fresh issue, same logic. Okay. Whatever the logic for cost application, cost calculation, I've told you. So whatever the logic I told you, that same logic applicable to preference share capital also. Okay. No need to explain it again, because it is also a fixed bearing fund, fixed cost bearing fund. Cost of preference share capital KP is equal to, it is PD plus RV minus NP by N whole divided by RV plus NP divided by 2. Hope you got it. This is the formula for cost of preference share capital KP. In case of existing instrument, same formula, change NP as MP, right or wrong? Cost of preference share capital KP is equal to formula PD plus RV minus MP by N whole divided by RV plus MP divided by 2. Am I right? Yes. Where, let's define the terms one by one, where PD is equal to preference dividend, right? What is PD? Preference dividend. Same explanation. MP we have to define, and N also, right or wrong? N is equal to life of preference share capital. What do you say? And MP is equal to current market price of preference shares. Remaining terms are same, right or wrong? Current market price of preference shares. That's it. See, with this we have completed cost of preference share capital. Equity cost computation is so difficult, we need to invest a lot of time. Okay. Did you write it? Yes. In the next session, we'll start with equity cost. Bye. Good afternoon, all of you. Yes, let's start with the other concepts in cost of capital. I need to cover one more concept under debentures, that is cost of convertible debentures. Once that is over, then we can move to cost of equity. Can I start with that? This cost of convertible debentures. Let me tell you, dear students, convertible debentures means the debentures can be converted into equity shares at the option or the discretion of the debenture holder on maturity. So after the maturity, the debenture holders are left with two options. Either they can choose converting these debentures into equity shares, or they can go for cash redemption. So which one they usually choose? It is dependent on the redemption value that they are getting at the time of maturity. See, for example, I am offering debentures with 10 years maturity. Today I'll get some net profits, right? Some face value or something, some premium and discounts and all I'll receive. And after 10 years, they need to get redemption value. Convertible debentures are just like redeemable debentures only. Usually in redeemable debentures, we used to repay what the principal component on maturity. The redemption value is generally equal to the face value. But here, the redemption value is not equal to the cash value. In fact, it is equal to conversion value. Means you have to calculate the conversion value of debentures on the date of maturity. Are you getting? Every debenture is supposed to be converted into certain number of shares that should be offered at the time of issue of convertible debentures itself. At the time of issue of convertible debentures, we are going to promise them each debenture is going to be converted into 10 number of shares, or 8 number of shares, or 15 number of shares, or 20 number of shares, like that we are going to offer them. So based on that, they'll invest. Okay. So for example, one debenture is converted into, that is to be converted into 10 shares. This is what the offer we are offering to them. One debenture is converted into 10 shares. Hello. So then in that case, we have to calculate these 10 shares value after these 10 years. For example, if you purchase these debentures, after 10 years you are going to receive 10 shares for each debenture, right? For such 10 shares, you have to calculate what the value of shares. Today there will be a price for this company shares, right or wrong? MP naught is equal to somewhere around, for example, if the share price today is 100 rupees, or else, let's take like this, the current market price per share is 50 rupees today. Okay. Because we are taking debenture here, let's take 10 rupees. What is the share price today? 10. After 10 years, you have to calculate the share price. You have to calculate MP10 share price. Means 10th year ending market price of the equity share. Are you getting? So as a debenture holder, how much value you are going to get? The redemption value RV is equal to the redemption value RV is equal to, you're going to get 10 number of shares. You are being allotted with 10 number of shares after 10 years. That is to be multiplied with share price per share at the end of 10th year, MP10. Are you getting? So number of shares for each debenture should be multiplied with market price per share on the date of maturity. That gives you redemption value or the conversion value actually. So then I have to calculate MP10. How to calculate MP10, sir? MP naught into 1 plus Z whole to the power of 10. This is the way to calculate the share price. For example, MP naught is 10 here into 1 plus growth rate. The growth rate applicable to the share price is 20% per annum. Power 10. G is 20%, means 0.20. Calculate the share price after 10 years and tell me the value. 1.2 power 10. How much? What's that? MP10 61.917, right? So you are going to get 61.917 for each share that you are being allotted, right or wrong? Now on redemption, how much value you are going to get? 10 shares into 61.917, then that will be 619.117. Am I right or wrong? So how much you are getting as a redemption value as a debenture holder? 619.17. Or else you can choose the redemption value in the form of cash. That is, redemption value is equal to 100. Which one you are going to choose? Which one is higher for you? If you get shares, the share value is 619.17. If you get debentures, the cash value as a redemption value, you are going to get 100 only. Now tell me, which one is higher here? 619.17 only. So usually the debenture holders under convertible debentures are being given as an option. See, either they can choose the redemption value in the form of cash option, or they can choose the redemption value in the form of what? Shares option. So either they can get shares or they can get what? Cash value. Whichever is higher, that's their discretion. They have to choose it. So conversion value or the cash option, whichever is higher, being chosen by whom? The debenture holders. Hope you got it. So you have to calculate all these things. So the ultimate thing in this formula is redemption value computation. RV is equal to MP naught, number of shares for each debenture, number of shares for each debenture into number of shares for each debenture into MPN. MPN means what? Nth year ending market price. Now you have to calculate MPN means MP naught into 1 plus G whole to the power of N. This is the formula for nth year ending market price. What is the formula? MP naught into 1 plus Z whole to the power of N. Are you getting? So once you get it, you can calculate cost of convertible debentures so easily. Cost of convertible debentures is equal to, I have to write the thing here. RV is equal to higher of cash option or stock option, simply. So they have to choose either cash option or stock option, whichever is higher. Okay. Now then I have to calculate cost of convertible debentures. Cost of convertible debentures is equal to KD is equal to I into 1 minus T plus RV minus NP by N whole divided by, this one. RV minus NP divided by N whole divided by RV plus NP divided by 2. Same formula which is applicable to redeemable debentures. But here the redemption value is not a regular one. It is based on what? The higher of cash option or the stock option. Under stock option, how to calculate redemption value? Number of shares for each debenture into MPN, nth running market price. So nth running market price is equal to MP naught into MP, 1 plus Z whole to the power of n. So we have to calculate the share value after 10 years because it has to be increased, right or wrong? It will grow because of the growth rate applicable to the share price. Tell me, what is the formula for cost of convertible debentures? I into 1 minus T plus RV minus NP by N whole divided by RV plus NP divided by 2. Now tell me, what is the formula for redemption value? Generally higher of cash option or stock option. Stock option formula. Redemption value is equal to number of shares for each debenture into MPN. MPN means nth ending market price. On maturity, what is the share price? Okay. The share price MPN formula. MP not into 1 plus Z whole to the power of N. Are you getting? Yes. It is what redemption value. So this is regarding cost of convertible debentures. Let's handle few problems related to these concepts. Then I'll start with cost of equity later. Shall we start with that? Hello. Go for cost of capital chapter. Page number please. '86. Yes. Illustration number 1. Can I start with that? 86. Here is the question. X Limited has 10% perpetual debt. Perpetual debt means irredeemable. Okay. So the discussion is regarding irredeemable debentures. 1 lakh. The tax rate is 35%. Determine the cost of capital before tax as well as after tax. Before tax cost of debt is nothing but interest divided by net profits. After tax cost of debt means I into 1 minus T by net profits. If you multiply 1 minus tax, that becomes after tax cost of debt. If you don't multiply with 1 minus tax, that becomes before tax cost of debt. Okay. Assuming the debt is issued at par, at 10% discount and at 10% premium. These are the 3 questions we have to handle. Shall we start? Illustration number 1. We should start with cost of irredeemable debt. What is the formula for cost of irredeemable debt? Also known as what? Perpetual debt. For calculating before tax cost of debt, the formula is I by NP for fresh issue. Are you getting? Heading before tax cost of debt. Okay. Now, let's start with this first situation. When debt is issued at par, and also please listen, let us calculate net process first of all. Once that is over, then I'll go for the remaining things. NP, net profits. Tell me, face value or issue price, both are same here, right or wrong? At what value are issuing the debentures? Face value only, right? That becomes issue price. Any information regarding issue expenses? Issue expenses. No information. Means 0. So how much net process you are going to receive? Okay, it changes from one situation to another situation, right? I just wanted to write interest, but I wrote net process suddenly. Interest is common to everywhere. Okay. Have you written this? Okay. Then this is going to be written later actually. Now it is not needed to be written. Okay. Listen, where I is equal to interest, right? Next only I have to write this. Interest. Interest means face value of debentures is 1 lakh, it is right? Interest rate is how much percentage? Then I am going to pay an interest amount of 10,000. Am I right? Next, first case. If debentures are issued at par, then I have to calculate net proceeds. Face value. At what price you are issuing the debentures? Or issue value? Both are same, right? No issue expenses are applicable here. Minus issue expenses. Expenses were not given here, right or wrong? So nil it is. Then your net proceeds. How much that is? 1 lakh. Then before tax cost of irredeemable debt is equal to KD is equal to formula I divided, already we have written that, right? Substitute these numbers. Interest is how much? 10,000 divided by net process, how much you got it? 1 lakh. It will be 10% before tax cost of debt. Or you can write 0.10. Okay. This is for fresh issue. That's why I have written net process instead of market price. Am I right? Next. Second situation. If debentures were issued at 10% discount. If debt is issued at 10% discount. Are you following this, my dear students? Yes. If you issue the debentures at 10% discount, what will happen? The net process will change because of the discount. Am I right? Face value of, I need to calculate NP. Face value of debentures. How much? 1 lakh it is, right? Now your discount, you need to deduct the discount from it. Minus 10% discount. It will be 10,000. Then I'll get what? I'll get how much? Name this. Issue value. Not this is not net process. Okay. This is what? Issue value of debentures. From this you have to deduct what? Issue expenses. Even though issue expenses were not given, why I am writing it here? For practice. Is that clear? Which is supposed to be deducted at any point of time. Net proceeds. Is that clear? Now can I calculate before tax cost of debt? Before tax cost of debt is equal to KD is equal to interest is how much? 10,000 divided by 90,000. Tell me the value. 0.11% is right? Yes. Next, third situation. If debentures are issued, if debt is issued at what? 10% premium, right? Then face value 1 lakh. Add 10% premium, right? $10,000. Then issue value 1,10,000 minus issue expenses. How much? Nil. Then your net profits 1,10,000. What do you say? Then cost before tax cost of debt KD is equal to formula. Yeah, already we have written that formula. Again and again I'm asking. 10,000 divided by 1,10,000. It will be 0.0909 means 9.09% is right. Which formula is applied here? The formula that I have not explained to you, because this is before tax cost of debt, right or wrong? See here, interest by net profits. Interest I have calculated, everywhere interest remains same. The only changing number is net profits. Net profits means face value adjusted with discount or premium, subject to deduction of what? Issue expenses. No issue expenses were given here, but still I have deducted as nil because for the sake of practice. So for face value, I've got 1 lakh only, and interest 10,000 by 1 lakh, 10%. This is before tax irredeemable debt. When I am issuing debt at 10% discount, deduct 10% discount from face value 10,000, issue value is 90,000. No issue expenses, net process 90,000 same. Then before tax cost of debt is 10,000 by 90,000. My cost of debt is 11.11%. In case of premium, 10% premium should be added to face value 10,000. I got issue value 1,10,000, no issue expenses, nil. I got net process of 1,10,000. My before tax cost of debt comes to 10,000 by 1,10,000, 9.09%. Now from now onwards, I need to calculate cost after tax cost of debt, right? After tax cost of debt is equal to after tax cost of perpetual debt, KD is equal to interest into 1 minus tax rate divided by net profits, right? You know, right? Already we have written interest. I need to write tax rate. How much is our tax rate? That was given in the question itself, right? In the first line itself, they have given 35% tax rate, where T is equal to tax rate. Already we have calculated interest, and also we have calculated net process. No need to calculate again every number, okay? 35%, that is 0.35. Now, point 1. If debt is issued at par value, then After tax cost of debt is equal to KD is equal to formula. Yeah, we have written that formula. Again, again and again I am doing that. Interest is how much? 10,000 is your interest, right? Into 1 minus tax rate means 1 minus 0.35 divided by our net process comes to, actually we have, you don't need to calculate net process, already we have done that, right or wrong? 1 lakh for face value. When you are issuing debentures at face value, earlier we calculated that number only we have to take it. 6,500 numerator. Is it so? Then you will get 0.65, 0.065, that is 6.5 percentage. Am I right? See, it is per annum basis only. Okay, no need to write it actually, just saying. This is for face value issue. Second point, if debt is issued at discount, hello, then I have to calculate what? After tax cost of debt. After tax cost of debt KD is equal to 10,000 into interest 1 minus 0.35. Listen. Divided by 90,000 it is, right? My net profits under second situation is 90,000. Tell me the answer directly. 7.2% is right? Yes. Third one. If debt is issued at 10% premium, then after tax cost of debt is equal to KD. Actually, are you mentioning KD every time? Yes. Tell me, interest 10,000 into 1 minus 0.35 divided by 1,10,000. Tell me the percentage. 5.91 percentage, right? With this we have completed the first problem. Is that clear? Go for the second one. Is it over? Five years ago, I said what? 5 years ago, KPM Limited issued 12% irredeemable debentures at 105 at 5 rupees premium to their par value. At what value they have issued? 105. I don't care because it's an existing instrument. Because 5 years is over, is it a fresh issue or existing instrument? Existing instrument. The current market price of these debentures is 95. I care about this number. Today's debenture price is how much? Market price 95. This is relevant because it is a clear case of existing instrument. I must use market price, not net profits. Am I right? If the company pays corporate tax rate of 35%, what is the current cost of debentures capital? Tell me one thing. These debentures are irredeemable or redeemable? Irredeemable. Fresh issue or existing instrument? Existing instrument. Hello all of you. Existing instrument because 5 years ago these debentures were issued. Illustration number 2. Cost of irredeemable debt. Formula: interest into 1 minus tax rate divided by MP, market price. Where I is equal to interest face value of debentures. Any information regarding face value of debentures? 100. One rule you must keep it in mind: interest rate should always be applied on face value of debenture, not on the issue value. Interest rate, please. 100 into 12%, it comes to 12 rupees. T tax rate, income tax rate, corporate tax rate or income tax rate, 30. It is 0.35, right? MP is equal to current market price per debenture. $95 it is, right? Today's debenture price. KD is equal to 12 into 1 minus 0.35 divided by 95. Tell me the answer. 0.082. Before solving these questions, you must have revised these formulas. 0.082, right? 8.2%. I guess you must get other decimals also. 0.082. At least tell me two decimals. 21. 21 enough. 21. 8.21% is two decimals at least. Are you getting? With this we have completed second problem. Written or still writing? Written. Go for illustration number 3. It is 3. Can I read it? XYZ Limited keeps perpetual fixed amount of debt in its books. It pays coupon rate of 15%. My dear students, coupon means interest rate. The interest rate that is offered by the company is 15%. Its debt sells at par in the market. Right now, the selling price is par value. What is the cost of debt in the firm's? What is the cost of debt if the firm pays 35% tax rate? What is the cost of debt if it sells at 5% premium, 5% discount to the face value? First, you have to consider par value, then premium, then discount. 3 situations it is. Life was not given. It's a clear case of cost of redeemable debentures. Am I right? Hello. No need to do this sum. Earlier already we have solved one sum, right or wrong? Yes, look at this. KD is equal to I into 1 minus T by net process. Anything great in that? It's a regular formula only, after tax cost of debt, perpetual debt. Where interest is equal to 100 into 15%, 15 rupees. They ignored to solve this. Write it. 100 into 15%, 15 rupees. NP is equal to net profits sold at par 100 rupees. Actually, market price I have taken, or else you can consider net process only. Why? Because keeps a perpetual fixed amount of debt in its books, means it's an existing debt. Actually, it's an existing debt. Existing debt means you have to consider market price. Are you getting? So the market price I have taken is par value only for 100. Hello. So being sold at par, tax rate 35%, substituted all the numbers and they got 9.75. Check it. 15 into 0.65 divided by 100 is a number. I got 0.0975, that is into 100, 9.75%. That is my after tax cost of debt, existing situation. Are you getting? Hello. Anything great here? What is a new thing here? Just do it. Second question, if the debt is issued at, if the debt is if it sells at 5% premium, then this time a market price is changing. Selling at means in the stock market the price is going like this. For 100 value, you have to add 5% premium. 105 is a market price. Am I right or wrong? For second case, if market price is at 5% premium to the face value, that is 105, then cost of debt is same formula. Denominator will be changed. What is the price? Hello? What is the price? Since these debentures are fresh issue or existing instrument, it's a clear case of existing instrument because they have mentioned the company is having its debt in its debt in the books, right or wrong? Keeps perpetual debt in its books, so it's an existing instrument clearly. See, selling means the price of the share, the price of the debenture in the stock market, it is selling actually. It is selling at par value, premium value, discounted value also sometimes. How much you got for second option, point A? You're doing it, okay. 15 into 0.65. Yeah, 9.28 you got it, right? But they got it something else. Change it then. Not 9.25, change it to 9.28%. What is so new here? Only thing, market price is expressed as a percentage of premium and discount here for the first time. It seems to be like a fresh issue. But even if you use such formula, that's okay, you'll get full marks actually for calculation purpose. If the market price is shown at 5% discount to the face value, then my market price will be 95. Am I right? Then your cost of debt KD will be equal to 15 into 1 minus 0.35 as usual numerator. Denominator, it will be 95 market price. Am I right? So 10.26%. With this we have completed which sum? Illustration number 3. Hope you got it. Now go for illustration number 4. Redeemable debentures. Can I start that? ABC Limited issued 5,012% debentures of 100 rupees each at a premium of 10% on 1/4/2018 to be matured on 1/4/2023. 1/4/2018 to 1/4/2023 means 19, 20, 21, 22, 23. Totally how many years? 5 years life. The debentures will be redeemed on maturity. My dear students, it's a clear case of redeemable debentures, right? Life is how many years? 5 years. N it is, right? Any information regarding redemption value, the debentures are redeemed on maturity at par value, at discount or at premium, any information like that? Then in that case you should take one assumption. Debentures are assumed to be redeemable at par value, means redemption value RV is equal to face value. Okay, that is 100. Compute the cost of debentures assuming 35% as tax rate. It's a clear case of cost of redeemable debentures, right or wrong? Any information regarding fresh issue or existing instrument? They said what? Issued. You can take NP or MP, doesn't matter actually, okay, because in both the cases the value remains same. Let us take net proceeds only by assuming that this is a fresh issue. Illustration number 4. Cost of redeemable debentures KD is equal to formula I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2. Where I is equal to interest. Face value is how much? 100. Interest rate 12%. 12 rupees interest, right? T is equal to tax rate, right? How much percentage? 35%, that is 0.35, right? RV is equal to redemption value. Any information regarding redemption value? Then I can take redemption value as face value. How much? 100. Now net proceeds. Let's take net proceeds as face value only. No issue expenses, no information regarding premium or discount, and in fact that is existing instrument or fresh issue, don't know. I can take market price as 100 or I can take net proceeds as 100. You can take here NP or MP also. Both the cases it works. Are you getting? Because the information is not clear. Premium issued at premium. Illustration number. Okay, issued at 10% premium. Fine. We need to calculate it, right? Then NP should be calculated. See, they said clearly the premium value, right? Face value is how much? Hello? 100, right? Add 10% premium. Add it. 10 it is. Then issue price will be 110. Am I right? I never saw that actually. Minus issue expenses. Any information regarding issue expenses? If issue expenses are not there, then your net process will be 110. Am I right? Then it will be like substitute all. I need to define other terms also. N is equal to life of debentures. How many years? 5 years. Anything else to define? Nothing. KD is equal to interest, please. 12 into 1 minus 0.35 plus redemption value 100 minus net profits 110 divided by life 5 years whole divided by 100 plus 110 divided by 2. Solve this and tell me the answer. 0.055223 or 5.523%, right? This is regarding cost of redeemable debentures. See, we thought that it is an existing instrument, but they have given premium, so it is clear that these are redeemable debentures issued at premium. So it's a clear case of fresh issue, right or wrong? With this, we have completed illustration number 4. Can I go for 5? Yes. Look at 5. PQR Limited issued 12% debentures of 100 rupees each on 1/4/2018 and to be matured on 1/4/2023. How many years? 5 it is, right? The market price of the debenture is 80. For the first time they have given market price, so it is a clear case of existing instrument. Am I right? Compute the cost of existing debentures assuming 35% tax rate. Let's deal with this. It is a cost of redeemable debentures in case of existing instrument. Illustration number 5. Formula I into 1 minus t plus RV minus MP by N whole divided by RV plus MP divided by 2, right? Where I is equal to interest Face value 100 into interest rate 12%. 12 rupees is my interest value, right? T tax rate or 0.35. RV redemption value any information regarding redemption value? No. So I can take face value as redemption value 100 only, right? Then MP market price of debenture is 80. N is equal to life of debentures. How many years? It is clear that it is 5 years, right? Then KD is equal to interest, please. 12 into 1 minus 0.35 plus redemption value 100 minus 80 divided by 5 whole divided by 100 plus 80 divided by 2. Right or wrong? Yes, please tell me the answer. 0.1311, 13.11%. Yes. With this we have completed illustration number 5. Look at illustration number 6. Go with illustration number 6. Can I start with that? Yes. Tell me, students, what is illustration number 6? Rima & Co has issued 12% debentures of face value of 100 for 10 lakhs. Of course, it can be given for 10 lakhs or 10 lakh crore. It doesn't matter. Always cost should be calculated for single debenture. That is applicable for all the debentures. Debentures is expected to be sold at 5% discount. It's a clear case of fresh issue. It will also involve flotation cost of 5 rupees per debenture. For the first time we got one new point, right or wrong? Issue expenses. Next, the debentures are redeemable at a premium of 5% after 10 years. They are very specific this time. The debentures are redeemable at premium. You should be careful while calculating RV, redemption value. Calculate the cost of debentures if the tax rate is 50%. Can I start with this cost of redeemable debentures by adjusting all the factors? Yes. Illustration number 6. It's a clear case of fresh issue and redeemable debt or debentures. So it is simply cost of debentures KD is equal to formula I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2. Am I right? Where I is equal to interest. How much that is? 100 into interest rate. Tell me. 12%. Value 12 rupees. Am I right? Hello. T tax rate. That comes to 50% is 0.5, right? RV redemption value. This is 100 into premium is how much? Then 105% is your redemption value. 5% is premium, 100% is principal. 105 rupees only, right? Now N is equal to life of debentures. How many years it is? They've given the life, right? How many years? 10 years. Then I should go ahead with what? NP, net process. For the first time they've given flotation cost. At what price we are issuing these debentures? Premium or discount? Issue price. Face value 100. How much discount? 5% discount. Deduct 5% discount then. 5 rupees only, right? Issue price. That is 95. Am I right? Minus issue expenses or what? Flotation cost only. Am I right? The only issue expenditure that is given in the question is flotation cost. First time we are deducting the issue expenditure. That comes to, you're not saying 5 rupees per debenture, right? Any doubt? Same logic. I'm just following the process, the formula and all, right? 90 is what? Net. This is net profits. Anything else to define? This is the new thing. For the first time they have given flotation cost and all. Now let's start with computation. Already we have written the formula. KD is equal to interest, please. 12 into 1 minus 0.5 plus RV redemption value 105 minus net process 90 divided by life 10 it is, right? Okay, whole divided by 105 plus 90 divided by 2. Tell me the answer. It is 5 years or 10 years? 10 years only. Okay. Unfortunately, we don't get the answer which is given in the study material, I guess. But still tell me. Because they have taken tax rate for second part of the question also. But that's not correct. Follow this process only. That is also one of the alternative. But in the main examination, they are giving like this only. Answer. 0.7.692% is. You. Tell me the answer. Yes, this is your KD, right? With this we have completed which problem? Sixth one. Am I right? Hello? Yes. Yes. Let's start. Now go with illustration number 8. That is cost of convertible debentures. Can I read the question? RR Limited issued 10,000 12% convertible debentures of 100 rupees each. Look at the question. Convertible debentures it is, right? With a maturity period of 5 years. At maturity, the debenture holders will have the option to convert the debentures into equity shares of the company in the ratio of 1:10. That means 10 shares for each debenture. Every debenture can be converted into how many number of shares? 10 shares. What do you say? The current market price of the equity shares is 14 rupees each. See, this is current market price. I can say this is MP not. Okay. And historically, the growth rate of these shares are 5% per annum. So my average growth rate of the share based on the earlier experience, past experience is 5%. This is G. Compute the cost of debentures assuming 35% tax rate. Shall we start with that? Yes. Illustration number 8 we are solving. Illustration number 8. What is my first job? I first have to write the formula, right? Cost of convertible debentures KD is equal to I into 1 minus T plus RV minus NP, net profits or market price, doesn't matter. NP by N whole divided by RV plus NP divided by 2, because no adjustments are given for net profits. Let's start with interest, where I is equal to interest. Face value please. 100 into interest rate 12%. It will be 12 rupees. T is equal to tax rate. That comes to 35%. NP net proceeds, no information. I assume that face value only, right or wrong? No issue expenses, no market price, no premiums, no discounts. It is 100 only. Any information like that? No. N is equal to life of convertible debentures. How many years? 5 years. The main thing is you have to calculate redemption value. That is more important. Okay. RV is equal to redemption value. This is what you need to calculate it. Hello. First thing we have to do, redemption value. Yes. First one is the cash value of debentures. If you go with cash value, you'll get how much? Face value only, right or wrong? Students, you're going to get 100 only, right or wrong? Yes, first point. Second point, now you need to calculate conversion value of equity shares. Actually, value of equity shares, that's what you need to calculate. This is stock value. Formula, I told you already. Number of shares for each debenture into MPN. That's what I've given to you. 10 shares it is, right? Into MPN means MP 5 or so MP 5 is equal to MP naught into 1 plus Z whole to the power of 5. Current market price per share is how much? 1.4 into growth rate of applicable to the share price 5%, 0.05 power 5. Tell me the value. How much that is? 106.31. This is my market price at the end of the 5th year for equity share, right? Now let's go for the value of equity shares. What is this then? You don't get this much value, right? Yeah, this one is wrong. 17.8679. Value of equity shares after the maturity. 10 shares they are giving us for each debenture into 17.8679. Now tell me the value. 178.679. This is my value of equity shares. So which one you want to choose? Is it the cash value or the value of equity shares? Obviously the debenture holders will choose this. So take this value as redemption value. Yeah, here it is. Yeah. Is it over? Yes. Now RV is equal to redemption value, which is higher of what? Higher of cash value or stock value. Cash value or shares value. How much it is? You're not saying 178.679. Yes. Now take this number and calculate KD. Interest is how much? 12 into 1 minus 0.35. Am I right? Plus 178.679 means I can take 68 minus redemption value, RV minus NP, net process 100 only. Life 5 years. Whole divided by 178.68 plus 100 divided by 2. Tell me the answer. 0.1689, huh? Or 16.89%, right? Hope you got it. With this we have completed illustration number 8. Okay, can I start? If you remember, cost of preference share capital we understood in our earlier sessions, but the thing is, we understood the formulas when dividend tax is not applicable. See, when you are paying dividend, preference dividend or equity dividend, in case if dividend distribution tax is applicable, that becomes a cost to the company. The formula will be changed completely. The same formula, but we need to add dividend distribution tax called DT. Okay, simply we'll say dividend tax. Hello. So I'll write the formula. If dividend tax is applicable, then KP is equal to, the formula will be PD plus, PD into, wait, I'll write the formula in blue color. KP is equal to PD into 1 plus DT, means what? Dividend tax divided by NP or NP for existing or fresh issue. Denominator depends, right or wrong? Hello. NP by MP. It is not NP by MP. It is either net process or, I'll write it clearly, or. Otherwise, you'll take this as divided. NP or MP. You know that, right? For redeemable preference share capital, the formula will be PD into 1 plus PD into 1 plus dividend tax plus RV minus NP or MP divided by N whole divided by RV plus NP or MP, because it is for existing instrument as well as for new instrument, right? For both the cases it is applicable. The thing is, we have to apply DT, dividend tax. How to calculate such dividend tax? That's our next discussion. The dividend tax is bifurcated into three parts: regular rate, surcharge, and education cess. That should be considered separately. Hope you have written this. Now let me see this. The material, concept book. Please open concept book and go for the cost of capital chapter. Page number please. One. Yes. 125. Yes, it is. See this dividend tax, TT. Already I have given you all the formulas. Ooh, it is not visible. Huh? Even in here also, green color won't work. In screen it won't work, right? That is also not visible. Huh? That's why I didn't understand. Okay. So might be it is not visible. I'm showing this as dividend tax. This is your dividend tax. Dividend tax. Okay. Dividend tax. See, dividend tax, the final dividend tax is the sum of the above components. Tax on dividend, first of all, surcharge, education cess, secondary and higher education cess. All these three should be applied on tax on dividend. Repeating, first you should calculate tax rate on dividend. If you have surcharge, education cess and secondary and higher education cess, apply these percentages on what? Tax on dividend. Are you getting? Hello all of you. See, this is $213 to $298. Here it is. Look at the statement. Hello students. Look at this table. What's this? Computation of dividend tax. See this? tax on dividend should be calculated. Surcharge to be calculated on what? Tax on dividend. Education cess to be calculated on what? Sum of total of tax on dividend and surcharge. And secondary and higher education cess to be calculated on what? Sum of total of tax on dividend and surcharge. So ultimately you have to do like this. This tax on dividend, first we have to calculate that, then again calculate surcharge. Surcharge should be calculated on tax on dividend. Once that is over, then this education cess and secondary and higher education cess should be calculated on sum of tax on dividend plus surcharge. This you can understand while solving the problem only. Until then it is like a, yeah, you don't need to write it actually. Okay, or else you can, if you see, this is available in study material. If you want to refer it, you can see that. Yeah, okay, fine. Write it then. Please write everyone this format. Okay, now with the help of this background, let us handle two problems. Let's start with that. Actually, I told you what? Education cess and secondary and higher education cess should be applied on tax on dividend plus what? Surcharge should be added. These two numbers should be added for calculating education cess and secondary and higher education cess. Okay, that's not an issue. Already I've given you one format. Just leave this, okay. Now let's see. The question. Hope you have written that format. Now go for illustration number 9. B Limited issued 60,000 12% redeemable preference shares of 100 rupees each at a premium of 5 rupees each. Redeemable after 10 years at a premium of 10 rupees each. Face value 100, premium 5. Total issue price 105, right? And redeeming the debenture preference shares at premium value only means 100 plus 10, 110 is your redemption value. The flotation cost of each share is 3 rupees. How much is the flotation cost? 3 rupees. You are required to calculate the cost of preference share capital ignoring dividend tax. Taxes were not applicable here. Okay. Now this, for this problem, I don't need such format and all. It's a direct question. Is that clear? Now illustration number 9. Wait. Yes, tell me. Cost of redeemable preference share capital it is, right? KP is equal to PD plus RV minus NP, it is net process by N whole divided by RV plus NP divided by 2. I don't need to write this PD into 1 plus TT. Am I right or wrong? Where PD is equal to preference dividend. That is equal to face value, please. 100 into preference dividend rate 12%. That comes to 12 rupees. Next, RV redemption value. Am I right? Any information regarding redemption value? Yes, 100 plus premium 5. 105 or 100 plus 10, 110, right? 100 plus 10, 110. Now coming to net profits, I should consider premium NP. Face value is how much? 100 plus premium issue price. Any issue expenses? Students. Yeah, we have a flotation cost. Issue price 105 minus flotation cost. How much? 3. 102. This is my net profits. I got RV, NP, and N, life of preference shares. N is equal to life of preference shares 10 years, right or wrong? We got RV, NP, N, everything is there. Now, KP is equal to PD. Preference dividend, please. 12 it is. 12 plus RV redemption value 110 minus net profits 102 divided by N 10 whole divided by 110 plus 102 divided by 2. Tell me the answer. 0.12075 means 0.1208 or 12.08% right? Unnecessarily in the study material they have done the computation by taking whole capital into consideration. That is not at all necessary. You can take single debenture or single preference shares for calculating the cost of the respective sources. Is that clear? Done. Can I go for the next problem, students? Yeah. This is so important because it is loaded with what? The preference dividend tax consideration. Illustration number 10. Y company limited issues 10,000 12% preference shares of 100 rupees each at a premium of 10%, means issue price is 110, but redeemable at a premium of 20% after 5 years, means the redemption value is 100 plus 100 into 20%, 120. Am I right? The company pays underwriting commission of 5%. Here they're paying underwriters commission that should be deductible while calculating issue expenses. Am I right or wrong? That has to be deducted from issue price. That is so important. How much it is? Percentage please? 5%. If tax on dividend is 12.5%, surcharge is 2.5% and education cess is 3%. They are not classifying the education cess into secondary and higher education cess like that. They have not classified. So one education cess is given here. So straight away I'm going to apply this 3% on the dividend, the tax on dividend and surcharge. Calculate the cost of preference share capital. Redeemable or irredeemable? Redeemable. Fresh issue or existing instrument? Fresh issue. Can I start with this? In this sum, they have given 2 new points. I'll tell you. Illustration number 10 it is. Cost of redeemable preference share capital, KP, is equal to formula. You need to tell me. PD into 1 plus DT, dividend tax is required, right? Plus RV minus NP by N whole divided by RV plus NP divided by 2. Except dividend tax, we are going to define all the terms. At the end, I am going to define dividend tax. That's a different one, right or wrong? Where PD is equal to preference dividend. That is simply 100 into preference dividend rate. Face value 100, preference dividend rate, please. Rate of preference dividend. I'm asking you people. 12% is 12 rupees preference dividend, right? Hello. Let's handle this dividend tax also. That's not an issue. Can I start with that? Hello. dt is equal to dividend tax, that is equal to dividend tax plus surcharge plus education cess, right or wrong? Dividend tax means 12 into dividend tax rate. Look at the rate. The main dividend tax rate is 12.5%. Basic, right? Hello. Oh yeah, tax on dividend itself is 12.5%. The dividend amount is how much? 12. 12 into 12.5%. How to apply? Oh, amount they have given, huh? Yeah, 10 only solving. Then we'll do, yeah, amount we need not do it, right? Actually, the rate we need to calculate it, right? Yeah, let's do this. Dividend tax is 12.5%, right? Then write like this. 12.5% is 0.125 plus surcharge means 0.125 on dividend tax. How to apply surcharge? Surcharge rate please, into 2.5%. Apply 2.5% on 0.125. Then you'll get one number. Tell me. Into 2.5%. 0.125 into 2.5%. You are going to get 0.003125. 0.003125, right? So I'm going to write it here. 0.125 plus 0.003125 into the particular education cess rate, please, into 3%. I told you already, education cess should be applied on dividend tax plus surcharge rate. Is that clear? Apply on both of these numbers. Now 0.125 plus that particular 0.125 into 2.5%, you told me, plus 0.003125 plus 0.125 plus 0.003125 0.003125 into 3%. It will be double. No, total value, not total value, last value 0.00384375, right? Yeah, let me do it then. 0.125 plus 0.003125 into 3%. I got 0.00384375. Now add all these numbers and tell me. 0.00384375 plus 0.003125 plus 0.125. I got 0.1319, right? 0.131968. They have taken 0.1319. That's it. That's what I'm going to take. 0.1319 or 13.19%. This is my final dividend tax, including surcharge and education cess. So what we have done, we have written what dividend tax that was given, and we have calculated surcharge on the dividend tax rate. Then ultimately education cess should be applied on the total of what dividend tax and surcharge. That's why 0.125 plus this number, I got it as 0.125 plus this number. 0.125 is this one, right? Plus this number is nothing but 0.003125. On the total I have applied what? 3%. That's what my education says. So after adding all the numbers, I got 13.19% or 0.1319. This is my dt. Now let's solve this question continuously. So we have defined dt. Now let's go for redemption value. RV is equal to redemption value. See, they said redemption value is 20% on face value, right? 100 into 120%. 120 rupees it is, right? Next, after redemption value, net process, they said what? Any issue expenses? No. Face value, face value is 100. Yeah, I have to deduct that. Premium is how much percentage? You should be very careful here. 110. This is my issue price, right? Now underwriting commission is given as a percentage. How much percentage? Usually when an underwriting commission or flotation cost is expressed as a percentage, you have to apply such percentage like this: face value or issue price, whichever is higher. Is that clear? Whichever is higher. Whichever is higher. Is that clear? So it will be always be on issue price most of the cases. In case of discount, it should be applied on face value. At the rate 5%. Now tell me, 100 face value, 110 issue price. Whichever is higher. Which one is higher? 110, right? Means 100 in 110 into 5%. Apply it. 5.5. Then 104.5 is my net profits, right? Yes. Now N is equal to life of preference shares. How many years? 5 years. Now I am eligible to calculate cost of preference share capital, right? Then KP is equal to preference dividend amount. Already we have calculated that. How much that is? 12.5 rupees. Huh? No, 12 rupees it is. PD 12 rupees into 1 plus dividend tax. Just now we arrived 0.1319 plus redemption value 120 minus net proceeds 104.5 whole divided by 5 whole divided by 120 plus 104.5. Yes, please. Answer. 0.14862, right? Or 14.86%. Is it the answer? This is my cost of preference shares when dividend tax is applicable. Okay. In the next session, we'll handle the remaining problems. Thank you. Yes, I'm continuing the session. Now, please go for the next problem. Illustration number 11. That is covering irredeemable preference shares. Can I read the question? Siemens Limited issues 10% irredeemable preference shares of 100 rupees each for 10 lakhs. What will be the cost of preference shares? Preference share capital KP. If preference shares are issued at par, at 10% premium and at 10% discount. Assume that there is no dividend distribution tax. No dividend distribution tax is applicable here. Let's handle this sum so easily, comfortably. Illustration number. Cost of irredeemable preference share capital in case of fresh issue. Formula for KP? Preference dividend divided by net profits, right? Where PD is equal to preference dividend that is equal to 100 into preference dividend rate. It is 10 rupees, right? NP net profits. Any information regarding, the first case, first of all, what is the first case? when preference shares are issued at par. First point. Yes. Now, any issue expenses? No. Face value or issue price, both are same, right? Or net process, all are same, because there are no issue expenses. Am I right or wrong? 100 only. Then KP is equal to PD, 10 by 100. It is 10% only, right or wrong? Second case, when preference shares were issued at, yeah, 10% premium. Am I right? KP is equal to, yeah, wait, not KP. NP, net profits. Face value, please. 100 it is. Add 10% premium. 10. Issue price will be 110, right? Minus issue expenses. You know, issue expenses means issue price becomes net profits. Am I right? Then KP is equal to 10 divided by 110. 9.09 percentage. Third one. If preference shares were issued at, then preference shares were issued at discount. Issued at 10% discount, right? NP, net process, I have to calculate. Face value. Less 10% discount. 90 as your net process or issue price, both. 90, 98 I have written, okay. Both are same, right? Now KP is equal to 10 by 90, 0.1111, 11.11 percentage. With this we have completed illustration number 11. Hope you have done this. Page number, yeah, 11. 11 is over. Now let's go for the next concept called fair value or equilibrium price of an asset. The discussion is regarding fair value or equilibrium price of an asset. This is also known as theoretical value. Fair value or equilibrium price or theoretical value. See, my dear students, if you want to calculate value of any asset, there are so many ways to calculate valuation of any asset. But basically one of the method that we usually apply is discounted cash flows method. What's that? Discounted cash flows method. So for calculating value of any share, debenture, bond, preference share, buildings, business valuation, I can apply discounted valuation method. Okay, discounted cash flow method. So under this method, for calculating the value of any asset, usually we need two components. One is future cash inflows. I need what? Future cash inflows. Second one is investors' expected rate of return. Got it? But this is nothing but the discount rate. The investor's expected rate of return becomes the discount rate usually. So estimate the asset's future cash inflows for its life and then discount such future cash inflows at investor's expected rate of return. Nothing but if an investor wants some return, such expected rate of return should be used as discount rate for calculating the value of an asset. In simple words, it is the present value of future cash inflows discounted at investors' expected rate of return. What's that? Tell me. It is the present value of future cash inflows discounted at investors' expected rate of return. Means first you should define the future cash inflows related to the asset that you want to value and then know your expected rate of return. How much return you are expecting? Basically the expected rate of return of every investor depends on the risk they are trying to assume. It is purely based on the risk of the asset that we are valuing actually. So if the risk of the asset is very high, then usually the investors will expect more return. If the risk of the asset is low, they'll expect least return. Now our discussion is not on risk and risk-based return and all. The discussion is purely on how to value the asset. That's it. Because this investor's expected rate of return, for this expectation, we have a chapter called Portfolio Management at CMA Final Level SFM. How much return you should expect for a given level of risk for a specific asset. That will be evaluated separately under the chapter PFM, Portfolio Management, under at CMA Final Level SFM subject. Okay. The discussion is regarding what? Valuation of an asset. So if you want to calculate value of any asset, first define the future cash inflows and discount it at investors' expected rate of return. For example, let us take this building. See, for this building there should be a value, right? The building that now we are now we are taking this building for valuation. If you take this building for valuation, right now we are living. First of all, this building value is not the construction value, remember that. That construction value is the cost and then that has been depreciated also for few years and now you can have book value of this building in owner's balance sheet. Under owner's balance sheet, if you look at the balance sheet of the owner, you can see the book value after reducing depreciation. That is not the value actually. There should be some value for this building which is known as fair value. The value of the building I'm excluding from the value of the building, I'm going to exclude land value. That is based on market conditions. I want to calculate the value of the building only, not the land. Okay. Now, if you want to calculate the value of the building, then first you should estimate how many years this building life is, the balance life. Let us say this building can run for next 50 years. Hello. Since it's a new building, let us expect 50 more years life for this building. What cash inflows this particular building can derive to the owner? I'm asking you. The owner can derive rental cash inflows from this building, right or wrong? Let us say from this building, monthly, if he is receiving around 5 lakhs rental income, how much rental income he is receiving? 5 lakhs rental income. Then such 5 lakh rental income, monthly rental income should be multiplied with 12 months, 60 lakhs per annum. So annually this owner is receiving 60 lakhs rental income. For the next 50 years he is going to receive that. Am I right? 50 into 60 lakhs, multiply that. 50 years into 60 lakhs. Let us assume that there are no appreciations and all. I am not taking any appreciation because already I have taken more life for this building. How much? Is that 300 crores or look at the number? 60 lakhs into 50 years. Lakhs. 60 lakhs into 50 years. It will be 3000. 3000 lakhs means 30 crores. Not 300 crores. No, away. How could you arrive that number? 300 crores for a building. If you, how you can't assign that much value for this building, right? 300 crores. What you're saying? 30 crores. Not today's value, future's value. So for getting value of this building today, I should also cover some expected return, compensation. So discount such future rental cash inflows with what? Investors' expected rate of return. So somebody wants to buy this building, he should have some expected rate of return, say 12% per annum. 12% per annum. Usually from a building, people should expect 6% to 10% only, not much more. 12% return is expecting. So the future rental cash inflows should be discounted at what rate? 12%. Hello. The discount rate is 12%. 50 years cash inflows are equal here. 60 lakhs per annum equal. Annuity we can use. Multiply 60 lakhs with annuity factor for 50 years. Then you'll get present value of this building. Are you getting? Let us say for a 30 crores future cash inflows totally, if I discount it, I might get some value. Let us say I got 15 crores. So don't calculate it, you will get some other value. I'm just taking this number for consideration only. How much you got it? 15 crore. The value of the building, the fair value of the building today is 15 crore. If at all, if you want to buy this building, the maximum price you can offer for this building is 15 crores only, not more than that. Are you getting? And even if the owner wants to sell it, generally he'll start with 15 crore only. Sometimes he can offer, he will expect much more also. He can expect 20 or 30 crores also. It depends for negotiation purpose. So ultimately you should accept one thing: for calculating the value of the asset, I am discounting the future cash inflows related to this building at what rate of return? Investors' expected rate of return. So that is what the fair value or the equilibrium price or what? Theoretical value. If at all, if you want to buy this building, the maximum price you can offer is 15 crores only. If the owner says, sir, I am ready to sell this building for 20 crores, the price he is offering is 20 crores. No, I won't buy. Already I fixed. It is the maximum price is 15 crores only. If at all, if the owner is ready to sell this building for 10 crore, you can buy. Why? Because you are ready to pay 15 crore, whereas the owner is offering the same building for 10 crores only. You can buy it, right or wrong? In the similar way, you can calculate the value of shares, preference shares, debentures, bonds and all. See what cash inflows you can derive from a bond or a debenture in future. For example, if you are talking about debenture, redeemable debenture, for the next future years, say 10 years, you can get interest cash inflows, and also on redemption you will get your principal back, right or wrong? These cash inflows should be discounted at your expected interest rate today to get the value of the debenture. Are you getting, dear students? So to calculate the value of the debenture, to calculate the value of the bond, see, these are all financial assets. Do you know that? See, if building, land and all real assets, those are real assets, then the financial assets are equity shares, debentures, preference shares, bonds. All these are what? Financial assets held by investors. Financial. See, all these are liabilities to the company, assets to the owners. Right or wrong? So these financial assets should be valued. For valuing bonds, I should discount the future cash flows associated with the bonds. What kind of cash flows I can generate from a bond? If it is a redeemable bond, every year I'll get interest. On redemption, I'll get redemption value. If at all, if the company is offering me the principal component on yearly basis in installments, then I'll get interest plus principal as my cash inflow. Am I right or wrong? Those cash flows should be discounted at your expected interest rate today. How much return you are expecting from this bond? Use that rate as a discount rate and discount such cash flows. Then you'll get value of the bond. Discounting the future cash flows of the bond today at the investor's expected interest rate gives you what? Value of the bond. I want to calculate value of debenture. Ask them whether it is redeemable or irredeemable. If it is redeemable, how many years? 10 years. How many years cash flows you can get? 10 years interest cash flows. 10th year ending, you'll get redemption value. Being an investor, you are going to receive 10 years interest cash flows, 10th year ending redemption value. Discount such cash flows at your expected rate of interest. Say 10% or 12% or 14% or 15%. Discount it. Then you'll get value of the debenture today. That is what fair value of the debenture. Are you getting? If you are buying an equity share, what kind of cash inflows you can generate? Dividends. Such dividends should be generated for how many years? Indefinite period. Because if you buy the equity share, you're being the owner of the company, you're going to hold that share forever. That's what the objective, right or wrong? How many years dividends you can generate? Indefinite period. Such dividends should be discounted at your expected rate of return called KE to arrive the value of the share today. Are you getting? Like that you can calculate value of preference share also, redeemable or irredeemable. So ultimately, for calculating value of any asset or financial asset, define the future cash flows, know your expected rate of return, discount it, get the value. That value is known as what? Fair value. Is that clear? With the help of this background, let us handle one problem. Go with illustration number 7. Can I read it? Students, X Limited is proposing to sell a 5 years bond of 10,000 at 10% rate of interest per annum. The company is going to sell 5 years bond, face value 10,000, interest at 10% per annum. The bond amount will be amortized equally over its life. Amortization means they are going to repay the principal equally over its life. 10,000 principal, 5 years life, 10,000 by 5 per year. How much they are going to repay us? 2,000 principal repayment annual installment payment from the company. If you are the bond holder of this bond, then you are going to get your principal component back as a cash inflow. Yearly 2,000 rupees you are going to receive. Is that clear? What is the bond's present value for an investor? If he expects a minimum rate of return of 6%, have you observed one thing? The investor is expecting how much return from this bond? The investor is expecting how much return from this bond? 6%. It is a discount rate, right or wrong? This is what investors expected rate of return. Use this rate as a discount rate and discount the future cash flows at this 6% rate to get what? Value of the bond. Now, being a bond holder, what kind of cash flows you are going to receive for the next 5 years? Tell me, please enlighten me, dear students. What kind of cash flows you are going to get? You're the bond holder. Annually, you'll receive what? Interest. Along with that, the company is repaying principal also. How much yearly? 2,000. 2,000 principal plus interest cash flows on reducing balance. Total is your cash inflow. Discount such 5 years cash flows for 6% at 6% and get the value of the bond. That's what? Fair value of the bond. We can use value of the bond simply. Is that clear? Shall we calculate value of the bond today? Illustration number 7. Yes. Calculation of value of the bond. That is purely dependent on the cash flows. Here, bonds, Simply bonds outstanding at the beginning of the year. On this amount only you are going to get what? Interest. Installment, or else you can write interest at the rate 10%. Installment, total cash inflow. This is your cash inflow you can receive, right? Total cash flow. Present value factor, what rate of return you are expecting? 6%. Present value of cash flows. Got it? How many years? 1, 2, 3, 4 and 5. Total principal of the bond is 10,000. Am I right? Yes, 10,000 is the first principal value that is outstanding at the beginning of the first year. Then 2,000 is an installment for first year, because 10,000 divided by 5 per year 2,000. Am I right? Principal outstanding at the beginning of second year is 8,000. Hello? 8,000. Then 2,000 is your installment for second year. 6,000 and again 2,000 installment. Am I right? Fourth year it is 4,000 outstanding. 2,000 installment for fourth year ending. Then fifth year beginning the principal outstanding is 2,000. Again by the end of second year you will get a principal amount back as 2,000. What do you say? Now calculate interest on the outstanding balance at the beginning of each year. Say at the beginning of first year 10,000 is outstanding. Throughout the year you will get interest on 10,000. How much that is? 10,000 it is, right? Hello? For second year, since already you got 2,000 rupees as your principal repayment back, so don't expect interest on 10,000. Expect interest on 8,000. 8,000 into 10%, 800, 600, 400, 200. Am I right? Get the cash flows. 3,000, 3,000, wait. 3,000, 2,800, 2,600, 2,400, 2,200. Now discount these cash flows at 6%. Tell me the present value factors here. At 6%, calculate it and tell me. 0.943, 890, 840, 0.792, 0.747. Now multiply these numbers and tell me the values. 3,000 into 0.943. 2829, 2492, 2184, 1,900, 1,643. Total 11,048. That is that the value? That's not an issue at all. 30-20 rupees difference also, that's acceptable because of decimals. 11,050. This is your approximate value, right? With this we have completed illustration number 7. Please copy this. Yeah. Okay, I'm moving to the next source cost called cost of equity. Can I go for that? Students, focus. Estimating cost of debentures, cost of preference share capital is it is an easy task. Why? Because that is regarding the estimation of fixed future. But when it comes to cost of equity, it is purely about estimating the variable future. It is not so easy to estimate the variable future. So because of that reason, cost of equity computation requires lot of attention, and it's a cumbersome work, a difficult task it is. So that's why there are so many methods were developed to estimate the cost of equity KE. Is that clear? So those methods we need to understand. Let me write it. First approach, dividend by price approach. Second one, earnings by price approach. Third one, dividend by price plus growth approach. Fourth one, earnings by price plus growth approach. Fifth one, realized yield approach. Realized yield approach. Sixth one, capital asset pricing model. CAPM. Is that clear? So these are the approaches we need to understand. Dividend by price approach, earnings by price approach, dividend by price plus growth approach, earnings by price plus growth approach, realized yield approach, capital asset pricing model. See, under these approaches, out of these approaches, the most famous and very important approach is dividend by price plus growth approach. 5-star method it is. So important. Everywhere you can see until the completion of CMA final, either CA or CMA final, till the completion of that course, you can see this formula, dividend by price plus growth approach. Everywhere you can see. Everywhere you can see. And next one is, the world is following it, capital asset pricing model. Right now the stock markets are valued based on CAPM only. Such a big approach and famous approach. Still people are following CAPM only. I'll say this is 10-star approach, seriously. Risk based approach it is. Okay, so important. So these two approaches you should remember. Always keep it in mind and look at these formulas very importantly before going forward examination for calculating cost of equity. Hope you got it. Now let's start with the first one, dividend by price approach. Under dividend by price approach, the investor's expectation is always constant dividends for indefinite period. See, what is your expectation being an equity shareholder today after investing money at current market price MP0? You will usually expect every year dividend, right or wrong? Under this approach, the DPS is always constant every year. It will never grow. Forever the investor will receive this dividend per share. Growth is not applicable under this approach. So how to calculate this, sir? Simple. Here also I am going to calculate cost of equity under two situations, in case of fresh issue and in case of existing instrument. Hope you are understanding it. For fresh issue, cost of equity KE is equal to formula DPS divided by NP, net profits, where DPS is equal to expected dividend per share. NP is equal to net profits on issue of equity shares. Okay. Same format is applicable even for equity shares. Net profits computation. Now tell me, in case of fresh issue, what is the formula for cost of equity KE? DPS by NP. Same formulas. Instead of taking I into 1 minus T or preference dividend, I am taking what? Dividend per share. But that is constant. Growth is not applicable. Forever, for indefinite period, you are going to receive this dividend per share only. That's the assumption of this theory. In case of existing instrument, you can guess the formula. Yeah, instead of net process, I am going to use market price. Am I right? Cost of preference share capital KP is equal to formula. Sorry. It is an overflow. Sorry. Cost of equity KE is equal to formula. Same formula. Instead of writing DPS, instead of writing net process, you have to write MP naught. Give a notation P naught. That is more important for equity share, because equity share will grow from one year to another year. That is not applicable for debentures and preference shares. Always it revolves around face value only. I told you one sentence, you ignored it now. I know. The market price of equity share will grow. It will grow from year after year. If your face value is 10, you can say market price is 1000 also. But when it comes to the price of debentures and preference shares, it revolves around face value only. For example, last year if the market price of the debenture is 105 or 110, this year it can be 95. Next year it can be 100, or after that year it can be 102. After 10 years it can be 90, or otherwise 110 or 105 only. It never goes to 210, 2000, 1500 like that. Okay. It will be near to face value only for debentures and preference shares. Remember that. That is applicable only for debentures and preference shares, because they are not retaining any profits that belongs to them in the company. Their profits will never grow. They will always get fixed amount only. Right or wrong? But when it comes to equity shares, since they are the owners of the company, their profits are retained by the company for future growth. Always their share price will grow. Is that clear? So here I need to define the terms where DPS is equal to expected dividend per share. NP is already, we have defined NP, right? Yeah, you don't need to define this dividend per share. I just need to define what MP naught, where MP naught is equal to current market price per share. Is that clear? Yes. With this we understood the first approach called dividend by price approach. Let me go for next approach, that is earnings by price approach. Under this approach, instead of expecting dividend per share, investors will expect earnings per share. Their focus is on EPS. Just substitute the term DPS with EPS. That's it. Nothing new here. And these earnings will never grow. That is another assumption under this theory. EPS is always constant up to indefinite period. In case of fresh issue, guess the formula? Cost of equity KE is equal to EPS divided by net profits usually. Is that clear? In case of existing instruments, substitute substitute market price in place of what? NP. Cost of equity KE is equal to formula EPS by, guess the formula, MP naught. I just need to define only one term. What's that? EPS. Expected earnings per share. That's it. Nothing great there. So what is the difference between previous theory and this theory? Previous theory considers dividend per share. This theory considers earnings per share. Some investors can expect profits only, exclusively. Okay. where EPS is equal to expected earnings per share. Is that clear? With this, we have completed earnings by price approach. Now, this approach is so important. Let's start with this. What is the approach? Dividend by price plus growth approach. Under this approach, the dividends will grow forever up to indefinite period. Forever, for indefinite period, it will grow indefinitely. Under this approach, the dividends will follow constant growth rate. Means if I get 10 rupees dividend for the last year, for the next year, I'll get more than 10 rupees dividend. Say, for example, if the growth rate applicable to the dividend is 10%, for 10 rupees last year dividend, please add 10%. 10 plus 10 into 10%, I'll get 11 rupees dividend in the next year. Afterwards, the dividends will grow on compounding basis. For the second year, the dividend will be 11 plus 11 into 10%. I'll get 12.1 rupee. Is that clear? Like this, the dividends will grow from year after year on compounding basis by following the constant growth rate. When the dividends are growing on constant growth rate basis, then the cost of equity formula will change. Let me show you. Here also, under two cases we have to solve. In case of fresh issue, and in case of existing instrument. Formula: cost of equity KE is equal to DPS 1 divided by net proceeds plus growth for fresh issue. In case of existing instrument, it is cost of equity KE is equal to DPS 1 divided by MP naught plus G. Is that clear? MP naught plus G. Cost of equity KE is equal to DPS 1 divided by MP naught plus G. For fresh issue, it is NP. For existing instrument, it is MP naught. Additionally, we are adding one term called growth rate because of growing dividends for indefinite period, right? Let me define one by one the terms. All the terms you know, I just need to define DPS 1 only, right or wrong? Where DPS 1 is equal to, usually, for example, the last year dividend is 10, don't write along with me, look at this. And next year dividend will be, it should be added with growth rate, right? 10% growth rate. I'll get 11. See here, this 10 rupees is known as last year dividend DPS naught. Again, this 10 rupees is DPS naught last year dividend, and this 10% is G. Take the common term out of it, I'll get DPS naught into 1 plus G. This is the formula for DPS 1. Is that clear? Tell me, what is the formula for DPS 1? DPS naught into 1 plus G. Power 1 means, you don't need to write power 1. Okay. Now, this is technically known as, the terminology says, expected dividend per share. Expected dividend per share at the end of year 1. At the end of year 1. What is the formula for DPS 1? Expected dividend per share at the end of year 1. Tell me the formula: DPS naught into 1 plus G. Expected dividend per share at the end of the year 1 means the dividend that you are expecting for year 1, first year ending. Okay, next year dividend, it is simply. And MP naught, you know, G, you know, right? But for G, I need to tell you, yeah, I need to write the growth rate also. G is equal to growth rate in dividends, actually it is. Okay. This is generally be the multiplication of two factors, B into R. B into R. What is B? I'll show you. B means retention ratio. Do you know the formula for retention ratio? 1 minus dividend payout ratio. R is rate of return. This is IRR, I can say. The rate of return I can earn from my investment. Tell me what is the formula for growth rate G? B into R. B means retention ratio. If you know the dividend payout ratio, you can easily calculate retention ratio. For example, if my EPS is 10 and dividend per share is 4, then retention will be 6. Am I right? Now, dear students, out of 10, 4 rupees is the dividend payout, right or wrong? It is 40%. Out of 10, 6 rupees is retention. It is 60%. Am I right? I can define the formula like this. Dividend payout ratio is equal to first you should calculate dividend payout ratio. From that only you can calculate retention ratio. Okay. It is simply DPS by EPS. 4 by 10. Right or wrong? If you know the dividend payout ratio, then you can calculate retention ratio. 1 minus dividend payout ratio. Retention ratio is equal to 1 minus, see here, it is 4 divided by 6, 4 divided by 10, I can say 0.40, 40%, right or wrong? For getting retention ratio, simply deduct 0.4 from the 1. 1 minus dividend payout ratio. That is 1 minus 0.4. I'll get what? 0.6 only, right or wrong? This retention ratio should be multiplied with rate of return to get what? Growth rate. Is that clear? This is my G. Now, with this we have completed dividend by price plus growth approach. But usually they don't give you dividend directly. Hello students. They'll give you dividend like this. Dividend just paid. Dividend just payable. Dividend last paid. Last year dividend. If they gave like if they gave like this, if they've given like this, then consider these terms as DPS naught. Last year dividend it is. Instead of that, if they give dividend like this, expected dividend per share for the next year. Expected dividend per share for the current year. In any way they can give you expected. Whenever you see expected, immediately consider that dividend per share as DPS1. Next year, current year, it doesn't matter. If you see expected, it is DPS1. Got it? Yes, yes, you want to write it, huh? Yeah. See, this earnings by price plus growth approach was not there for CMA actually. Okay. So you don't need to learn about this. I'm not covering this. What's that? Fourth one. Fourth one you can leave literally. Okay. Realized yield approach. Let's understand this later. Even CAPLess pricing model also. Realized yield approach. There are no formulas for realized yield approach. We have to calculate that only during the sum only I can explain that realized yield approach. Capital asset pricing model, we need some attention that should be understood separately. Before that, I want to give you few more formulas, two formulas, simple formulas. Actually, you know what is this retention ratio? Yeah, and also that retention ratio can also be written like this. It can also be written like this. Retention ratio is equal to how much profit you are retaining. That's what retention ratio, right? You can say profit after tax minus preference dividend minus equity dividend. This is what your retention, right or wrong? That is to be divided with profit after tax minus preference dividend. Simply earnings for equity. I can say this is earnings for equity. Okay. You please write earnings for equity. Or in our words, EAESH. Okay. Or EAESH. This is the formula for what? Retention ratio. Means profit after deducting preference dividend, after deducting equity dividend, whatever the profit, that should be the retention, retained profits, should be divided with the profit which is available to equity shareholders. This is retention ratio. And R, rate of return, I told you, R is equal to rate of return. That rate of return can be calculated like this, nothing but return on equity, that is return on equity only. Earnings available to equity shareholders divided by book value of equity. What is this? Book value of equity. Earnings available to equity shareholders, you know how to calculate that. I don't need to tell you. But book value of equity means what, sir? It is simple. Book value of equity means it is the face value of equity share capital plus reserves and surplus. That's it. Are you getting? That's what book value of equity. This is book value of equity. Is that clear? R is rate of return, earnings available to equity shareholders divided by book value of equity. So this is regarding the terms applicable for calculating growth rate actually. So in the next session, we'll cover the remaining formulas and all. Thank you. Good evening all of you dear students. One important concept we need to cover is capital asset pricing model. What's that? Listen. Yes. See. Okay. First of all, in the initial part of the theory, I'm going to give you the formula for capital asset pricing model and terms in it. And then once that is over, then we'll go for the theory. Can I start with that? CAPM is purely, it is based on risk-based approach actually. It is being developed based on risk-based approach. Actually, you don't need to estimate the future expected dividends here for calculating the cost of equity KE. But this approach is developed based on what? The risk which is being accepted and taken and assumed by the investors. That's what CAPM actually. So it is a risk based approach for calculating cost of equity KE. Now under this approach we have a formula for cost of equity KE. I am not talking about the theory and all, just writing the formula and terms in that. Once that is over, I'll go for the theory, what is the background of this theory and how it came and all. Okay, under cost capital asset pricing model, cost of equity KE is equal to, it is simply RF plus beta into RM minus RF. Okay, where RF is risk free rate of return. This is risk free rate of return. Beta is equal to, it's a systematic risk factor, actually it is systematic risk, it's a multiplier, changes from one company to another company. RM is equal to return on market portfolio. This is also known as return on market portfolio, also known as average market return. Average market return it is. Okay, return on market portfolio or average market return it is. RM minus RF is equal to market risk premium. This is market risk premium. Also known as average market risk premium. Sometimes I can give you like this, average market risk premium. Is that clear? Average market risk premium. These are the terms needed to calculate cost of equity KE. Now let's talk about the theory. Please tell me what is the formula for cost of equity KE? RF plus beta into RM minus RF, where RF is equal to risk free rate of return, beta is systematic risk factor, that is a multiplier, RM is return on market portfolio or average market return, RM minus RF is market risk premium or average market risk premium. Is that clear? Yes. Now this formula is needed to handle the problems, nothing else. If you can read the formulas and if you can define the formulas, that's more than enough. Now I'm going to talk about the theory and all, the background. See, basically for calculating the value of the asset, I told you we need two components. One is the future cash flows, other one is what? Investors expected rate of return. Usually you can expect one kind of return, I can expect one kind of return, the other person can expect another return. People will expect the expected return based on their perception. It changes from one investor to another investor. Am I right or wrong? But we need some uniformity for expected rate of return. Basically, if I expect 20%, if you expect 80%, there is a lot of deviation between both of us, right or wrong? Then in that case, it creates lot of inconsistencies, inequilibrium situations, huge price fluctuations in the stock market while buying the assets and selling the assets. For creating some balance, some theories were developed based on risk, Means basically being an investor, whenever you're buying any asset, you will expect some return that is based on the risk of the asset, the risk of the asset that is being valued, that is being considered for buying or selling. Are you getting? So the risk of the asset is based on the future cash flows. If there are more cash flows deviation, then there will be more risk. Then accordingly, I'll expect the return. Am I right or wrong? So this particular risk factor decides the rate of return, the expected rate of return. So the risk, the expected rate of return in turn depends on what? The risk of the asset. Now, this risk for a given level of risk, how much return I should expect? That's the discussion. Such return should be defined systematically under different theories. Actually, under different theories, such return was systematically developed. In late 1950s, so past 1950s and the early 1950s, there was a greatest economist who started this process, Markowitz. In 1950s, he developed one theory, but that is a successful theory, but unable to implement in the market because of so many impracticable points in that theory. Though that's theoretically a strong theory, but practically it is difficult to implement. Later on, Tobin extended the theory, but still there are that theory is with some limitations. And in the year 1960 to 1970, one theory was developed by 4 people at a time: Sharp, Lindner, Triner, and Mawson. 4 people at a time they developed this theory called capital asset pricing model. They came up with this theory in their own way, and they published it in the newspaper. And see, they've given the theory in a different way, but predominantly what they're saying is same. Because of that reason, for them, the Nobel Prizes have been given for all of them. Because they developed this theory called capital asset pricing model. What they have developed, that's what we need to understand. Is that clear? Basically, whenever you are expecting return, that is loaded with risk. Risk means what? If I expect 20%, I may get 30 or I may get 10. I may get 50 or I may get nothing. Deviation from my expectation. Am I right or wrong? Such risk is classified into 2 parts. For this risk only, people will expect premium usually. But this risk is classified into 2 parts: systematic risk and unsystematic risk. What's that? And unsystematic risk. What is systematic risk and what is unsystematic risk? Say, for example, if I invest my money in Infosys, I'll get Infosys return only. Am I right? If I invest my money in Infosys as well as in TCS, then I'm diversifying my money. Right or wrong? When I'm diversifying my money, automatically my investment will reduce some amount of risk. Why? Because if at all, if I get any loss from Infosys, that can be compensated by profit from TCS. So there is a famous analogy: do not put all eggs in one basket. So like that, do not put all amount in one company shares only. You have to face huge amount of risk. If that company fails, your money will be wiped out. What do you say? So for that reason, invest your money in different company shares for better diversification. So if you get huge profits from one company, that can be compensated by huge losses in another company, so that your expected mean return can be stable. Is that clear? So by that, you can reduce your risk. So one can reduce risk by putting their money in different company shares. So that is what the combination of securities. So if you are holding more than one company shares, TCS, Wipro, Axis Bank, HDFC, like that, Tata Steel, like that, if you are holding so many company shares in your hand, your box is loaded with so many investments, which is known as a portfolio. Which is known as what? A portfolio. Portfolio means a group of securities. This portfolio can reduce risk. But to what extent, sir? No. If I invest my money in all the sectors in India, including gold, still I exposed to some amount of risk. Why? Because sometimes the entire market can be crashed. All the company shares can fall down. Example, US declared war on our country. Suddenly if US declares war, it is so difficult to win, right or wrong? Then in that case what will happen? Every company's profits will fall down. People are not willing to buy any product or not willing to take any service because of what? Death fear. Then all companies profits drastically will fall down and market will crash down. So in that case, if you have invested 1000 crores in all the company shares, it automatically went down to 100 crores or even 10 crores also. What do you say? What do you say? So you can't escape from that risk. Just because you're putting your money in all the company shares, you can't escape from that risk. That's a country specific risk, right or wrong? Not company specific. So in that case, some factors will influence all the company shares, including your portfolio, though you have invested your money in all the company shares, called systematic risk factors. Like example, foreign currency rate fluctuations, you can't escape from that. Is that clear? GDP fluctuations, you can't escape from that. Interest rate fluctuations in the country, you can't escape from that. You have to face it. You should borrow money at higher rate if at all RBI is are charging higher rate of interest from all the borrowers. What do you say? Higher interest rates, foreign currency rate fluctuations, government tax policies. Suddenly government raised the GST rates. Recently it reduced the GST rates. If at all, if it raises GST rates, it impacts all products and services in India. You can't escape from that. These are all macroeconomic factors which will affect almost all every company in India. So I can reduce my risk to some extent, but not fully. That's why the component of risk that can be avoided by putting all your money in different securities, by forming a portfolio, I can reduce some extent of risk which is known as unsystematic risk. This can be eliminated fully. This unsystematic risk can be eliminated fully. It is company specific. If I have one risk with one company, that can be compensated by investing my money in another company also. But some portion of risk cannot be avoided, which is known as systematic risk. This is unavoidable risk. Unavoidable risk it is. Unavoidable risk. And this unsystematic risk can be avoided through diversification. Means by putting your money in different company securities. Diversification means what? Spreading my money all over the companies so that I can reduce my risk. This risk can be reduced to zero also. That's why this is known as diversifiable risk. What's that? Diversifiable risk. Because through diversification I can reduce this. I can reduce this through diversification. That's why this is diversifiable risk. And as per your understanding, this is avoidable risk. Okay. This is avoidable through what? Diversification. Even if you go for diversification, which the risk that cannot be avoided is non-diversifiable risk, which is known as systematic risk. This is non-diversifiable risk. Are you getting? Non-diversifiable risk. This Sharp, Lindner, Trenner and Mawson says, if you expect some extra return or premium, if you expect some premium, see usually if I invest my money in Government of India bonds, I'll expect 6% or 7% only. But if I transfer that money to company shares, I'll expect some extra return because I'm facing risk. So if I expect 7% from Government of India bonds, I'll expect 20% from Infosys share, means extra 13%. Extra 13%, why I am expecting? Because I am facing risk, I am expecting some such extra return which is known as premium for risk. How much extra premium I am expecting? 13%. That's the premium for risk. What's that? Premium for risk. Such premium for risk should be expected by the investors only for systematic risk. Only for what? Systematic risk. Don't expect premium for unsystematic risk. Expect premium only for systematic risk. Who said this? Funny Sara? No. Sharp, Lindner, Trenner and Mawson. Actually Sharp, you can remember Sharp name, that's more than enough. William Sharp says expect premium only for systematic risk. For such systematic risk, identifies a systematic risk with a term called beta. Beta is a measure of systematic risk. Is that clear? Based on this beta, calculate the premium for your investment. Beta is a measure of systematic risk. Based on this beta, expect premium. That's what Sharp says. Okay. Now let's talk about this formula. How this formula was arrived. I need to explain that. What do you say? So basically, if you want to invest in risk-free investment in the whole world, the famous highly rated risk-free instrument is US Treasury Bill, USA Treasury Bill, United States Treasury Bill. In India, our risk-free investment is Indian Treasury Bill. Is that clear? Indian Treasury Bill is the best example for what? Risk-free investment. No risk at all. This is a risk-free investment. If you expect any return from this asset, that is known as RF. What's that? RF. For example, if you are getting a return of 10%, just for the sake of understanding, I am taking this number. How much return annually you can earn from this risk-free investment? 10%. Now, if you want to move your money from this risk-free investment to Infosys share, to which company you want to move your investment? Infosys. Hello. So you just wanted to move your money to Infosys. Do you expect same 10% rate of return from Infosys? No way. Am I right? I'll expect some premium. That is based on what? Beta. I told you. That beta for Infosys is equal to 2 times. It's a factor. Then how much return you'll expect, sir? 2 into 10, 20%? No. There is a framework for this. Don't do like that. Simply by multiplying beta with risk-free return, you don't get the return that you should expect from Infosys. There is a systematic process, a framework for this. That's what CAPM. Is that clear? So beta is equal to 2. This is the beta of Infosys. This beta differs from one company to another company. For some companies, it can be less than 1. For other companies, it can be more than 1. For few companies, it can be equal to 1. So usually beta is in between more than 1 or less than 1. It cannot be 78 or 82 or like that. Usually it will be around 2 or 2.5 or 1.5 or 0.8 or 0.9 like that only. Okay. So what is this beta? Beta measures the sensitivity relationship between our company's risk with our company's return fluctuations with the market portfolio's returns. What's that? Market portfolio's return. So what is this market portfolio? I'll tell you. I need to compare this with what? Market portfolio. For this market portfolio also, there will be a beta. Usually that beta is equal to 1. So what is this market portfolio? Market portfolio is a group of securities, but those are top-notch securities in the market. In our India, in our country, there are 2 types of stock exchanges which are famous. Bombay Stock Exchange, BSE, and National Stock Exchange, NSE. Am I right or wrong? See, Bombay Stock Exchange is nothing but market. National Stock Exchange is nothing but market. But I can't take all the stocks in those stock exchanges because there will be more than 1000 company shares traded in those stock exchanges. Right or wrong? Let's take the best stocks out of it. Top-notch stocks. Pick up the best stocks. You don't need to pick up it. There was an index which is being developed in the year 1986 and 1995 itself. They are Sensex and Nifty. Do you know that? The Sensex and Nifty are the best stock portfolios showing the index numbers. Those index point fluctuations are representing those company stocks. What are such stocks, sir? See, basically, the Sensex taken top 30 companies from BSE and this Nifty taken top 50 companies from NSE. Is that clear? And developed the index. It started with 100 around. Now it has more than, I mean, these points are in thousands it is. What do you say? Now showing thousands of points. Let's see the index points in the market. Sensex today showing how many points now? 85,706.67. These 85,706.67 points are representing the market value of so many companies. How many companies? Top 30 companies. Look at this. Here it is. 39 years ago, 1986 it was started, right? Showing how many company stocks, sir. Look at this constituents. How many stocks were loaded here? 30. And today the market capitalization is 151.78 lakh crore in Indian rupees. That's the value of market capitalization of how many companies? 30 companies only. Based on this value only the points will move. You know, my dear students, this market cap is the market value of equity of 30 company shares. So 151.78 lakh crore, more than 1 crore, around 1.5 crore. What do you say? If these 30 companies market values are appreciating, suddenly it is 200 lakh crores, then points will move upward. Is that clear? Sensex points will move upward. If these points will fall down, that means this market capitalization is going to fall down like 100 lakh crore around. Is that clear? It's a negative indication. Why? Because when top-notch companies in India are not performing well, the country is not doing well. That's why index points falling down is a wrong sign for Indian economy. Is that clear? They're not producing well, they're not doing well. That's what the indication. That's why always Sensex points will move upward. Either it should be stable. Is that clear? Now my question is, I don't want all this. These top 30 companies are representing Bombay Stock Exchange market. These top 30 companies is simply known as market portfolio for our discussion. Is that clear? See, for all these 30 companies, there will be some return. One company can give you 30% return, the other second company can give you 20% return, other company can give you 50% return. If you take 30 companies average return, that is known as RM, return on market portfolio. RM is average market return, means average return of top 30 companies in India, Bombay Stock Exchange. Is that clear? Hello all of you. There is a process to calculate that RM. I don't want to tell you because that is not our syllabus. I don't want to confuse you. Okay, is that clear? So RM is equal to return on market portfolio or average market return. That is top 30 companies in India. That is nothing but Sensex. Hope you got it. So this RM for this top-notch portfolio, it's a benchmark portfolio. In India, what is the best portfolio? Nifty or Sensex. Is that clear? Sensex top 30 companies. More than that, you can't find any best portfolio. That is the best portfolio in India. Is that clear? That's a benchmark. For example, if this market portfolio is giving 20% return per annum, 20% return per annum means if you invest your money in these 30 companies, you'll get on an average yearly 20% return. 20% return you can earn. Now, are you investing in market portfolio or in Infosys? Infosys you want to invest, right or wrong? Hello all of you. If you want to invest in Infosys, how much return you can expect? First of all, if you move from risk-free investment to market portfolio, how much premium you are expecting? 10 to 20 excess return you are expecting. From the top-notch portfolio you are expecting 20. So in addition to 10% you are expecting 10%. 20 minus 10. Am I right or wrong? Am I right or wrong? That's what market return. That's what that's what market risk premium. What's that? Market risk premium. Is that clear? The market risk premium is RM minus RF. How much premium you are expecting? 20 minus 10. 10%. If you move from risk-free investment to market portfolio. Are you moving from risk-free investment to market portfolio or you are moving from risk-free investment to Infosys? Infosys. What do you say? Infosys is 2. Beta is equal to 2. Market portfolio beta is 1. See, market portfolio beta is always 1. For market portfolio, see that represents systematic risk. My Infosys risk is 2 times of market portfolio's risk. Am I right or wrong? Beta is equal to 2 means what? The Infosys risk is twice the market portfolio's risk. It is 2 times. For market portfolio, the systematic risk is 1 only. Whereas for Infosys, it is 2. Means which security is risky? Is it the Infosys or market portfolio? Infosys. Infosys is risky. Because the beta is equal to 2. More beta, more systematic risk. Less beta, less systematic risk. When beta is more than 1, that means the risk of the Infosys is more than market portfolio. And when beta is less than 1, then the risk of the security is less than risk of the market portfolio. Again repeating. Here beta is equal to 2, which is more than 1 or less than 1? Means the risk of the security is more than the risk of the market portfolio, top market portfolio in India. Is that clear? If beta is equal to 0.8, means what? That company's systematic risk is less than the market portfolio risk, because for market portfolio it is 1. Now for my company it is 0.8. My risk is less. What do you say? Now tell me, your beta is 2 means you are expecting, your risk is twice the risk of market portfolio. Now, if you invest your money in the market portfolio, how much premium you will expect? 10%. But while comparing Infosys with market portfolio, my risk is 1 time or 2 times? 2 times. So, will you expect same 10% premium in addition to 10%, or you will expect more premium? More premium. 2 times premium you will expect. Are you getting? That means this 10% should be multiplied with beta. 2 times premium will expect. Are you getting? So simply, how much return you can expect being a shareholder? See, 10% usually that's my return plus premium. Premium means market is giving me 20 minus 10. Am I right? So for that, you can expect 10% extra premium. Your premium is 10% means you are not expecting better return. See, if you invest your money in the market portfolio, the premium should be 10%. But you are investing in Infosys means you will expect 2 times premium. Why? Because Infosys beta is 2 times of market portfolio's beta. Is that clear? That means it should be multiplied with what? 2. 10% is RF, risk-free rate of return. 2 is beta. 20 is RM, top-notch market portfolio return. Am I right? RF 10 means what? This is market risk premium for your investment in market portfolio. If you multiply this RM minus RF market risk premium with beta, you'll get risk premium of what? Your security that you want to invest. See, my dear students, here I will get how much return? 10 plus 2 into 10. It will be 10 plus 20%. Tell me one thing, how much return I'll get? 30%. Means if you invest your money in Infosys, 10% risk-free return you can earn. In addition to that, you'll get 20% premium for your risk. If you invest your money in market portfolio, how much return you can earn? 10% return you can earn plus 10% premium in the market portfolio. Only 20% you can earn, right or wrong? Why 10% premium only for market portfolio? Because market portfolio's risk is 1 only, whereas my Infosys risk is 2 times. Is that clear? If your beta is 0.8, will you get 10% premium or less than 10% premium? Less than 10% premium. If beta is equal to 0.8, then what will happen? KE is equal to 10 plus 0.8 into the same RM minus RF, 20 minus 10. It will be 10 plus 0.8 into 10 means 10 plus 8%. Earlier I got how much premium? 20% premium. Now I got how much premium? 8% premium. This is less than the market risk premium. Am I right? Why? Because my securities beta is 0.8, which is less than the market portfolio's beta. Less than 1 it is. So less risky portfolio, expect less premium. Is that clear? So this RM minus RF is like benchmark premium. Is that clear? That should be multiplied with beta of your asset that you want to buy. Hope you got it. Now tell me, what is the formula for cost of equity KE under CAPM? RF plus beta into RM minus RF. RF means risk-free rate of return. Examples, Indian Treasury bills, Government of India bonds. These are the best examples of what? Risk-free investments. Indian Treasury bills and Government of India bonds. GOI bonds. Government of India bonds. RBI bonds. RBI bonds. Government of India bonds. Indian Treasury bills. These are the best examples of what? Risk-free investments in India. And beta is systematic risk factor multiplier. Beta differs from one company to another company. It can be more than 1 or less than 1. More than 1 means our company's risk is more than market portfolio's risk. Less than 1 means our company's risk is less than market portfolio's risk. Market portfolio means Sensex top 30 companies. What do you say? Top 30 companies. Yes. Now tell me, if beta is equal to 1, that means my company's risk is equal to market portfolio's risk. Am I right? Which risk I'm talking about? Systematic risk. Unsystematic risk not at all applicable here. Is that clear? Yes. RM means return on market portfolio or average market return. I told you top 30 companies average return is nothing but average market return. Usually they'll give you Sensex, Nifty as a basis for what? Market portfolio. On that Sensex and Nifty they'll give you the return. You have to identify that. Is that clear? And RM minus RF is market risk premium. If at all, if you want to move to market portfolio, if you want to invest money or in the market portfolio, top 30 companies, this is a premium you can earn. Market risk premium means the risk premium that you can earn by investing your money in the market portfolio. Is that clear? And that is known as average market risk premium. Why? Because the return is average, so premium should be average. What do you say? Yes. This is regarding cost of equity KE under CAPM, which is more than enough for us. See, generally, I've explained this. This risk is generally meant by volatility. Volatility means what? Fluctuations. Okay. High volatility means high risk. Low volatility means low risk. No volatility means no risk. Right? With this, we have completed the theory called capital asset pricing model. Say, whatever the theory it is, you have to remember the formula. That is more important. Hope you got it. Yes. So, with the help of this, we have completed capital asset pricing model. In the next session, we'll handle the remaining concepts. Thank you so much. Good afternoon, all of you. Yes. Please look at illustration number 12. We have covered all the concepts. All approaches were covered. Dividend by price approach, dividend by price plus growth approach, earnings by price approach, earnings by price plus growth approach, capital asset pricing model. What do you say? Everything we have covered. Now let us start with the problems. Illustration number 12. Can I read the question? MNC Limited paid dividend per share of 4 rupees. This is last year dividend. And current market price per equity share is 20. Calculate the cost of equity share capital KE. Tell me one thing, students. Actually, this is a clear case of dividend by price only. No growth is given here, right? So, illustration number 12, right? Number 12. The formula for cost of equity KE is, since the growth is not available, the formula is simply DPS by MP naught, right? Hello. Where DPS is equal to expected dividend per share. How much that is? Say in the question itself they have given, right? 4. MP naught is equal to current market price per share. That is 20, right? Now KE is equal to 4 by 20. Tell me the answer. %. No, 20%. Sorry. 20% or 0.2. This is my cost of equity KE. Am I right? So please. With this, we have completed illustration number 12. That's a straight question. Written or not? Yes. Go for illustration number 13. AB Limited issued shares of 100 rupees each at a premium of 10%. Means the issue price is 110, right or wrong? The issue involved underwriting commission of 5%. Okay. Issue expenses. The rate of dividend expected by the shareholders is 12%. Always this percentage should be applied on face value. Determine the cost of equity. Have you seen any growth rate in this problem? No. So this is a clear case of dividend by price approach without growth. What do you say? So illustration number 13. Formula for cost of equity KE under dividend by price approach in case of fresh issue. Cost of equity KE is equal to, it is simply DPS by net proceeds NP, where DPS is equal to expected dividend per share. That is equal to face value of equity share 100 into dividend rate. Yeah, they've given 12%, 12 rupees, right? Net process I need to calculate. Face value is how much? 100, right? Further, they have added some premium. How much premium they've added? How much? 10% of premium they've added. That is 10 rupees. So the issue price will be, so that the issue price will be 110. Now let us deduct the issue expenses from it. Flotation cost, right? Underwriters commission. At the rate 5% on what? Face value or issue price, whichever is higher, that is 110. It will be 5.5, 104.5. This is my net proceeds, right? Now cost of equity KE is equal to, cost of equity KE is equal to, DPS is how much? 12 by 104.5 into 100. Yes, 0.1148. Or 11.48%. Am I right? Next, please. Illustration number 14. So, direct question, illustration number 13, right? I mean, some adjustments, subject to some adjustments. Let's see the 14th question. The earnings available to equity shareholders amounts to 40,000. I can say this is EA, ESH, right? Firm is represented by 10,000 equity shares and the current market price of the equity share is 25. Calculate the cost of equity share capital. Understand one thing here in this problem, they have not given any dividend related information, right? So I can conclude that this is a clear case of earnings by price approach because the growth rate is not given. Illustration number 14. Formula, cost of equity KE is equal to EPS divided by we have market price here, right? How much that is? 25. MP naught, you should write MP naught. EPS is equal to expected earnings per share. You know that the earnings available to equity shareholders is how much? So the formula will be EA ESH divided by number of equity shares. Am I right? So tell me the earnings available to equity shareholders. 40,000 divided by 10,000. This is my EPS, 4 rupees. Am I right? Now calculate, oh, you don't need to calculate MP naught, that was given directly. Current market price per share. Yes, it is. 25. Now you can easily calculate this KE, right? 4 divided by 25. Tell me the percentage. 1667. Am I right, or 0.16 only? Okay, then 0.16 means 16%. 16% is the cost of equity KE. For which problem it is? 14th problem. 14th is over, right? Now go for 15th. This is a different problem. You should be cautious because they are covering dividend tax in this problem. It is going to impact your growth rate. Can I read the question? Yes. Mormon Limited is expected to earn 30 rupees per share. I can say this is expected earnings per share, right? Company follows fixed payout ratio of 40%. This is my dividend payout ratio. How much dividend payout ratio the company is following? 40%. So if you can apply 40% on this 30 rupees, you can get expected dividend per share. Because this is expected earnings per share. On this, if you can apply this payout ratio of 40%, you can get expected earnings per share. What do you say? I can say this is EPS 1. Why? Because that is clearly given as expected earnings per share. Means first year ending. Am I right? If you multiply first year ending earnings per share with payout ratio, I'll get first year ending dividend per share only. That is DPS 1. Am I right or wrong? Find the cost of equity. If dividend tax of 15% is imposed on the distributed earnings, in case if dividend distribution tax is applicable for the dividend payment, then how this cost of equity should be calculated? When under two circumstances they are asking you, current level of dividend amount is maintained, means the same amount of dividend I want to maintain. If you want to maintain the same amount of dividend, how much? 30 into 40%? Yes. If the current level of dividend amount is maintained, you have to calculate cost of equity KE. Current level of dividend means your payout ratio is 40% on 30% earnings per share. So 30 into 40%. So your dividend per share should be maintained at 12 rupees. It should be your dividend per share at the end of first year. If you want to maintain 12 rupees dividend per share at the end of the first year, and thereafter if you want to maintain the same payout ratio, it is going to affect your growth rate. Why? Because I have to pay my dividend tax. I should pay the dividend tax out of the profits. Means it reduces retained earnings. See, my dear students, this dividend tax can be paid either out of either out of retained earnings, or it can be paid out of the dividend itself. Means while distributing the dividend, the dividend tax should be deducted from dividend per share itself. Means you have two options. Either you can pay dividend tax by deducting such dividend tax from the DPS, or you can pay such dividend tax by deducting such dividend tax from the remaining retained earnings. Are you getting? So you have two options. Pay dividend tax out of dividend per share directly. For example, if I am offering 12 rupees dividend, if the dividend tax here is how much percentage? 15%. 12 into 15%, how much? 12 into 15%, how much? 1.8. That 1.8 must be deducted from 12 rupees itself. 12 minus 1.8, how much? 10.2. So that is the amount you are going to pay as dividend to the equity shareholders. Are you getting? What they are trying to ask you is, if the current level of dividend amount is maintained, means you have to pay 12 rupees directly to the equity shareholders. The dividend tax should be appropriated from the retained earnings. If you appropriate dividend tax from the retained earnings, it will increase the existing retained earnings. Then it is going to reduce your growth rate. How it is going to affect your growth rate, I'll show you. Can I start? Illustration number 15 it is, right? Yes. Let's handle this sum. Okay. Point A, when current level of dividends amount is maintained, right? Yeah. If current level of dividends amounts were maintained, right? What is going to happen? First of all, expected EPS 1 is equal to expected earnings per share, expected earnings per share at the end of year 1. That comes to how much money? 30 rupees, right? DPS 1 is equal to expected dividend per share at the end of first year. This is what the dividend you want to maintain. Expected dividend per share at the end of year 1. That is equal to 30 rupees into 40%. If you want to pay 12 rupees dividend to the equity shareholders directly, it should be the net dividend. It must be the net dividend after paying what? Dividend tax. And when, how can you pay dividend tax? Generally this dividend tax should be deducted from 12 rupees only, but you are not deducting this dividend tax from 12 rupees because they want to maintain the same level of dividend, right? Then in that case such dividend tax should be appropriated from the balance retained earnings, which is going to affect your growth rate. I'll show you how it affects growth rate. Dividend tax I should pay, right? Dividend tax is equal to 12 rupees into 15%, am I right? Per amount please. 1.8. Now how it affects your retained earnings? Retained earnings is equal to, you please tell me, existing number of shares outstanding, yeah, expected earnings, how much that is? 30 rupees only given, right? Okay, out of 30, how much you are paying as dividend? 12. How much you are paying as dividend tax? 1.8. Now retained earnings, this is your retained earnings, right? Hello. Yes. Now you know that G is equal to B into R. Do you know that? Yes. Okay. You know the formula for B and R. What does that be? Retention ratio. Formula is what? Profit after tax. I mean, generally here we don't have any preference share capital here. What do you say? So I can say profit after tax minus equity dividend, because we don't have any what? Preference share capital, divided by earnings available to equity shareholders into this rate of return is nothing but, I told you many times, earnings available to equity shareholders divided by book value of equity. But we don't have any book value of equity here. When book value of equity is not available, take the market price per share as a basis. What is your market price per share? 200 is a base. That's my share price. Okay. Profit after tax after paying equity dividend. Just now we got it. That's my retained earnings, right? Hello. I can say I can change this name into retained earnings. You can cancel these two terms, earnings available to equity shareholders and earnings available to equity shareholders, divided by book value of equity. When book value of equity is not available, you can take market value of equity. How much is your retained earnings? Just now you told me after paying equity dividend tax also. After paying dividend tax, I got 16.2 divided by book value of equity 200. It will be 16.2 by 200. 0.081 or 8.1%. This is my growth rate. Am I right? Take this growth rate into consideration and calculate your cost of equity KE. Written. Now, let's talk about the computation of cost of equity KE. Cost of equity KE is equal to DPS 1 divided by MP naught plus G. Everything we have defined actually. The only thing we have to define is MP naught. MP naught is equal to current market price per share. That is 200, right? Now KE is equal to DPS 1, please. We got it actually. 12 rupees. You want to maintain the dividend. You are not paying dividend tax out of 12. That's why I am not deducting dividend tax from 12. Is that clear? Mine divided by MP naught 200 plus growth. Just now you got it. 8.1%. Now tell me the answer. 12 by 200, convert that into percentage, add that percentage to 8.1%. 14.1%. This is my cost of equity KE, right or wrong? Yes, please. With this, we have completed first part of the question. When you want to maintain the same level of dividend, amount of dividend, that means that should be the amount should be distributed to the equity shareholders without deducting dividend tax. This is a way to compute cost of equity. Here you understood one thing. This dividend tax affected my retained earnings, finally changed my growth rate, right or wrong? Now go for the second point. Dividend to the shareholders is reduced by the extent of dividend tax. Dividend to the shareholders is reduced to the extent of dividend tax. Then in that case, I'm not going to pay 12 rupees dividend directly to the equity shareholders. They don't get 12 rupees into their hands. Please reduce your dividend to the extent of dividend tax. What is going to happen? Simple. DPS 1 is equal to expected dividend per share at the end of, but we have to adjust it here now. At the end of year 1, how much is your dividend? 12. How much is your dividend tax? 1.8. Reduce it, and this is what the dividend you are going to pay, 10.2. This is the money you are going to pay. Is that clear? Yes. And also it is going to affect my growth. G is equal to growth rate, which is B into R, right? B into R means, already we have simplified this formula if you remember. What's the formula? Retained earnings divided by retained earnings divided by book value of equity. How much is your retained earnings? You have to calculate that. You should calculate that. What do you say? Retained earnings is equal to how much is your profit? 30 minus how much you are going to pay dividend in the form of equity. How much cash dividend you are paying to the equity shareholders? 10.2. How much dividend tax you are paying? 1.8. Finally, the net retained earnings 18, right? Now G is equal to retained earnings is 18 and book value of equity is 200. Am I right? Then it results in 9% growth rate. 0.09. Am I right? No. Can I go for the yeah, please write it. From here onwards you are writing, right? Okay. Now you can calculate cost of equity KE. When dividend tax is reduced from the dividend itself, then it will change your cost of equity KE. Tell me DPS 1 10.2 divided by MP naught 200. Growth 0.09 or 9%. Tell me the answer. 14.1% is. This is my cost of equity KE, right? Next question. Go for 16. XYZ company's share is currently quoted in the market at 20. This is MP naught, right? Current quotation price means today's share price MP naught. The company pays a dividend of 2 rupees per share at the end of company pays a dividend of 2 rupees per share and the investors expected a growth rate of 5% per year. Company's dividend payment is 2 rupees, that is DPS 1 and growth rate 5%. You are required to calculate cost of equity capital of the company and market price per share if anticipated growth rate in dividend is 7%. That's the next question. Okay. Yes. Let's handle this question. First, let us handle point A first of all. Illustration number. Yes, please. Point A first. That's my first question, right? Cost of equity KE is equal to, that is my requirement. What is the requirement? Cost of equity capital should be calculated here. We have a growth rate here. Am I right or wrong? Then it is a clear case of dividend by price plus growth approach. So in that case, the formula will be DPS 1 by MP naught plus G. Am I right? Then where DPS 1 is equal to expected dividend per share at the end of year 1. That is equal to 2. MP naught is equal to current market price per share. And that comes to and G is equal to growth rate. Which is 7%, right? 5%. Yes. Then KE is equal to cost of equity KE is equal to DPS 1 is 2 by 20 plus 5%. 2 by 20 means 10% is right. Is it 10%? Yeah, it is 15% total. Means 10 means the first portion I'm asking actually. That's okay. KE is 15%. With this, the first part is over. Yeah, wrong. You can ignore that. We are right always. Go for the second part of the question. They ask you to calculate market price per share if the anticipated growth rate in dividend is 7%. I told you market price per share formula MP naught is equal to DPS 1 by KE minus Z. Did you remember that? As per dividend growth model, as per dividend growth model, MP naught is equal to DPS 1 divided by KE minus G. This is a formula which is derived from dividend by price plus growth approach. This formula is derived from which formula? Dividend by price plus growth approach. Under dividend by price plus growth approach, what is the formula for KE? DPS 1 by MP naught plus G. Am I right? Then from this KE minus G is equal to DPS 1 by MP naught. Then MP naught is equal to DPS 1 by KE minus G. This is a formula you must remember. Don't write it here, just for the sake of understanding I have given here. Okay. Now tell me how to calculate this current market price per share MP naught. If the growth rate is increased to, they said what? If the growth rate in dividend is 7%. Then MP naught is equal to formula DPS 1 2 divided by KE cost of equity, earlier KE, tell me the KE percentage, 15% you can take it, minus G 7%, 2 by 8% is answer 25. Okay, this is your current market price per share when your growth rate increases to 7%. Is that clear? By assuming that the same cost of equity is maintained, expected return. With this 16th one is over. Illustration number 17. Here in this problem, they have not given growth rate, but we have to calculate growth rate by taking this past data. Okay. Simple average we are going to take. Usually, weighted average, I mean the compounded growth rate we have to consider. But in this study material, they have taken simple average. If they are okay with that, we should always be okay with that. What do you say? Using dividend growth model means DCM, nothing but MP naught is equal to DPS 1 by KE minus G, or else KE is equal to DPS 1 by MP naught plus G. KE calculation or MP naught calculation. That's what DCM model, dividend growth model, dividend by price plus growth approach. The other name for dividend by price plus growth approach is dividend growth model. Good. Got it? Calculate the cost of equity KE in the following case. Equity share capital 2 lakhs, face value 10. Earnings for 2023 60,000. If you can divide this number with this number, you will get EPS, right or wrong? Current market price per share is 180. This is MP naught. Dividend per share 7, 8, 10, 11 in the years. In the years, 7, 8, 10, 11 in the years. 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 7, 8, 10, Of what? 2020, 2021, 2022, 2023. So I should be focused on 2023. Here there are 3 years, 20 to 21, 1, 21 to 22, 2, 22 to 23, 3. Previous year dividend, 7. This is last year dividend. 2027 means this is 2020 ending dividend per share. Is that clear? DPS at the end of which year? Year 2020. 2020 ending to 21 ending as 1 year. 21 ending dividend per share is 8. 22 ending dividend per share is 10. 23 ending dividend per share is 11. Yes. Now what you need to calculate? Cost of equity capital. You need to calculate this, right? So I know the dividend per share directly. This is 11, DPS 1. I can take this last year dividend as DPS 1. This is your DPS 1. What do you say? How much is your DPS 1? 11. And MP naught is available. The only thing I need to calculate is growth rate. Let's do that. Growth rate should be calculated here. Illustration number 17. Different problem, but somewhat illogical. They have taken some unrealistic assumptions in this problem. What is the formula for cost of equity KE? Cost of equity KE is equal to DPS 1 divided by MP naught plus G. Am I right? Now write one. What is DPS 1? That was given directly, right? Where DPS 1 is equal to expected dividend per share at the end of year 1. That is 11, right? MP naught is equal to current market price per share. That comes to G. You have to calculate. First of all, let's calculate expected growth rate. Expected growth rate or growth rate. That is based on past few years dividends from 20 to 21, 21 to 22 and 22 to 23, right? Let me calculate it. Growth rate in 2021. 2021 DPS is how much? 8 it is, right? And 22 DPS, sorry, 20 DPS previous year dividend per share, 7. The difference is 1 rupee. So from 7 to 8, the dividend has been increased by 1 rupee from the base number of 7 from the previous year. So what is the growth rate in dividend for such 2021 year? For 2021 year, it is how much percentage? 14.285 means 14.29. You can take it. This is my growth rate for which year? 21. Like that, you please calculate for 22. Growth rate in 2022. Simply with the difference between 10 and 8, 10 minus 8 divided by 8 into 100 percentage. 25%. This is my growth rate for which year? 2022. Growth rate for 2023. Growth rate in year 2023. difference between 23 and 22 dividend per share, 11 minus 10 divided by 10 into 100, right? It is 11.11, huh? No. It is 10% only. So simple number, 10%. So now, these are the 3 years growth rates. Which growth rate I should apply? Average. Usually that is simple average. Actually that should be compounded basis. But in the study material they have taken simple average. I should follow strictly, right? So simple average growth rate is equal to take the numbers 14.29 plus 25 plus 10 divided by 3. Tell me the answer. 16.43% is what? Growth rate. 16.43 is your simple average growth rate. Now you can calculate cost of equity KE. KE is equal DPS1 11 divided by MP naught 180 plus growth 16.43 percentage. Convert this number into percentage and add this to this number. Tell me the answer. 22.541 percentage. Yeah, 22.541 percentage. This is my cost of equity KE when the growth rate is not given. When we have past few years dividends, based on that, please calculate growth rate and then arrive this cost of equity KE. With this, we have completed 17th problem. What is the new point in this problem? Calculating the growth rate by considering these numbers, right or wrong? So by considering these numbers only, we have calculated growth rate. This is so important in this problem. Okay. And we have taken this 2023 DPS as DPS1, expected dividend per share. Now go for the next sum, 18th one. 18th one. Did you remember the formula for cost of equity KE under CAPM? Cost of equity KE under CAPM is equal to RF plus beta into RM minus RF. That's what we need to define here. From the following information, determine the cost of equity capital using CAPM approach. Required rate of return on risk-free securities 8%. My dear students, risk-free security, Indian Treasury Bill, RF it is. How much percentage? 8%. Required rate of return on the market portfolio of investment is 13%. What is this? RM. Did you remember that? Return on market portfolio is simply RM, return on market portfolio. Am I right? The firm's beta is 1.6. So straight question it is. Shall we solve this question? Illustration number 18. Cost of equity KE is equal to formula. Wait. You have to write like this. Under CAPM. Under CAPM, cost of equity KE is equal to formula RF plus beta into RM minus RF. Where RF is equal to risk-free rate of return. That is equal to 8%, right? Beta is equal to 1.6. RM is equal to return on market portfolio. 13%. KE is equal to 8 plus 1.6 into 13 minus 8. Answer please. 16% you'll get. Please calculate it with your calculator. You should get it. This is regarding illustration number 18. Is it over? Anything great here? Nothing. Go for illustration number 19. The beta coefficient of target limited is 1.4. What is your beta? 1.4. The company has been maintaining 8% rate of growth in dividends and earnings. This is your growth rate, G. The last dividend paid was 4 rupees per share. This is DPS not. Last dividend paid, I told you, last dividend paid, last year dividend paid, dividend just paid. All these are what? DPS not. DPS not, right or wrong? I've given you the terminology also separately. Next, expected dividend per share at the end of the current year and next year means you have to consider it as DPS1. If at all, if they have given dividend as last year dividend, last paid dividend, then your just paid dividend or just payable. These numbers are representing what? DPS not. You have to add growth rate to this number to get DPS1. The return on government securities is 10%. I told you already government securities are the best examples of what? Risk-free assets. So you can consider this 10% as RF. Did you remember that? Treasury bills, Government of India bonds are the best examples of what? Risk-free investment. So your risk-free investment return is how much percentage? 10%. While the return on market portfolio is 15%, what is this? This return on market portfolio is RM, right or wrong? The current market price of one share of target limited is 36. What is this? MP not. What will be the equilibrium price per share of target limited? You have to calculate equilibrium price per share of target limited. So what is this equilibrium price? My dear students, equilibrium price is nothing but fair price. Nothing but they're asking you to calculate share price. You have to calculate MP naught. What is the formula for MP naught? DPS 1 by KE minus Z. Did you remember that? Yes, point A. Illustration number 19. So equilibrium price per share MP naught is equal to I told you formula please, DPS 1 divided by KE minus G. Now here you know that DPS 1 you can calculate it, right or wrong? Where DPS 1 is equal to expected dividend per share for the next year. What is the formula for DPS 1? Did you remember that? DPS naught into 1 plus G. I've given you this formula while we were understanding the theory called dividend by price plus growth approach. I've given you this formula. Did you remember that? Go to that formula and see. There you can see this formula. DPS naught means last year dividend. How much is your last year dividend? 4. What is the growth rate in dividend? The growth rate in dividends. The growth rate in dividends 8%. First line itself, right? So I'll get 4.32. Am I right? What is this? DPS 1 expected dividend per share. Am I right? Now I need to calculate KE. See, the KE is not available and CAPM data is available and you have to calculate KE under CAPM and mandatorily you have to calculate KE under CAPM, because if you want to calculate the fair price, the expected return should be based on CAPM only, because that is taking risk into consideration. Every investor's uniform expected rate of return or in the same lines. So that will create some equilibrium situation in the market. Everybody's expected price will be cope up with what the regular theory called capital asset pricing model theory. Did you remember that? You should not expect different returns for different risks. Based on your perception, you should follow CAPM only, because CAPM defined one framework based on beta. Based on that only you should expect return, and this substitute such return in the formula to get the fair price. As per CAPM, cost of equity KE is equal to formula RF plus beta into RM minus RF. Am I right? RF risk-free rate of return, that is available. It's in the question itself, that is available. How much? How much? 10% is. Okay. Plus beta. What's the beta? 1.4. RM, return on market portfolio, 15% is. Minus 10. Tell me the cost of equity KE. 17% is 0.17. This is your KE. Now you know the KE under CAPM. Substitute this number in the earlier formula MP0 to get the equilibrium price per share. Hello. I cannot substitute any number here except CAPM, because if you substitute any number based on your own understanding, that means you are expecting different returns. It won't give you better, equilibrium price, fair price. If you want fair price, this KE, expected rate of return of equity shareholders, should be based on only one theory. What is that? CAPM. Is that clear? Hello? In that case, MP0 is equal to, it is not a mere substitution like a mathematical formula or mathematical problem. There is a reason why you are substituting this return in the formula, because if you substitute this return in the formula, you are expecting return based on the systematic risk of the security, and accordingly you are calculating the value of the share. Is that clear? MP0. DPS1 is how much? 4.32 na? 4.32. 4.32 divided by 12, 17% minus growth. Yeah, tell me the answer. 48. This is my equilibrium price per share. Is that clear? Therefore, equilibrium price per share is equal to 48. I want to tell you one thing. Equilibrium price per share means fair market price. It is the maximum price at which you can buy any investment. I told you the building can be purchased at what price? 15 crores. That's the maximum price I told you, right or wrong? In the similar way, this share can be purchased at a maximum price of 48. This is the maximum amount you can afford for buying this share. Now look at the question. Would you advise for purchase of the share? Will you go for purchase of the share? Actually, at what price the share is available? Look at the actual market price in the stock market. This share is available in the market at 36. So you can buy this share from the stock market at 36. Low value, right? I'm ready to pay maximum amount of how much? I'm ready to pay an amount of how much? 48. I'm ready to pay 48 rupees for buying this share. Whereas the same share is available at a cheaper price of 36. Since the actual market price is lower than the equilibrium price per share of 48, it is advisable to buy this share. Okay. It is advisable to buy the share of which company? Target Limited, because the actual market price per share of how much? 36 rupees. This is my actual market price in the stock market, is less than The equilibrium price per share of equilibrium price per share of 48. Okay, because your the price share is available at a lower price when compared to the equilibrium price. So whenever the share is available at a cheaper price when compared to fair value, it is always advisable for the investors to buy. In case if this same share price is traded at 55 or 60, you don't buy. Please don't buy this share because that's overvalued asset. Unnecessarily you don't pay much money, because the maximum money you can afford for buying this share is, the maximum money you can afford for buying this share is 48 rupees only. That is what the fair price or equilibrium price or theoretical value per share. Is that clear? With this we have completed illustration 19. Are you writing this? Yes. Next question. Illustration number 20. Calculate the cost of equity share capital of Mammon Limited, whose risk-free rate of interest is 10%. The firm's beta is equal to 1.75 and return on market portfolio is equal to 15%. Straight question it is. KE is equal to RF plus beta into RM minus RF. Tell me, what is this risk-free rate of return? Students, what is this? RF. Beta is beta. And what about this 15%? Return on market portfolio. I can consider this as RM. Now tell me, what is the formula for cost of equity KE under CAPM? RF plus beta into RM minus RF. Every number is substituted and arrived. It's a homework. You can do this. Go for 21. Are you doing this now? Do it immediately. Right. Hello. If the illustration number 21, if the risk-free rate of return and the market rate of return on the investments are 14 and 18% respectively. Risk-free rate of return means RF and market rate of return means RM. Calculate the cost of equity share capital if beta is equal to 1, beta is equal to 2 by 3, beta is equal to 5 by 4. What is great in this sum? Nothing. HW. What is the formula for KE? RF plus beta into RM minus RF, right? So RF is 14%, RM is 18%. This rupees please cancel. It will create unnecessary pressure within you. RM market return 18%. You just need to calculate beta, but that beta is already given here itself, right? So first question, when beta is equal to 1, substitute the numbers, you will get KE. Second question, when beta is equal to 2 by 3, calculate KE by taking 2/3 beta. Everywhere RF and RM are same. The only changing numbers are what? Beta only. I think you can calculate this, right? You can handle this. HW 21. 22. Can I read it? From the following information in respect of a company, you are required to calculate the cost of equity capital using CAPM approach. This is a different one. You should be careful. Star mark, because with different adjustments. The risk-free rate of return is 12%. RM this is. Okay. Sorry. RF this is. RF this is. Risk-free rate of return. Expected market price of equity share at the end of the year is 1400. This is MP1. Initial price of investment in equity shares of the company is 1200. This is MP not. Beta risk factor of the company is 0.7. This is beta. Expected dividend at the end of the year is 140. This is DPS 1. All these prices are assumed to be considered as market portfolio representative numbers. And by taking these three numbers, you have to calculate RM. What is that? Return on market portfolio. What I need to calculate? RM. There is a formula for this return on market portfolio. I'll give you. Please remember that. Can I start with that? Illustration number 22. What is so great in this problem? Calculating RM itself. That's a new thing in this problem. Illustration number 22. So first, under CAPM, cost of equity KE is equal to formula RF plus beta into RM minus RF. What do you say? Hello? Where RF is equal to risk-free rate of return that is directly available. How much that is? 12% is. Beta is equal to how many times? 0.7 times. You need to calculate RM, return on market portfolio. That is not directly available, right? Because of that reason, you have to calculate like this: DPS1 plus MP1 minus MP0 divided by MP0 into 100. Where DPS1 is your dividend. Second one is, this is capital appreciation. This one is capital appreciation. See, you're buying the share at this price and you're going to sell the share at this price. The difference itself is your capital gain. Capital appreciation. This particular formula is going to be covered under the chapter risk and return. How to calculate rate of return for a company share. There you can understand it. Formula is what? DPS1 plus MP1 minus MP0 divided by MP0 into 100. Now tell me, this is your return on market portfolio. But considering these numbers are the representative of market portfolio, DPS1 is how much? Dividend per share at the end of first year? 140. MP1, share price after 1 year? 1000 and 1100 is your initial price, right? 1200 divided by MP0, 1200 into 100. How much is your return on market portfolio? How much is your return on market portfolio? How much? 28.33, sure? Yes. Now substitute these numbers. The cost of equity formula under CAPM. You can get KE answer. KE is equal to RF 12% plus 0.7 into RM 28.33 minus RF 12. Answer please. Tell me the answer. 23.431 percentage. 23.431 percentage. This is your cost of equity KE under CAPM. What is so new in this particular problem? Calculation of RM based on the prices and dividend they have given, by assuming that those numbers are related to representative of market portfolio. With this we have completed which problem? 22nd problem. In the next session we'll handle the remaining concepts. Thank you. Yes, dear students, I'm just continuing the chapter cost of capital. Can I go for the next problem? Before that, I need to give you one formula for cost of retained earnings. Page number of cost of capital, chapter 90 in concept book. Here it's yes. Tell me one thing. Retained earnings is a money which belongs to whom? Equity shareholders. What do you say? Retained earnings belongs to equity shareholders only. Because of that reason, I can say KR is equal to KE. Cost of retained earnings KR is equal to KE. So I'll write it clearly. Page number, concept book only. $130, right? Yes. Cost of retained earnings KR is nothing but cost of reserves. What do you say? See, reserves is a money which belongs to equity shareholders. So automatically, whatever the return the equity shareholders are expecting on their equity share capital, the same return they'll expect on retained earnings also. Means cost of retained earnings KR is equal to cost of existing equity KE. Cost of existing equity KE. Please write these formulas. Cost of retained earnings KR is equal to cost of existing equity KE. In case if the personal tax rate and brokerage rate is given separately, then you should apply the below formula. You must apply cost of retained earnings KR is equal to, in case of the personal taxes and what? Personal taxes and brokerage rate is given separately, then KR is equal to, this is a formula you have to remember, KE into 1 minus TP or marginal tax rate, personal tax rate or marginal tax rate, into 1 minus brokerage rate. 1 minus brokerage rate. Is that clear? Tell me what is the formula for cost of retained earnings when personal taxes and brokerage rate were given? KE into 1 minus personal tax rate into 1 minus brokerage rate. This is so simple. For example, tell me one thing. If retained earnings were distributed as dividend to the equity shareholders, how they invest the money? They'll invest the money in the other securities. What do you say? Hello? If they invest their money in other securities, whatever the income they're getting, on such income, they'll pay what? Tax. That's what personal taxes, TP. TP means personal taxes into 1 minus TP. And then also they're investing the money in other securities, means they're paying brokerage. Hello? What I'm trying to say is, in case if there is a profit which is available to equity shareholders, if you distribute such profit to the equity shareholders instead of retaining, what they can do with that money? They'll invest that money in other securities so that they can earn this return. How much return? KE. And on that they have to pay what? Personal tax into 1 minus TP. And also they should pay brokerage for their investment into 1 minus brokerage rate. This is the net return they can earn from their outside investment, right? So the same return they should expect in case if the company retains their profit. That's what KR is all about. Okay. The cost of retained earnings means, if at all if the company is retaining the profits, then they should expect this much return from the company, because if they receive such money in the form of dividend, they can earn this return only. They'll earn this return, they'll pay personal taxes, they'll pay brokerage rate. So this is the net return they can earn. Are you getting? The same return they should expect from the retained earnings in the company, because they don't expect much return. Hope you got it. So this is nothing but opportunity cost base actually. Based on opportunity cost, we'll calculate like this. This is the logic behind this formula. You better understand one thing. Remember the formula, that is more than enough. Can I go for the problem? TP is equal to personal tax rate. Write this. Yes. Personal tax rate. Go for the next question. Illustration number 22. The firm's KE return available to equity shareholders is 10%. This is KE. The average tax rate of shareholders is 30%. This is TP, right? It is expected that 2% is brokerage cost of the shareholders will have to pay. It is expected that 2% is brokerage cost that shareholders will have to pay while investing the dividends in alternative securities. What is the cost of retained earnings? I told you what is the formula for cost of retained earnings? KE into 1 minus TP into 1 minus brokerage rate. Substitute all the numbers. KR is equal to KE. How much is your KE? So here it is 10%, right? Tax rate, personal tax rate 30% is. Brokerage rate 2% is. Substitute all the numbers here. 10 into 1 minus 0.3 into 1 minus 0. Brokerage rate is how much? 2% it is, right? 2% into 1 minus 0.02. 7 into 1 minus 0.2. 4.9% is. And the answer they have taken 0.5. This is 0.3. Okay. Hello. Here it is 0.7. Then 4.9 is the right answer. Hello. They've taken differently, na? No. Your answer is different, huh? 7 into 0. 6.86, huh? Yeah, your answer is right. 6.86. This is wrong answer. Just cancel it. And write this answer. Hello. Write this answer after writing this. Okay. This is your cost of retained earnings. Got it? 24th problem is a conflicting sum. Why? Because on the earlier problem they have taken into 1 minus b, but in this problem they have taken minus brokerage rate. This is absolutely a wrong formula actually. So wait. In the earlier situations, even in CA material also they used to take like this. Hello. Later even in CA material also you can see here K into 1 minus TP into 1 minus F flotation cost rate or brokerage rate. So this is the formula right now people are using. So my suggestion is you better prepare 23 only. 24 is a misleading sum actually. Hello. Even if you want to do this, apply this brokerage rate as into 1 minus b. Into 1 minus b. That is the way to handle this sum. What do you say? So here it is. This one is KE. This one is B. And this one is TP. What do you say? So apply the formula. Answer should be, you should get the answer accordingly. KR is equal to, see, AKS Limited retains 10 lakh out of its current earnings. The expected rate of return to the shareholders if they have invested the funds elsewhere is 10%. This is KE, right or wrong? How much is your KE? 10 into 1 minus TP, personal tax rate is 30%, 0.3 into 1 minus brokerage rate is 2%, 0.02. Same answer, huh? How much? 6.86. Earlier also the same answer, right? So just ignore the solution. Okay. And also ignore this solution also. Don't take this solution and this solution also. I've taken this just to tell you it should be ignored in the study material. That's why I have incorporated this. Is that clear? Whatever they've given in the study material, the same thing I have incorporated here. If you look at the CA study material, this problem solution was not there in the CA material now because they've removed it. Hello. Now this is your KR formula. KE into 1 minus TP into 1 minus brokerage rate. With this 24th is over, right? Hello. Now we should go for the new concept now. That's our last concept under this chapter, cost of capital. Till now we understood how to calculate cost of equity, cost of preference share capital, cost of retained earnings, cost of debentures, everything we understood, right or wrong? But the ultimate objective of this particular chapter is calculating the weighted average cost of capital. If you want to calculate weighted average cost of capital, then weights must be the amounts of the respective sources, nothing but the investment amounts of the respective sources. See, in the balance sheet, I can have equity and debt. What do you say? Equity is 400 crores, debt is 600 crores. Total money is how much? 1000 crores. What do you say? Hello. Now KE is equal to 40%. KD is equal to 10%. These are the two sources costs. I cannot simply take the simple average of these two numbers, 40 plus 10 divided by 2. 40 plus 10 divided by 2, 25% is my average cost of capital of the whole fund, 1000 crores. I cannot say like that. What do you say? Why? Because I should consider the weights of the respective sources. The amounts must be considered as weights, and such weights should be multiplied with the respect to cost in order to arrive the weighted average cost of capital. Weighted average cost of capital is more accurate cost of your total capital which is used in the business. Is that clear? You cannot consider the simple average. Simple average never represents the weights of the respective sources. So because of this reason, for calculating weighted average cost of capital, I must consider the respective sources weights. The weights are nothing but the amounts or the fund amounts of the respective sources. So this is the way to calculate weighted average cost of capital. This is a format. Calculation of weighted average cost of capital. Are you getting? In shortcut, I'll say WACC. WACC. The columns are sources. You have to write sources, amount rupees, the weight of each source, nothing but proportion. What is that? Proportion. This is also known as what? Weight. Also known as what? Weight. Then cost of capital, C by C, cost of capital. Then proportion into cost of capital, also known as weight into cost of capital. These are the standard columns. You can use any word, weight or proportion. Proportions are nothing but weights. You can write source, the source. So what are all the sources available? Please write it here. Equity share capital, reserves and surplus, preference share capital, debt here, right? Write like this. Write the amounts here. Write the amounts and get the total. This total, for example, the first amount is 1, second amount is 2, third amount is 3, fourth amount is 4, and total is T. This is my total. Now I have to calculate proportion. How to calculate proportion, sir? Simple. The proportion should be calculated like this: 1 by T. I mean, first amount divided by equity share capital amount divided by total. That gives you proportion of first source. 2 by T, 3 by T, 4 by T. This is a way to calculate what? The proportion of equity share capital, retained reserves and surplus, preference share capital and debt. Multiply these weights with the respective sources cost. Such costs should be calculated at the beginning of the problem itself. Before going for this table, you should have calculated cost of equity, cost of retained earnings, cost of preference share capital and cost of debt. Only after doing such computation, go for this table. Then multiply these two numbers, proportion into cost of capital. Then I'll get what? The weighted cost of capital. The weighted cost of capital, which is known as weighted average cost of capital, denoted with KO. Denoted with what? KO. This KO is simply known as overall cost of capital. What is this? Overall cost of capital on this capital. Overall cost of capital on the total capital. Is that clear? This is your overall cost of capital on the total capital here. This is my total capital. On this total capital, this is my overall cost. Is that clear? So this is the way to calculate weighted average cost of capital. Tell me the columns, please. Source, amount rupees, proportion, weighted proportion or weight, cost of capital, proportion into cost of capital or weight into cost of capital. Then you get overall cost of capital. Are you getting? So dear students, this can be written as a formula in a single line also. We can write the formula like this: weighted average cost of capital KO is equal to PD into KD plus PE into KE, PP into KP plus PE into KE. Means what? Proportion of debt into cost of debt plus proportion of preference share capital into cost of preference share capital plus proportion of equity into cost of equity. Or I can write this formula as weight of debt into cost of debt plus weight of preference share capital into cost of preference share capital plus weight of equity into cost of equity share capital. Because instead of using the word proportion, I can also use the word weight. Is that clear? So this is another formula for what? Weighted average cost of capital KO. If you have reserves also, you have to write WR and KR. This is the formula for weighted average cost of capital KO. Hope you got it. Yes. Now my task is from where I should take these amounts. The weights is a discussion. My dear students, the weights, from where I should take these amounts. I can take these amounts in two ways. One is from books, known as book value weights. Another one is from markets, known as market value weights. Is that clear? So what are you talking? See, I said amount column, right? These amounts should be taken from which source? From which statement I have to take these numbers? That's the question. Equity share capital, reserves and surplus, preference share capital, debentures. Sir, balance sheet is available there. So you can take the numbers from financials from balance sheet. Why you are asking like that? My dear students, if you can take the figures from balance sheet, that is books of accounts, you know that balance sheet is representing books of accounts. Then if you calculate weights by taking such figures on the balance sheet, then such weights, the weights which were taken from books of accounts, are simply known as book value weights. Since balance sheet is representing books, if you take the numbers from balance sheet and if you calculate weights, such weights are simply known as what? Book value weights. Instead of that, I can also calculate these weights by taking the market figures. Means for equity, market value of equity. For preference, market value of preference share capital. For debentures, market value of debentures. For bonds, market value of bonds. For bank loans, market value of bank loan. No, you can't find it. Hello all of you. You can never see the bank loans market value, because bank loan is not going to be traded in stock exchange. Am I right or wrong? Then what is that then? See, when market value of any source is not available, take the book value as market value. So usually bank loans, under books of accounts as well as market value weights, under both the cases you will take the same numbers. Hope you got it. So my dear students, how to calculate market value of equity? Market value of equity can be calculated as number of equity shares into market price per share. How to calculate preference share capital market value? Number of preference shares into market price per preference share. How to calculate market value of debentures? Number of debentures into market price per debenture. Is that clear? Yes, my dear students. See here. If we arrive the weights, or proportions, by taking the figures from balance sheet, then such weights are simply known as book value weights. Am I right? Is that clear? If we arrive the weights or proportions by taking market values of each source, then such weights are known as what? Market value weights. No? Market value weights. Yes, dear students. Reserves and surplus is usually considered as a separate source in book value weights. In book value weights, I have to take reserves and surplus directly from the balance sheet. Reserves and surplus should be taken should be taken from the balance sheet for calculating the weight or for calculating the proportion or weight, both are same, right? Proportion of reserves and surplus. But here the reserves and surplus cannot be taken directly from the balance sheet. First of all, you should know how to calculate market value of each source. Market value of each source is equal to number of units into market price per unit. Is that clear? Number of units into market price per unit. Market value of each source is equal to number of units into market price per unit. For example, if you are taking equity share capital, tell me the formula. The unit is equity share. Number of equity shares into market price per share. If it is preference share, number of preference shares into market price per preference share. If it is debentures, number of debentures into market price per debenture. If it is bonds, number of bonds into market price per bond. If it is bank loan, number of bank loans into market price per bank loan, right? No, you won't see like that. If it is bank loan, take the bank loan accordingly, directly. Can't apply market value to the bank loan. You can't assign any market value to the bank loan. Is that clear? So, I need to do one more point here. Just write it. The market value of equity should be split into equity share capital and reserves and surplus. Equity share capital and reserves and surplus. Equity share capital and reserves and surplus in its book value ratio. In its book value ratio. In its book value ratio. Is it clear? Yes. The market value of equity should be split into equity share capital and reserves and surplus in its book value ratio. For example, if my market value of equity is this much amount, 300 crores, this is my market value of equity. The equity share capital is, the book value of equity share capital is 100 crores. Reserves and surplus is 100 crores. So you have to split this amount in equal ratio. In what is the ratio? 1:1. Then 1:1. So simply market value of equity share capital, it is simply 300 crores into 1/2. How much it is? 150 crore. Market value of reserves and surplus, simply you have to separating it, that's it. It is simply 300 into 1/2. What is the value? 150 crores. Like this you have to split the money of market value of equity into equity share capital and reserves and surplus in its book value ratio. While solving the question you'll understand it. All the problems are going to be solved like this only. See, in book value weights you have to take equity share capital, reserves and surplus on the balance sheet. But in market value weights, calculate the market value of equity, and that market value of equity should be split into equity share capital and reserves and surplus in the ratio of what? Book value of equity share capital and reserves and surplus. Is that clear? This point is so important for solving the questions. You have to remember this. This is a 5-star point for the questions. Yes. Students, listen one point. In the balance sheet, I understood that equity share capital is 1 lakh with 10,000 shares of 10 rupees each. Reserves and surplus are 2 lakhs. Students, I am asking you, what is the book value of equity? I told you many times, the equity share capital and reserves and surplus total itself is what? Book value of equity. For example, if you are holding 5,000 shares in this company, you are holding 50% of equity, right? Then what is the value of equity as per the books of accounts? Is it only equity share capital or also reserves and surplus? Reserves and surplus also. Total book value of equity is how much? 3 lakhs. Out of that, your equity is 50%. So because you are holding 5,000 shares, that means you are holding 50% of equity, right or wrong? Hello. So how much is your equity value? 1,50,000 as per the books of accounts, that is. As per the books of accounts. First of all, if I calculate book value per share, do I need to consider only equity share capital? Also reserves and surplus? Also reserves and surplus I have to consider. I should consider equity share capital and reserves and surplus for calculating what? Book value per share. So it is simply equity share capital plus reserves and surplus divided by number of equity shares. Am I right? Equity share capital is 1 lakh. Reserves and surplus is 2 lakh. Am I right? Divided by number of equity shares? 10,000 shares. Now tell me, what is your book value per share? How much it is? 30. Now tell me, this 30 is loaded with what components? Yeah, face value and reserves and surplus. Am I right? How much is our face value? 10. Reserves and surplus? 20. Now tell me one thing. This book value per share is already loaded with what? Reserves and surplus. For example, for this share, the market price per share MPS is 100. Are you getting what you are getting? The share price is 100, means which is more than book value per share, right? So for your share, the trading price is 100. Do you think that this market price per share is a big number or small number? Big number. This is loaded with so many components. What are those components? Face value 10, reserves and surplus 20, and excess value, the extra value of your business. I can say this is goodwill. That's your extra business value. What do you say? So the whole number is market price. That is a response to your company share in the market. 70 rupees extra. Is that clear? Now tell me one thing. If I take market value of equity by multiplying number of shares with 100, how many number of shares are here? 10,000 into 100. If I multiply, what is the value? 100 lakhs. Am I right or wrong? No. It is 10 lakhs. How much it is? 10 lakhs. Hello. The market value of equity is equal to 10,000 into 10,000 shares into 100. It will be 10 lakh. What is the book value of equity? 3 lakhs. What is the market value of equity? 10 lakhs. Means this 10 lakhs is already loaded with what? Reserves and surplus. Are you getting? That's why we are going to split this money into two components. What is that? Equity share capital and reserves and surplus. In which ratio? In the ratio of book value of equity share capital and reserves and surplus. What is the book value of equity here? Book value of equity here. Equity share capital 1 lakh. Reserves and surplus 2 lakhs. The ratio of equity share capital and reserves and surplus 1:2. Now separate this. So you will get equity share capital weight as per market value weights. 10 lakh market value of equity into 1/3, right? 1/3. 1/3. Then reserves and surplus 10 lakh into 2/3. Tell me the amounts. 3,33,333, right? 6,67,000. Sorry, 6,66,667. Am I right? In this way, you have to separate it. when the market value of equity is given for market value weights. Hope you are getting it. Yes, this is a background logic why we are splitting market value of equity into equity, share capital and reserves and surplus in the ratio of book value of equity, share capital and reserves and surplus. Hope you got it. Now with the help of this background, I hope you have written all these sentences. Sentence only, no, apart this one is not required actually. Okay, because I'm going to give you this in PDF format, right? You can refer it whenever you need it. Not a problem. Hello. Let's go for the next question, dear students. Okay, I don't want this video and all. Can I go for the next question? Illustration number 25. AKS Limited has the following capital structure on October 31st, 2023. Source of capital, equity share capital 1 lakh shares of 10 rupees each, 10 lakhs. Reserves and surplus 10 lakhs. 12% preference shares 5 lakhs. 9% debentures 15 lakhs. Total capital 40 lakhs. Hello students. The market price of equity share is 50. It is expected that the company will pay next year a dividend of 5 rupees per share. What is this? DPS 1. And which will grow at 7% per hour. What is this? G. Assume 30% income tax rate. You are required to compute weighted average cost of capital using market value weights. They are very specific. They are asking you to calculate weighted average cost of capital exclusively based on what? Market value weights. So straight away, let us handle this sum. Before calculating weighted average cost of capital based on market value weights, please calculate cost of individual sources first. That's your first job. Okay. Illustration number 25. Yes, please. Cost of equity KE is equal to, that's the first source, am I right? Formula DPS 1 by MP naught plus G, am I right? Where DPS 1 is equal to expected dividend per share at the end of year 1. How much that is? They've given the expected dividend per share, right or wrong? That comes to 5. Next, MP naught is equal to current market price per share. That comes to 50. Are you sure? G is equal to growth rate. They have given the growth rate directly 7%. Now can you calculate KE directly by substituting these numbers? Yes. DPS 1 5 divided by MP naught 50 plus 7%. Now tell me the answer of cost of equity KE. How much? 17%. Are you sure about this number? Yes. With this we have completed cost of equity KE. That is not the end of the story. We have to calculate cost of retained earnings, right? Cost of reserves and surplus. Cost of reserves KR is equal to, cost of reserves KR is equal to, I told you here there are no personal taxes and brokerage rate available here. I can take the first formula, cost of existing equity KE, right or wrong? How much is our cost of existing equity KE? Just now we have calculated that 17%. Is that over? Next, cost of preference share capital KP. Any information, life and all? No. So I can assume that it's a irredeemable preference share capital. The formula is PD by MP. What do you say? Existing instrument it is, am I right? Where PD is equal to preference dividend. Face value is given or not? Not given. The face value of preference shares were not given. Then assume face value of preference share as 100. 100 rupees as a face value of preference share. That's what the assumption I'm taking here. Preference dividend rate 12% is. Take that. So 12 rupees is your preference dividend. Am I right? MP is equal to market price per preference share. Do you know that information? If the price is not available, consider face value as your market price. That means the preference shares are assumed to be traded at par value. The same logic is applicable to debentures also. Whenever the market prices of debentures or preference shares were not given, I assume that those two instruments are being traded at par value only. Is that clear? That will be, the value will be 100. Now KP is equal to 12 by 100. It will be 12% or 0.12. Am I right? Can I go for the next source? 9% debentures KD, cost of debentures KD. Any information regarding redemption value and all life? No. So it's a clear case of irredeemable debentures. I can write this formula I into 1 minus T divided by MP because it's an existing instrument. It's a case of irredeemable debentures because life is not given, and it's a case of existing instrument because already it's an existing capital structure. What do you say? I into 1 minus T by MP. Again the face value is not given. Which value you want to assume? 100 is a face value. What do you say? Where I is equal to interest. 100 into interest rate 9%. Then my interest will be 9 rupees only. Am I right? T tax rate. Tell me the tax rate. 30% is, which is 0.30. MP market price. Any information regarding market price of debenture? Then what you should do? Take the face value as your market price, right or wrong? Market price per debenture. I assume that the debentures are being traded at par value. So simply 100 is my market price. Am I right? Now calculate KD. It will be 9 into 1 minus 0.3 divided by 100. It will be 6.3%. I want to tell you one point. This calculation can be done in a simple formula by using a simple formula. That is cost of debt KD. Cost of debt KD is equal to I into 1 minus T. You can use this formula. Here I means interest rate, not interest amount. It's a shortcut formula you can apply. Interest rate is how much? 0.09 into 1 minus tax rate 0. Tax rate 30. It will be answer 0.04. It is right. Sorry, 0.09 it is right. Yeah, answer please. 0.063 means 6.3% only. Am I right? My dear students, I can use this formula subject to few conditions. What are such conditions are? First of all, it should be irredeemable debenture only. The second condition is in the denominator, either the net profits or the market price of the debenture should be equal to the face value. In the denominator, either the net profits or the market price should be equal to face value. Then only I can apply this shortcut formula I into 1 minus T. So whenever you see in the denominator, if the denominator is exactly equal to face value, I can use this formula directly. So in the problem, if they have not given any information regarding issue expenses, flotation costs, premiums, discounts, but still they are asking about cost of debentures or any debt instrument, straight away you can use this formula interest rate into 1 minus tax rate. What do you say? Now we have calculated all the sources costs. Now I am eligible to calculate weighted average cost of capital based on market value weights. What do you say? So let me do that. Calculation of weighted average cost of capital. For the first time only I am writing it fully. Usually what we need to write? WACC. For the first problem, because it is a first problem, I am writing it. Because it's a first problem, I am writing it. Remember that. WACC by using market value weights. Is that clear? The columns, sources, source, amount rupees, proportion, cost of capital, proportion into cost of capital. Is that clear? Write the sources. What is the first source? Equity share capital. Give some gap. Reserves and surplus, because we need to do computation for every source. Then next source, preference. What may you know the preference dividend rate? Rate was not given, right? 12% preference share capital. Next, 9% debentures. Is that clear? Now tell me the number of equity shares. 1 lakh shares into market price. Wait. Yeah, tell me. 1 lakh into. Tell me the market value of equity share capital. 1 lakh into 50. It will be 50 lakhs, right? Hello, all of you. I'm writing it here. Market value of equity. Working note. 1. Market value of equity is equal to, how much that is? Oh yeah, how many shares are there? 1 lakh shares. I'm just writing that. Is that clear? Into 50. It will be 50 lakhs. I should split this market value of equity into equity share capital and reserves and surplus in the ratio of book value of equity share capital and reserves and surplus. Did you remember that? Book value of equity share capital and reserves and surplus ratio. What do you say? It will be 10 lakhs is to 10 lakhs, right? It will be 1:1, means 2, right? 1 by 2 should be, so out of your market value of equity, 50 lakhs into 1 by 2, am I right? Then 50 lakhs means 25 lakhs is the separated amount to equity share capital, reserves and surplus. 50 lakhs into 1 by 2, 25 lakhs. What do you say? Preference share capital, 5 lakhs as a face value. Oh yeah, you don't have any information regarding market value of preference shares, right? So you can take book value as market value. How much? 5 lakhs. Even for debentures also the market prices were not given. So again I can consider that value as 5 lakhs only. So successfully we have separated market value of equity into equity share capital and reserves and surplus in the ratio of book value of equity share capital and reserves and surplus 1:1. 10 lakhs is to 10 lakhs, 1:1. That split is okay. Now take this total. 50 plus 5, 60 it is, right? 60 lakhs. Hello? 70. Yeah, it is 15. Okay. Debentures have written 5 only. Then it will be 70. Am I right? Now take the proportions. For every proportion, take at least take at least 4 decimals. One more point, if the 5th decimal is 5 or more than 5, round it off to 4th decimal. Hello? 25 by 70. Zero point 3571 enough. Next 0.3571. Next 714 means you can take any number into 2 at least, so that it will be comfortable. Let's see. 5 by 70. 0714. Next 15 by 70. 2143. If you add all these proportions, then you should get 1. You'll get 1. I'm sure about it. 1 plus 2, 3, 3 plus 4, 7, 7 plus 3, 10. 1 you'll get it. You don't need to add 1. You don't need to write it as 1. Don't aggregate this, okay? Hello? Now write the cost of capital that we have arrived earlier. Equity share capital cost. Both of these percentages are same, right? Next, preference 0.12 only. This is 0.06. Are you sure? 0.063 only, right? Yeah, multiply the proportions with the cost of capital. Zero point. Next. Point 3570 to 0.17. But 0.06, 0724. That's okay, no issue. Next. Zero 0.856. Okay, next. Zero 0.0135. Sure. Get the total. 14.34. What is this? KO. I told you, overall cost of capital. So what it means? You see, this overall cost of capital 14.34% is 14.34% of cost on your 70 lakhs capital. This is the 14.34% of cost of capital. That capital is 70 lakhs. The cost percentage per annum is 14.34% on the capital amount of 70 lakhs. Is it the answer? They got 3.5. That's okay. No issue. With this we have completed illustration number 25. Yes, in the next session we'll continue the remaining sums. Good evening all of you. Yes, let us handle the remaining problems under the chapter cost of capital. We are handling weighted average cost of capital computation. Am I right or wrong? Let's go for that. Go for the illustration number 26. Can I read it? Yes, sir. Okay. Asianol Limited has the following capital structure. You are not yet. Equity share capital 10 lakh shares with a face value of 100 lakhs. 12% preference share capital 10,000 shares 10 lakhs. Retained earnings 120 lakhs. 14% debentures 70,000 debentures 70 lakhs. 14% term loan 100 lakhs. How many sources are here, dear students? Totally 5, right? And remember one thing, we have equity share capital as well as retained earnings. The market price per equity share is 25. This is MP not. The next expected dividend per share is 2 rupees. This is DPS 1. And is expected to grow at 8%. This is G. The preference shares are redeemable after 7 years. At the end, after 7 years at par. It is not at per, it is at par. and are currently quoted at 75 rupees per share. You have to understand one thing here. These preference shares are redeemable at par and current market price is 75, which means it's an existing instrument. Am I right or wrong? The debentures are redeemable after 6 years at par. It is not per, it is par, at par. And their current market price quotation is 90 rupees per debenture. Same logic applicable here also. This is redeemable debenture, redemption at par. Current market price per debenture is 90. The tax rate applicable to the firm is 50%. It is very clear, right? Now let us start with the cost computation of individual sources. Once that is over, we can go for weighted average cost of capital based on book value weights and based on market value weights. Shall we start that? Actually, the question itself is missing in this question. What do you say? Write it, write it. Actually, under what method, it doesn't matter. Leave that. First of all, they have not even asked calculate weighted average cost of capital. Basis and all secondary. Calculate WACC. Write the question. Extension. Calculate WACC by using book value weights. Calculate WACC by using book value by using book value weights and market value weights. By using book value weights and market value weights. Extension of the question. Can I start with the solution? By using book value weights and market value weights. Yes, here it is. Cost of capital. Illustration number 26. First source cost of equity KE. DPS 1 divided by MP naught plus G, where DPS 1 is equal to expected dividend per share at the end of, I wrote DPS, but in the examination you have to write dividend per share at the end of year 1. That is equal to 2. Next, MP naught current market price per share. That is equal to 25. G is equal to growth rate. Which is 8%, right? KE is equal to DPS, please, DPS 1, please. 2 divided by 25 plus 8%. Tell me the cost of equity. 16% or 0.16. Am I right? This is cost of equity. Now go for cost of preference share capital. Redeemable or irredeemable? Redeemable. Fresh issue or existing instrument? Fresh issue, because no, it's an existing instrument. Market price was given here, right or wrong? Cost of redeemable preference share capital KP is equal to PD plus RV minus MP divided by N whole divided by, did you remember the formula, dear students? RV plus MP divided by 2. Before handling weighted average cost of capital problems, you might have revised all the sources cost at least once. Otherwise, you can't handle the problems because we have covered so many formulas. What do you say? Where PD is equal to preference dividend. Face value of preference share capital. 100 into preference dividend rate. It will be 12 rupees. This is my preference dividend amount, right? Any information regarding redemption value, they said it is par value. Do you know the face value of preference share capital? How do you know? Because we know the number of preference shares. So 120, no. Yeah, it is 10 lakh divided by 10,000. How much it is? 100. So face value is 100. So redemption is at par 100. What do you say? And MP is equal to current market price per preference share. That was given directly. Current market price per preference share. That comes to 75. N is equal to life of preference shares. How many years? 7 years. We got every number right. Now KP is equal to PD, please. 12 plus 100 minus 75 divided by 7 whole divided by 100 plus 75 divided by 2. Now calculate it and tell me the cost of preference share capital. 17.79. 5 means 17.8%, right? Or 0.178. With this we have completed cost of preference share capital computation. Now the next one is cost of retained earnings. I told you already, cost of retained earnings. If no information regarding personal taxes and brokerage is given, I can consider KR is equal to KE, right or wrong? Cost of retained earnings KR is equal to cost of existing equity KE. That comes to, how much that is? 16% or 0.16. Not a great deal. Next one. Cost of redeemable debentures. Am I right? Existing or fresh issue? Existing. Because the price, market price is given in the problem itself. Am I right? Formula. I into 1 minus T plus RV minus MP by N whole divided by RV plus MP divided by 2. My dear students, I may not get the same answer which is being arrived in the study material, because they have taken 1 minus tax rate for the second component also. That is an alternative computation, but we don't follow, because for majority of the problems in the study material they have given only tax saving for interest only, not for the second component. Hello. Because of that reason, even though you are deviating this number from the study material number, don't care, just leave that. Follow this process only, okay? Because for the remaining problems also we are going to follow the same process. I don't want to deviate from the regular process. Interest I is equal to, where I is equal to interest. Face value is how much? 100 into interest rate. 14%. It comes to 14 rupees. T tax rate. 0.5. RV redemption value. Any information regarding that? Yes, it is par value. So, do you know that the face value of debenture is 100? How do you know? They have given 70,000 debentures. 100 lakhs they have given, right? No, 70 lakhs they have given. 70 by 70,000, 100 it is. Now, N is equal to life of debentures. MP is equal to market price of debentures. $90 it is, right? Students, can we calculate KD now? KD is equal to interest. Please. 14 into 1 minus 0.5 plus RV redemption value 100 minus 90 divided by life 6 years whole divided by 100 plus 90 divided by 2. Answer please. 9.12%, whereas their answer is 8.25. Am I right or wrong? So don't consider that, follow this solution only. 9.12. 12% is or 0.1912, right? 09 actually, right, wrong. 0.0912. For the rest of the problems, the whole material, they've done problems with the help of or the regular formula only. Nowhere they've taken like that. Is that clear? So it is not a usual practice, abnormal practice that is. So I don't want abnormal things, I want normal things only. Okay. Next please. In the main examination they'll solve the question like this only. Don't expect this kind of solution that was given in the study material. Okay. Next please. Cost of term loan. See, when there is no information regarding net proceeds, issue expenses, generally for term loans, you have to find whether there are any processing charges while taking the loan. If such information is not available, I can take directly the regular formula. I told you already. KTL or KD, it can be known as KD also, is equal to interest rate into 1 minus tax rate. Mostly for term loans, this is the formula. What is the rate? 0.14 into 1 minus 0.5. It will be 0.07. Am I right? Yes. Now coming to, I have to go with what? Weighted average cost of capital based on book value weights and based on market value weights. Can I go for that? Calculation of WACC based on book value weights. Simple. Take the columns, same columns, every time the same column. Source, amount, proportion, cost of capital, proportion into cost of capital. Am I right? Tell me all the sources. Equity share capital, 12% preference share capital, retained earnings, 14% debentures, 14% term loan, amounts please. 100 lakh, 10 lakh, 120 lakh, 70 lakh, 100 lakh. Have you observed one thing? We are not bothering about these numbers because straight away we are taking the numbers given in the question itself. Such numbers are nothing but book value weights. You don't need to calculate those weights. Those amounts actually. Tell me the total. 400 lakhs. So easy to calculate proportions. 100 by 400 means 0.25, right? 10 by 400. 0.025. 120 by 400. 0.3. 70 by 400. 175. 100 by 400. 0.25. You don't need to add it. You'll get 1 no, surely. Surely you'll get 1. Yes, tell me the cost of equity share capital. 16%, right? 0.16. Here also retained earnings 0.16. Preference share capital cost 17.8% is 0.178. Next, debentures cost 0.0912. So always tell me the decimals only. Multiply the proportions, book value weights with the cost of capital of each source. Yes, please. 0.04. Are you sure? Wait. 0.25 into 0.16. Is it right? 0.04. Okay, next one. 0. Okay, next. 0.048. Yes. 0.01596. 0.0175, right? Get the total. This will be overall cost of capital based on book value weights. 1259, enough, 12.59%. So your answer should not be matched with the answer which is given in the study material, because they got another cost of debt, right or wrong? So don't bother about it. Stick to your answer. You're right. Is it over? Are you writing? Calculation of weighted average cost of capital by using market value weights. Columns, source, amount rupees, proportion, cost of capital, proportion into cost of capital. Tell me the sources. Equity share capital, 12% preference share capital, retained earnings, 14% debentures. Wait, I'm writing it. Wait. Let's do this. 1 second. Second source, please. 12% preference share capital, right? Next, retained earnings. Next, 14% debentures. 14% term loan. Is that clear? Now go for the equity share capital. First of all, we have to calculate market value of equity at the end. That's a working note. Market value of equity is equal to, tell me how many shares are here? 10 lakh shares. 10 lakh shares into market price per share. So it will be 250 lakhs. You know the book value of equity, share capital and reserves and surplus. 170, no. Yeah, actually it is 120. 100 and 120, right or wrong? Book value of ratio of book value of equity share capital and reserves and surplus, that is equal to, which comes to 100 is to 120. I can say you don't need to solve this. You better do one thing. Every time we can't do like that. 220, right? 100 by 220, 120 by 220. Then you can go over there and split this money. 250 lakhs into 100 by 120. 100 by 220, sorry, 120 I wrote, right? It is 220 total. Yeah, and lakhs need not be, lakhs and lakhs can be cancelled, right? 113 point, yeah, that's okay. 113.636 preference share capital, sorry, retained earnings, 250 lakhs into 120 divided by 220. Tell me the value. 136.3636, right? Preference share capital. How many preference shares are there? 10,000 shares. Market price per preference share is 75. Then it will be Sure, seriously? 7 lakh 50 means 7.5 lakhs. Are you sure about that? Yeah, it is 10 lakhs actually. Yes, next, debentures. How many debentures were there? 70,000. Each debenture market price? 70,000 into 90. 63 lakhs. I can take 63. Term loan as usual. 100 it is, right? Is that 100? Yes. Now get the total, dear students. 113.636 plus 7.5 plus 136.3636 plus 63 plus 100. 420.49. Yeah, that's okay. They got 420 lakh 50,000. That's okay. 429.4996 means I can take 420 point. Just take this number as round figure. 420.50, right? You take the proportions now. 113.636 divided by 420.5. 420, remember the number. 420.5. 0.270. Tell me another decimal. 2. Next. 420.5. Okay. Next. 0.3242. Yes. 23. Yes. Tell me the cost of capital of each source. 0.16. Here also 0.16. Preference. Yes. Next. 0912. It is 0.07. Right. Multiply the proportions with respect to sources cost. Yes. Next, please. Yes. Next. 0.0028. No, you're wrong. That's why I checked it. It's Ayyappan, right? 0.051872, right? 0.051872. Yes. 1818, huh? Yeah. Next. 0382. Next, please. Yes. Total, please. KO. Usually, it should be GT. If you have done all the numbers computation. Point 15296, right? Or 15.29 percentage. I can take 15.3 also. How much they got it? They got 12.75. That's okay, because their weights and their cost of individual sources were different, right? That's fine. 15.29. This much difference, I guess. Yeah, because this debenture source proportion itself is cost itself is changed completely. They got 8.25, we got 0.0912. Is that right? Confirm once. We have to change one number, right? What's that? 0.0136. Now get the total. Yeah, 0.128 or 12.8%. This is acceptable answer with a reasonable deviation. Is that over? Yes. Can I go for the next problem? Yes, please. Illustration number 27. Is it 27? 28 also similar problem. Okay, right. Let me start with 27. The capital structure and cost of capital of a company are given below. Book values, after tax cost of capital. Equity cost is given directly 16%. Retained earnings, if they don't give you have to consider how much? Hello, 16 only, right? Subject to the information availability. No personal tax rates, brokerage rates were given in the question. How do you know, sir? I know. Debentures 400 lakhs, right? Book value. And debt cost is 7%. This is after tax cost of debt only. Equity shares are representing shares of 10 rupees each. Equity shares represent shares of 10 rupees each. Face value 10. The current market value of each share is 80. This is market price per share of what? Equity shares, MP note. And the corporate tax rate is 40%. Compute the weighted average cost of capital. If the company uses, compute the weighted average cost of capital of the company using book value weights and market value weights. You have to calculate weighted average cost of capital using book value weights as well as market value weights. What do you say? See, everything they've given. I think I don't need to calculate anything. What do you say? They've given every cost. Just we have to take 16% retained earnings. So I can show you the solution. So here at KE for retained earnings, KR is equal to KE. That's what they've taken. What do you say? For debentures, already they've given the cost. So they've done this weighted average cost of capital in their own way. Can you calculate weighted average cost of capital based on book value weights and market value weights? In our own way. In our own way, what are the columns? Heading please, calculation of weighted average cost of capital by using book value weights. Columns, source, amount rupees, proportion, cost of capital, proportion to cost of capital. In sources, I have to take equity, retained earnings, debentures. Then amounts, the same amounts, right? Total, you can calculate proportions. The costs are already available, right or wrong? Then you can do it. What about book market value weights? You have to take that number of shares in same columns, just in amount columns you have to write number of shares. How many shares are there? Actually, now 200 lakhs divided by 10 it is. How many shares? 20 lakhs. 20 lakhs into market price per share? 80. 20 into 80. 800 lakhs, huh? That's what they've taken here, right? Hello, are you sure about 800 lakhs? Wait. Is it 20 lakhs only? Yes, 20 into 80. 1600 lakhs that is. Yeah, 20 into 80, 1600 lakhs. In the ratio of book value of equity share capital and retained earnings, that is in the same ratio, right? 1:1. You are going to get 800 lakhs equity share capital, 800 lakhs retained earnings. You know how to split this money, right or wrong? Then finally, you can write debentures. Debentures amount is no information regarding market price of debenture and face value and all. I can take the same amount as market value of debentures. Here, market value of debentures are equal to the same debentures value because of the lack of information regarding market price of debentures. Is that clear? After that, I don't need to tell you how to do that weighted average cost of capital based on market value weights because already we have solved two sums. The thing is, go for the second question. That's the most important point. How would you account for the difference, if any, in the average cost of capital under 1 above? Actually, if you see the weights, Look at the weights. As per book value weights, 25% weight to equity share capital, 25% weightage to retained earnings. Totally 50%, right? We have assigned 50% weightage to what? The costliest source, equity share capital. Balance 50% to debentures, the cheapest source. Are you getting? So we have assigned weights in an equal way, 50-50. That's why I got 11.5% weighted average cost of capital. What about the weighted average cost of capital based on market value weights? 14.2. My cost is more. Why my cost is more? Because you have assigned more weightage to equity share capital and retained earnings under market value weights. Because that is more expensive source, the cost will be increased. And I've assigned least weightage to debenture source because that is cheapest source. The cost is cheaper for debentures, so that your weighted average cost of capital will increase because I've assigned lesser weight. Look at the weights. 0.4, how much? 0.8. Earlier we have assigned 50%, now we have assigned 80%. This means you have assigned more weightage, extra 30% weightage to what? Equity cost. Thereby your equity cost, thereby your overall cost of capital will increase. I reduce the cheapest cost proportion and I increase the costliest sources proportion. Thereby my multiplied product resulting in higher cost of capital. Are you getting? That's what they've written here. It has been observed that calculation of weighted average cost of capital using market value weights, using market value, is higher than using book value. The reason being that the market value of equity shares is considerably greater than book value. Yeah, obviously I told you market value of equity is always higher than what? Book value of equity. Therefore it provides higher specific cost of capital and gives you greater emphasis to this source of finance. Which source of finance? Equity. We are giving more emphasis to this equity source, so that because we are assigning more weights to equity, we are giving more emphasis to equity source. That leads to more overall cost of capital. Are you getting? Hello all of you. You can write it in your own sentences actually. Since we have assigned more weightage to equity share capital and retained earnings, whereas we have assigned lesser weightage to equity share capital and retained earnings under book value weights, so that because the equity cost is the costliest source, thereby it is resulting in more overall cost of capital. You can write like that in your own way. Are you getting? Do you want to write the conclusion in our own way? Write it, I'll tell you. Second point. It is observed that, second point, it is observed that weighted average cost of capital, it is observed that weighted average cost of capital by using book value weights, by using market value weights, is greater than the weighted average cost of capital, by using book value weights, right? By using book value weights. Now continuation. The reason behind this is market value of equity. Market value of equity is greater than the book value of equity. Full stop. Thereby we are assigning more weightage. Of 80%, within brackets 0.4 plus 0.4, of 80% within brackets 0.4 plus 0.4 to equity which is the costliest source, which is the costliest source, which is the costliest source in the capital structure. What we have written? Tell me what we have written. Thereby assigning more weightage capital structure. Hence the WACC under weighted under market value weights, WACC under market value weights is more than that of book value weights, is more than that of book value weights. The reasons are simple, because we have assigned more weightage, more weightage to equity under market value weights, which is the costliest source. 16%, 16 or how much it is? 16%. When compared to debt, it is more costlier, and I have assigned 80% now. Earlier it is only 50%. Am I right or wrong? That's the reason. With this we have completed illustration number 27. Go for 28. The following is the capital structure of ABC Limited as on 31st/12/2023. Sources of finance: equity share capital 5 lakhs, 5,000 shares of 100 rupees each, 10% preference share capital of 100 rupees each, 2 lakhs, 12% debentures 3 lakhs, total capital 10 lakhs. The market price of the company share is 100 MP not 110 MP not. It is MP not, right or wrong? And it is expected that the dividend of 10 rupees per share would be declared for the year 2023. This is DPS 1. This is DPS 1, right or wrong? The dividend growth rate is 6%. If the company is in the 40% tax bracket, compute the weighted average cost of capital using book value weights as well as using market value weights. They've covered both, right? Only market value weights they've used. Then we have to do like this only. First of all, they've not even given the cost computation of individual sources. Let's do this together. Illustration number 28. Illustration number 28. Yes, please. First source cost of equity share capital, right? KE is equal to DPS 1 divided by MP naught plus G, where DPS 1 is equal to expected dividend per share at the end of year 1. How much that is? 10. MP naught, current market price per share, that comes to, sure, G is equal to growth rate 6%. Now KE is equal to 10 divided by 110 plus 6%. Tell me the cost. 15.09% or 0.15. Yes, please. Next, cost of preference share capital KP. Am I right? Yes, please. Yes, it is preference dividend rate is there and no information regarding market price. I can assume that the market price is equal to face value. Redeemable or irredeemable, life is not given. I can assume it is an irredeemable preference share. Am I right? Take the numbers directly. You don't need to write every number. 100 into 10%. That's my preference dividend, right? Market price is 100. I'll get 10% only. Any information regarding debentures cost? Students, I'm asking you market price, issue expenses. Then I can use one shortcut formula if you remember. Interest rate into 1 minus tax rate. Because the denominator term information is not available, like whether it is issuing at face value or premium or discount or issue expenses. At least they should have given market price. If they would have given market price, I would have taken that number. What do you say? Because that was not given, I am taking the shortcut formula. If at all, if the market price of debenture is given as 95, 96, 97 or 105 like that, I cannot use this formula. Is that clear? I can use this formula in the absence of information only by assuming that the denominator term is equal to face value. Is that clear? Now tell me the interest rate. 0.12 into 1 minus 0 point tax rate. 1 minus tax rate 40%. 0.40. Tell me the answer. %, which is 0.072. That's it, right? All the sources cost computation is over. The beauty is you don't need to bifurcate market value of equity between equity share capital and reserves and surplus because the reserves and surplus was not available. What do you say? Let's do this. Calculation of weighted average cost of capital by using what? Market value weights. They got some other number. Why? They've taken 6. I think they've taken 50% tax rate instead of 40%. What else we can do? See, are you seeing the first part of the question? Yeah, fine. 6 only, right? So they might have taken 50% tax rate instead of 40%. That's the only thing they did it. Just you can leave that. Columns. Source. Amount rupees. Proportion. Cost of capital. Proportion into cost of capital. Now tell me the source names. Equity share capital. 10% preference share capital. 12% debt debentures. Now tell me the number of equity shares. 5,000 shares should be multiplied with 110. It will be 550,000. Okay. Preference shares number was 2 lakh by 100. 20,000 2,000 shares. 2 lakhs only because we don't have any market price information, right? Debentures also same. 2 lakh and then 3 lakhs. Total please. Now get the proportions with 4 decimals unless if they are rounding figures. 5238. Yes. 0.2857. Proportions over cost of equity 0.15. Preference 0.10. This is 0.072. Yes. Do this computation. See, we do one thing. To align with the solution, let us change the tax rate so that you can get the same answer as per the study material. Do you want to change that, or you want to follow this? Follow this, then fine, leave it. But don't bother about the answers, okay? Tell me. 0.07904. Next. 0.01904. 2057, right? Total, please. Sure. That is 11.86%. This is my KO, right? With this point, point 1 is over. Written? You wrote it. Now go for second part of the question. It has, sorry, this one. Assuming that in order to finance the expansion plan, so to expand our business plan, we need finance. The company intends to borrow a fund of 5 lakh rupees bearing 14% rate of interest. So we are planning to raise 14% term loan. Amount of how much? 5 lakhs. What will be the company's revised weighted average cost of capital? You have to calculate revised weighted average cost of capital. This financing decision is expected to increase dividend from 10 to 12 rupees per share. See, your expected dividend per share is going to be changed. It will be DPS 1, 12 it is, not 10. Okay. However, the market price of the share is expected to decline from 110 to 105. Consider market price per share as 105. So you have to change this cost of equity again. No change in cost of 10% preference share capital and cost of 12% debentures. Those two sources cost remains same. But I need to calculate one additional source called cost of term loan. Because the equity terms are changing, I have to calculate, I should revise my cost of equity. I don't need to calculate, I don't need to touch preference and debentures because no terms were changed. But I should calculate cost of new term loan. Is that clear? So then thereafter I should calculate revised weighted average cost of capital by using which weights? Market value weights. Second part of the question. Cost of equity again. KE is equal to DPS 1 by MP naught plus J. Straight away take the numbers. Oh, DPS 1 is 12, it is right. Oh, right. 12 by 105 plus growth rate. No information regarding growth rate. It remains unchanged. How much? 6%. Now tell me the answer. Comes on 428 or 17.428%. Am I right? Next, please. Cost of term loan. This is our new loan, right? No information. I can go with interest rate into 1 minus tax rate. Tell me the interest rate. 14%, right? 14. 1 minus 0.4. Then answer will be 0. 0.0716. No. 0.076. 0.0716. No, tell me the answer. I don't. I'm just doing 0.084. Sure? 8.4%. Now can we calculate weighted average cost of capital by using market value weights again? Calculation of WACC. Yeah. You have to write revised. Calculation of revised Weighted average cost of capital. Because we are revising it, right or wrong? Due to some changes by using MV weights, market value weights. Am I right? Take the columns. Source, amount rupees, proportion, cost of capital, proportion into cost of capital. Tell me the sources, please. Equity share capital, 10% preference share capital, 12% debt, 12% debentures, 14% term loan, right? Except for equity, for other sources, I don't need market values because amounts were not given, market prices were not given. How many number of equity shares are here? 5,000 into 105, right? Tell me the value. 10 lakh, 5 lakh 25,000. 5 lakh 25,000. Remaining amounts, please. 2 lakh, 3 lakhs. Then finally it is 5 lakhs, right? Total, please. 15 lakh 25,000. Next, please. Proportions. 3442. 6 means 43. Next. 13,114. 1967. 3286. Sure? 78. Get the total of all these numbers. No, you don't get the answer. I think early. Seriously? 3 plus 4, 7, 14. Extra 2 decimals. You said what? 0.327? 3276. 786. That's okay. No issue. Somewhere you did a mistake. Otherwise, you don't get like this. Fourth decimal, round off. You have to make it as round off. Round figure. Accurate answer you'll get. If you can total it, okay, that's fine. No issue. Tell me the cost of equity share capital. We have taken 3 decimals here. That's the reason. 0.1311, right? Now take it 4. I can take this number as 9, right? 3279. Am I right? After 8, what is the decimal? 6. Then you can take 9. Now it is okay. Now tell me. Cost of capital of cost of equity. Changed. Do you know that it is changed? 0.17428. Next. 0.1, 0.072, 0.084. Now multiply the proportions with the cost of each source. 0.06, 00. That's it. 0.06 is enough. Next. Okay. Yes, please. 0.027. Sure about these numbers? Get the total. Confirm these numbers. The last one. 11525. 50%, that's a major deviation. This total is okay? Are you sure about this number? 11.52%, right? Students, with this we have completed illustration number 28. Hope you have done this. This one you need to write. Yeah, write it. In the next session, we'll handle the remaining problems. Thank you. Okay, please go for solved case number 3. Solved case number 3. I'm continuing the session. Can I read it? Avan Electricals Limited wishes to determine the weighted average cost of capital for evaluating capital busting projects. Yes, for evaluating capital busting proposals, we need cost of capital as a discount rate. You know that, right? You have been supplied with the following information to calculate the value of KO for the company. You have to calculate cost of capital KO. Current liabilities 9 lakhs, debentures 9 lakhs, preference shares 4,50,000, equity shares 12 lakhs, and retained earnings 4,50,000. Those are the numbers available in the question. Okay, and total sundry assets 39 lakhs. Anticipated external financing information. So we are planning to raise these sources additionally. 20 years 8% debentures of 2,500 rupees face value, redeemable at 5% premium, sold at par, 2% flotation on 2% flotation cost. So this is regarding debentures cost, and life was not given. Yeah, life was given 20 years, right? Second point, 10% preference shares, sale price 100 per share, 2% flotation cost. Okay. Equity shares, sale price 115 per share, flotation cost 5 rupees per share. The corporate tax rate is 35%. Expected equity dividend growth rate is 5%. This is G. The expected dividend at the end of the current financial year is 11 rupees per share. This is DPS 1. What do you say? Assume that the company is satisfied with its present capital structure and intended to maintain it. The same proportions they want to maintain, except current liabilities. The same proportion of debentures, preference shares, equity shares, and retained earnings they want to maintain. Actually, you're raising all these sources. The amounts were not given. How much amount of preference, how much amount of equity, how much amount of debentures you're raising, that was not given. But what they're trying to say is in the same proportion I'm going to raise. Means what? The equity, retained earnings, preference shares, and debentures proportions remains same. The same proportions will be continued even after that. Is that clear? Hello? So accordingly only we have to calculate weighted average cost of capital under this situation. So you don't need to take any market values and all, the same numbers you can take. Let us start with one by one. Again I'm repeating, how much capital is there right now? Remove 9 out of 39, 30 lakhs capital is there, right? I'm not raising the extra 30 lakhs. I don't know how much I'm raising, but while raising that fund, the same proportions will be continued. So I'm going to use these numbers for taking proportions, but costs should be considered for additional sources. Cost of debentures, cost of preference shares, cost of equity. Are you getting? These new sources cost should be considered. Be careful. It's a combination of existing proportions and new sources cost to calculate weighted average cost of capital of additional fund. Weighted average cost of capital of additional fund. Let's solve case number 3. Be careful. First source, cost of debentures. Redeemable or irredeemable? Redeemable. Cost of debentures KD is equal to redeemable debentures cost I into 1 minus T plus RV minus NP, fresh issue it is, right, by N whole divided by RV plus NP divided by 2. Where I is equal to interest. Face value of debenture 2500 into interest rate 8%. How much? 200. T tax rate was 35%, 0.35. Yes. Yes, my dear students, redemption value. I have to calculate redemption value. RV is equal to redemption value. How much is your face value? 2500. How much premium you are offering on redemption? 5% into 105%. Apply it. Hmm. 2625. Yes. Next, please. Yeah, flotation cost 2% means net process are going to be changed, right or wrong? Face value, how much? Any information regarding issue price, premium, discount? No information means face value and issue price both are same. What do you say? Yes, please. Okay, then minus 2% flotation cost. Am I right? This is my issue expenditure. That comes to tell me the flotation 50 to 4. This is your net profits. N is equal to life of debentures. 20, right? Then KD is equal to interest, please. 200 into 1 minus 0.35 plus redemption value 2625, right? My net profits 2450 divided by 20 whole divided by 2625 plus 2450 divided by 2. Tell me the answer. 0.05 467 means 0.0547, right? 5.47%. Next source, please. Cost of preference shares. Am I right? Redeemable or irredeemable? No life was given, right? So irredeemable, it's a clear case. Formula PD by net profits. PD is equal to preference dividend. That comes to 100 into 10%, 10 rupees. Net profits. Face value or issue price, both are same. How much? 100. 2% flotation cost 2 rupees. Then 98 is my net profits, right? Then KP is equal to 10 by 98. Tell me. 0.10204 or 10.204 percentage, right? Seriously? Why they have taken 100 plus 90 divided by 2, 98 divided by 2? That's ridiculous it is. In the solution they have taken 100 plus 98 divided by 2 in the denominator. What do you say? Is that redeemable or irredeemable? Information regarding life is not given, right? Then how that guy? So I can't take that number. 10.204 percentage. What do you say? The calculation I can't take it. So just leave that. I think he wasn't sleeping while solving this question. What do you say? Next, please. After KP, cost of equity KE. Cost of equity KE is equal to, it's a clear case of what? New equity. Hello. Then the formula will be DPS 1 divided by net proceeds. See, I'm just giving the notation here very clearly. KNE means what? Cost of new equity plus G. DPS 1 by net process plus G. Are you getting? Where DPS 1 is equal to expected dividend per share at the end of year 1. How much that is? 11 it is, right? NP net proceeds. Yes, please. Face value of equity share. Oh God. Yes, face value. 115. No, issue price is how much? At what price the company is issuing the equity share? Sale price is 115, right? Take that issue price. Any issue expenses? Minus flotation cost? 5 rupees or 5%? Yes, I'm seeing the question. No, don't worry. It is 5 rupees per share. So net profits 110, right? The growth rate was given. G is equal to growth rate. It is 5%, right? Or 0.05. Now KNE, cost of new equity. Formula DPS 1 11 by 110 plus 5%. Tell me the answer. 15% as it is, right? 0.15 otherwise. Next, please. Cost of retained earnings, right? KR is equal to. Do you think that cost of retained earnings is equal to cost of new equity? No. This is what the new point. I told you already. I've given the formula also, but might be the emphasis was less at the time of explanation. But listen, dear students, cost of retained earnings is not equal to cost of new equity. Cost of retained earnings is equal to cost of existing equity. Why? Because retained earnings cost is equal to cost of equity, but the cost of equity should be existing equity only. Why? Because for retained earnings, do you think that the flotation cost, issue expenses and all are applicable? No. How much return the existing equity shareholders will expect? Whatever the return they are expecting on their existing equity, the same return they will expect on retained earnings also. Cost of new equity is a different issue. Are you getting? So in that case, I cannot consider cost of retained earnings as equal to cost of new equity. Already I have given the formula also for you. If you remember, you wrote what? Cost of existing equity only. Refer to your previous formula. You can see there. You must write cost of existing equity. Means you have to calculate that. What is the formula for cost of existing equity KE? DPS 1 divided by MP naught plus, what do you say? G. What is the DPS 1? How much is the DPS 1? 11 divided by MP naught is how much? The sale price itself is MP naught. Because when the company is issuing equity shares at 150, say I told you already, a company will issue fresh issue. The company will go for fresh issue of equity shares always at existing market price per share. Means the issue price of equity share and current market price per share should be equal 115, right or wrong? Growth, same growth applicable for every, whether it is fresh equity or existing equity, growth remains same. How much? 5%. Now tell me the answer for cost of existing equity. 14.565. Sure. Yeah, we are right. This bloody guy is taking any number, whatever he wants. What they got it actually, see there, they got, that's wrong. Oh, 5.6, okay, fine, we got the same now, 5.7, right? Unnecessarily we scolded him. 14.57%, right? This is cost of retained earnings KR. Can I go for the next source? That's all right. Everything was done. Now you are eligible to calculate cost of weighted average cost of capital. But amounts were not given. They said the same amounts, the same proportions are being continued. What do you say? Students, I'm not solving that. I'm referring it. Look at this. Because the main thing is calculating the sources only. Remaining computation as usual, right? Determination of weighted average cost of capital. What is that? Source, amount. This is not cost. This is proportion, right? This one is what? Proportion to cost of capital. Right? Debentures, preference shares, equity shares, retained earnings. Everything we have done. We have calculated every source cost, right or wrong? Substituted. Multiply the numbers with the respective proportions. You'll get what? Weighted average cost of capital. The thing is, cost of capital only. They have not taken proportion. Okay. Later they have done this, right? Okay. Then do one thing. Can you? Yeah, we'll do this. Unnecessary wastes of time. Because we are not following their process, right? Calculation of weighted average cost of capital. Tell me the columns. Source, amount rupees, proportion, cost of capital, proportion into cost of capital. Now tell me sources, please. Debentures, preference shares, equity shares, retained earnings. Tell me the amounts, same amounts. 9 lakhs, 4,50,000, 12 lakhs, 4,50,000. Total, please. Total 30 lakhs. Calculate the proportions. 0.30 exactly. Okay, 0.15. Point. Tell me what is the third one? 0.4. Next. Yeah. Tell me the cost of debentures. Debentures cost, please. Don't look at the solution. See the debentures cost. You have done or not? This one. 0.0547. Okay. Next. Preference. 02 1024. Are you sure? 10204. Tell me clearly. 0.10204. Next. 0.15. 0.145. Yes. 0.1457. Yes, multiply this and tell me the KO. Tell me one by one. 0.547 into 0.3. 0.1641. 0.15 into 0.10204. 0.015306. 0.4 into 0.15. 0.06. 0.15 into 0.1457. 0.021855. Did you get this number? 0.26? 12? 26.12% is. Altogether they got different answer. Our answer is completely different. Why? Everything they got, we got, and they got it. Both the numbers were same, just a slight difference. Why we got different answer? Or answer, my calculation is wrong, right? What about this previous total? These numbers are all wrong, huh? No, wrong numbers. Give me your answers, please. I've done some wrong computations. This calculator is not working for me. So many mistakes. Already it is loaded with some numbers. That's the real. Not one. Then you have done some wrong computation. 9 by 30. It is 0.3. 4.5 by 30. It is 0.15. 12 by 30. It is 0.4. Then 4.5 by 30. It is 0.15. Yes, every proportion is right. Why? How come you don't get one? It's right only. Yeah. First one answer, tell me. 0.1641, right? Wait. Why this sum is bothering me a lot? 0.01641. That's the wrong thing I've done. Double 135, right? 357 means 36 or 11.36%. Yes, we are absolutely right. With this we have completed which sum? Solved case number 3. Now go for next illustration. Solved case number 1. Can I read the question? All these are direct questions only. No need to solve. The financial consultant of Hypothetical Limited recommended that the firm should estimate its cost of equity capital by applying capital asset pricing model rather than the dividend yield plus growth model. Not by dividend by price plus growth approach. We are using CAPM here. He has assembled the following facts. Systematic risk of the company is beta. Systematic risk of the firm is beta 1.4. Systematic risk means beta only, right or wrong? 182 days. Treasury bills currently yield 8%. I told you, treasury bills usually, the maturity period of treasury bills are 91 days, double. 91 into 2. 182 days, double 182 into 2, 364 days maturity period. So whenever you're seeing this, this is RF. Expected yield on the market portfolio of assets is 13%. This is RM, right or wrong? Determine the cost of equity capital based on the above data. You know that what is the formula for cost of equity under CAPM? RF plus beta into RM minus RF. They've done the computation. It's a direct question. What do you say? Anything great here? Nothing. Go with the solved case study 2. Same question, same CAPM, but numbers are changing. The following facts are related to hypothetical limited. Risk-free interest in the market is 10% RF. The firm's beta coefficient is 1.5 beta. Determine the cost of equity capital using capital asset pricing model, assuming an expected return on market of 14% for the next year. This is RM. What would be the KE if B means what? Beta. Rises to 2, falls to 1. Take beta, existing beta, and calculate KE. Take beta 2 and calculate KE. Take beta 1 and calculate KE. Anything great? Same calculation. RF plus beta into RM minus RF. Hello? Can you do this computation? Already we have done few problems. What do you say? I might have solved these 2 problems at the time of CAPM itself. Unfortunately, I left these 2 problems. It's a practice for you. Regularly same formula, risk-free rate of return plus beta into RM minus RF. Be careful with these percentages and decimals and all. Okay. Students. Existing beta, by taking existing beta, you have to calculate. Always the changing number. Remember one thing, in CAPM, always the changing number is beta. RF, RM, always constant. Is that clear? RF and RM are always constant. What is the changing number? Beta. It is going to change everything. With this solved case study 2 is over, right? Can you do that? Yes, nothing great in that. That's a small problem. That kind of problems only I am leaving to you. Now, 4th problem. From the following information, determine the appropriate weighted average cost of capital relevant for evaluating long-term investment projects of the company. You have to calculate weighted average cost of capital, KO. So, cost of equity KE is 18%. After tax cost of long-term debt is KD, 8%. 0.08 means 8%. Am I right or wrong? After tax cost of short-term debt, I don't care. The most important thing is in weighted average cost of capital, we are taking only long-term sources. That's the most important thing. If you consider short-term debt, then your answer becomes wrong. Is that clear? Again repeating, weighted average cost of capital and cost of capital chapter itself will focus on what? Long-term sources only. Never ever take bank overdraft short-term loans for your consideration while calculating weighted average cost of capital KO. Is that clear? Now this sum is simple. Sources, book values, market values. See, the sources and book values and market values were given. Can you calculate weighted average cost of capital based on book values and market values? They have done the computation only based on market values. Hello? What are the columns you have to take? Please tell me. Source, amount rupees, heading please. Calculation of weighted average cost of capital by using market value weights. Columns. Source, amount rupees, proportion, cost of capital, proportion to cost of capital. What are the sources? Please tell me. Equity, long-term debt. Don't take short-term debt. Amounts, only market values. 7,50,000, 3,75,000. Total it and then multiply such, after total you'll get proportions, right? Once we get proportions, multiply such proportions with this respective costs of each sources 0.18, 0.08. Then you'll get weighted average cost of capital based on market value weights. Actually, they've done this computation based on market value weights only. You can also calculate this weighted average cost of capital based on book value weights. But the practice of this CMA book, I have observed one thing. If they're not asking you the basis for calculating weighted average cost of capital, always they're taking which weights? Market value weights, because that is the most appropriate and accurate method, which is taking the market values into consideration for weighted average cost of capital. Hope you got it. No information which weights I should use always? Market value weights. What is great in this problem? Ignoring short-term debt. Anything else? Yes, you have to ignore this. That's what the thing here. Okay. You have to ignore these 2 numbers. Right? With this we have completed. Solved case number 4. Can you calculate weighted average cost of capital by taking only these 2 sources? Now, nothing great in this. With this we have completed solved case study number 4. Let's go for the next problem. Illustration number 29. Can I read it? XYZ Limited has the following book value capital structure. Equity share capital 30 crores with face value of 10 rupees each, fully paid. 10% preference share capital 2 crore with face value of 100 rupees each, 100 rupees each. Retained earnings 40 crores, 14% debentures 20 crores with face value of 100 rupees each, 15% term loan 25 crores. The next expected dividend on equity shares per share is 3.6. This is DPS 1, right or wrong? Because they said expected dividend. The dividend per share is expected to grow at the rate of 5%. This is G, growth rate. The market price per share MP note is 30. Preference stock redeemable after 6 years or selling at 80 rupees per debenture. Missing information was there, dear students. There was a missing information here. Everything was clumsy. Let's go for study material. Same thing. No, I think here only it was happened. Let's see. Otherwise, I need to give you some data based on the solution only. 20, 29 page numbers for cost of capital. Oh God. Illustration number. Here is the one, right? See, they have given some data clearly. Modified. Yes, because this material is prepared just before this new addition. Everything was incorporated. The only thing is some corrections they are doing continuously. Now look at this. Can I read this question? Preference stock redeemable at par after 10 years or selling at 80 rupees per stock. Debentures are redeemable at par after 6 years or selling at 90 rupees per debenture. Is it the same sum? XYZ Limited only? Yes. Please correct it in your material. Write these sentences, first and second points clearly. I'm reading the question. See, preference and debentures are redeemable debentures and redeemable preferences, and the market price was also given here. The income tax rate for the company is 30%. Point 1, required to calculate the current weighted average cost of capital using book value proportions and market value proportions. Before taking these proportions, first you have to calculate cost of every source, right or wrong? Let's do this together. Illustration number 29. You should answer for me, okay? Tell me, what is the first source? Cost of equity, right? KE is equal to DPS 1 by, tell me, MP naught plus G, right? See, instead of solving this, we can refer the solution because same computation. Every time we are doing this, right? Very clearly they have given this time. I'll show you the solution because already we are doing this kind of computations for so many times, for so many problems. Look at this cost of equity. See the numbers, students. D1 by P naught. You know this formula, right? Expected dividend is how much? They have not written here. DPS 1 is how much? 3.6. They wrote it, but okay, here in the, okay, separately they have written, right? No. D1 3.6, P0 30, current market price. Growth rate is how much percentage? 5%. Substituted the numbers and they got cost of equity as 17%. What is new in this cost of equity computation? Please tell me. Regular computation, whatever we have done earlier in the previous problems, the same computation they have done here also, right or wrong? Next source, please. Cost of preference share capital, it is right. Redeemable or irredeemable? Redeemable. Tell me the formula for cost of preference share capital. Redeemable. Existing instrument or fresh issue? Actually, it is an existing instrument, but they have taken NP. Don't worry, you have to take, you can consider MP also. Okay. Tell me the formula. PD plus RV minus MP by N whole divided by RV plus MP by 2. PD, preference dividend. Face value, and how much face value? 100 into 10%, 10 rupees only, right? RV redemption value, no information, I can assume that face value 100. MP market price 80. N life 10 years. Substituted everything and they got 13.33%. Please check this answer whether it is right or wrong. Unless otherwise specifically stated, you should assume redemption value is equal to face value, par value redemption. Correct, it is right. You got cost of preference share capital. Next, cost of redeemable debentures. Interest 100 into 14%, 14 rupees. Tax rate 30%. Redemption value, no information, face value redemption. What do you say? MP market price, not NP. You please write MP. That's comfortable to you. In formula also, please write MP. MP you please write. Okay. Then N life 6 years. MP market price 90. Same substitution. They got 12.07. Confirm this answer. Is that right or wrong? Yes. After that, term loan cost. Interest rate into 1 minus tax rate. That's what they've given here. Interest rate into 1 minus tax rate. 15% 1 minus 0.3. 10.5. Because for term loans, that's the way to calculate cost. Once this is over, can you calculate weighted average cost of capital based on book value weights and market value weights? Book values have taken here. See, source, amount, weight, cost of capital, weighted average cost of capital. In our own way only, they have done this. Same columns have taken. Sources, amount, rupees, proportion, cost of capital, proportion to cost of capital. See, these are all costs you have arrived just now. Right or wrong? The same numbers we have arrived. Usually we took these numbers in proportions, I mean in decimals, but they have taken numbers. You better take these numbers like 17 as 0.17, 13.33 as 0.13333, like that you can take it. Why? Because it will create some confusion whether I should apply percentage or number and all. Okay, don't create such unnecessary confusion. Take decimals so that it won't create any confusion. Is that clear? And these numbers and all, you know, right? All the numbers we have taken. And cost of equity is nothing but cost of retained earnings, right? KR. What about market value weights? You have to calculate market value of equity, market value of preference, market value of debentures and market value of term loan, right or wrong? They ignore to write retained earnings, right? Actually, usually we split this market value of equity into equity share capital and retained earnings. You know why? There is a simple reason, because KE and KR both are same. My dear students, one point I want to tell you, KE and KR, when both are equal, that splitting won't give you new results. Even if you don't split that amount, you'll get same number. That means you can take directly the market value of equity here instead of splitting them. But you should not consider retained earnings. Students, what I'm trying to tell you is, when KR and KE both are same, then splitting the market value of equity between equity share capital and reserves and surplus is not necessary. Straight away write equity amount in the amount column, but such amount should be market value of equity, the total, without splitting it. But separately you should not write retained earnings. Are you getting? Because that market value of equity itself is what? Equity share capital and retained earnings, even the future, I mean the extra value also. What do you say? So here, instead of splitting this amount, they've taken this number as it is. If you don't like this, you can go ahead with your regular computation. Even that one also will give you the same result. Is that clear? So this is so simple computation. They have taken straight away 3 crores into market price 30. They have taken 90 crores. That's that market value of equity. They have not considered the splitting and all. Why? Because the KR and KE both are same. And then afterwards every computation is same, right or wrong? Debentures market value 2 lakh debentures into 80. Preferential market value 2 lakh into 80. Debentures market value 20 lakh into 90. Term loan as it is 225. Totally it is 134.6 crore. Got it? What is new in this problem, same calculations. The only thing is, for the first part of the question, first time they have taken equity directly without splitting that into equity share capital and retained earnings. If you don't like this, go with your regular calculation. This is one of the alternative computation only when my KR and KE are equal. Is that clear? This problem arises only for market value weights, not for book value weights. Because in book value weights, usually I'll take the numbers as it is from the question itself. Is that clear? Yes. See, they've given that notes also. So nice guy. I'm not reading it. Is that clear? Now, go with the second question. This is what I need to solve. This is a new thing for us. Okay. Up to this, the regular pattern only. Am I right or wrong? No solution in the book? You don't have solution in your book? Part 2, I'm going to solve it. That was not given as a solution. Oh. Why so? Not given in the study material itself, I guess. They should have given this. Yeah, they've given separately. Yes, that's okay. Let's do this in our own way. Because this part is so important for us. For that reason only I am doing it. Can I read the second part of the question? See, my dear students, before going for this, I need to tell you one thing. If you go with additional fund, if you're going for additional fund, say 10 crore, not in this sum, generally I am telling you. There is an existing company with existing capital structure with existing total capital. Now it is planning to raise 10 crores additionally. And they're planning to raise this 10 crores in equity, debt and preference share capital. How many sources they are planning? 3. 4 crore equity, 2 crore debt and 4 crore preference share capital. This is what they plan. Hello. Now the thing is 40% equity, 40% debt and 40% preference share capital. That's their proportions. They have chosen that. Now dear students, this 10 crores is additional fund or existing fund? Additional fund. And this 10 crores is going to be invested in one of the new project. And they want to evaluate this project. For evaluation they need cost of capital. Are you getting? But the thing is, I cannot use existing cost of capital for a new project which requires additional fund with different proportions. Hello. See, why? Because you have to raise such additional fund and you have to calculate cost of capital for this additional fund. For this additional fund, I have to calculate cost of capital. This cost of capital must be used for new project evaluation. Why? Because I am not using the existing fund to finance this new project, to use such existing cost of capital for evaluation. Are you using existing fund or additional fund? Additional fund. Then take this additional fund and calculate weighted average cost of capital for this additional fund, and that cost of capital must be used for new project evaluation. This cost of capital, technically known as WMCC, means weighted marginal cost of capital. What is this? Weighted marginal cost of capital. What is this weighted marginal cost of capital, sir? Marginal cost of capital is nothing but additional cost. Additional cost of capital. This capital is additional capital. Is it clear? Means marginal cost of capital is nothing but additional cost of additional capital that is needed for new project evaluation. I cannot use the existing cost of capital as a discount rate. That is unfair. Use the new additional fund cost of capital as a discount rate for evaluating the new project, because that fund is going to be used in the new So this additional cost of additional capital should be used as a discount rate for evaluating the new project. That is fair. This is known as weighted marginal cost of capital. Am I right? Now with the help of this background, let us handle the second part of the question. Determine the weighted marginal cost of capital schedule for the company if it rises 20 crores next year. How much money you are going to plan? 20 crores additional fund for the next year. Given the following information, the amount will be raised by equity and debt in equal proportions. So this 20 crores should be raised in 10 crores equity, 10 crores debt. Okay. The company expected to retain 3 crores earnings next year. So in equity, already we have some retained earnings. So for extra money, I'll raise the fresh equity. The additional issue of equity shares will result in the next price per share being fixed at 25. So this is what my new share price, MP naught. Okay. The debt capital raised by way of term loans will cost 15% for the first 5 crores and 16% for the next 5 crores. This is the first case. First of all, you have to bifurcate this fund into all these three sources: equity, debt, and we have debt here up to 5 crore, interest rate is 15%. Beyond 5 crore, if you raise, interest rate is 16%. Let us write the fund pattern. Once that is over, for every source I am going to calculate cost. Once that is over, then I am going to calculate what? Weighted marginal cost of capital. For calculating weighted marginal cost of capital, cost of every additional individual source should be calculated. First, for calculating cost of cost of each individual source, first we have to calculate what? The fund pattern, how this fund is bifurcated. Can I do that? Illustration number 29. Yes. Point, actually we put it, don't need to write it again. We've written that, right? Illustration number 29, I already have written that. Second part of the question we are solving. Pattern of raising additional fund. See, the total capital additional fund is how much? How much additional fund is required? 20 crore it is, right? Classify this fund into two parts: debt and equity in equal proportion. Debt and equity. Debt is equal to 20 crore into equal proportion means 1 by 2, right? 10 crore. Equity 20 crore into 1 by 2. 10 crore only, right or wrong? This debt again classified into two components. How much percentage of debt? The debt is classified into, for the first 5 crores it is 15%. First 5 crores it is 15%, next 5 crores 16%. Means 15% debt is 5 crore. 16% debt is another 5 crore, right? Coming to this equity, I'm just extending the line, okay? Already we have retained earnings, right? How much is your existing retained earnings? Retained earnings is part and parcel of equity. I can use this for new project. How much is your retained earnings? Next year it is going to be 3 crore. So if I can use 3 crore retained earnings, I don't need to go for complete fresh equity. The balance should be fresh equity, new equity share capital. Total 10, out of that already 3 crore is available. Additional fund required to be raised is 7 crore. right? Now for every source you have to calculate cost. What is the first source cost? Cost of 15% debt, right? Students, formula is so simple. I into 1 minus t, right? 0.15 into interest rate, tax rate please. Yeah, only. We are talking about cost of 15%, right? Tell me. 0.15 into 1 minus 0.3. Point? Okay. Okay. Cost of 16% debt. Same formula. 0.16 into 1 minus 0.3. 0.112. Sure. Now cost of new equity share capital. KNE. Formula. DPS 1 divided by net proceeds plus growth, right? The study material also they have done like this only. I hope so. Is it the one? They've taken retained earnings cost and yeah, fine, that's okay, no problem. How much is your DPS 1? Any information? Existing DPS 1 will be continued, right or wrong? Same DPS 1. Tell me the DPS 1. Any changes in dividend per share like that in the question itself? No, then in that case, consider the previous numbers. DPS 1, please. Current market price per share. You know, the additional issue of equity shares will result in the next new price per share being fixed at 25. Take the 25 as a number, okay. Growth rate 0.05. Now tell me the answer. Point 194. 19.4%. What is this? Cost of new equity. Am I right? Because this is new equity only. I see just now we have calculated cost of 15% debt, cost of 16% debt, and now we have calculated cost of new equity. Now our planning is to calculate cost of retained earnings. By that the total additional fund of 20 crore in cost with respect to individual sources will be completed. Am I right or wrong? So in that case, let me go for that. Cost of existing equity. The technicality of the subject, you can understand it here now. What is the formula for cost of existing equity KE? Actually, we have to calculate cost of retained earnings, right? That is equal to cost of existing equity KE. Cost of retained earnings KR is equal to cost of existing equity KE. Am I right? Tell me what is the formula for cost of existing equity KE? DPS 1 divided by MP naught plus G. DPS 1 is how much? 3.6. Don't change in that. What about current market price per share? It changed, right or wrong? Earlier it is how much? 30. Because of new issue, it reduced to 25. What do you say? Growth rate is how much? So the same numbers, right? How much it is? 0.194 or 19.4%. We got every source cost. Now can I calculate additional cost of additional fund, which is known as weighted marginal cost of capital? Calculation of weighted marginal cost of capital, which is known as what? WMCC. Is that clear? Hello students. Columns, source, amount rupees, proportion, cost of capital, proportion into cost of capital. Now write the amounts. The first one is what? 15% debt. Second one is 16% debt. Retained earnings. New equity share capital. Am I right? Tell me the amounts. 5 crore, 5 crore, 3 crore, 7 crore. The proportions are so easy. 5 by 20, 0.25, 5 by 20, 0.25, 3 by 20, 0.35, right? Now tell me the cost of every source. Already you have calculated every source cost. Tell me the numbers. 0.105, 0.112, wait, 105, next one please. Okay. Answer please. Every source multiplication. 0.02625. Okay. Zero two nine one, right? Next. 0.0679. Yes. One five one two five. Perfect answer. 15.125% is right. Is it your cost of existing capital or additional capital? This is known as weighted marginal cost of capital. You need to write it, right? Write this. From here onwards, wrote everything. We have one problem pending in capital structure. I told you people, did you remember that? Art is going to be covered in the chapter cost of capital. Go for that. Go for the capital structure 2 to 6. Don't worry, that's not a rocket science. It won't take much time. Yes. Question number 2 to 6 it is, right? Illustration 6. Can I read this question? Jet company has a capital structure of 30% debt and 70% equity. The company is considering various investment proposals costing less than 30 lakhs. So we are evaluating the proposals, projects, capital projects which are costing less than 30 lakhs. The company does not want to disturb its present capital structure. The cost of raising the debt and equity are as follows. Does not want to what? The company does not want to disturb its present capital structure, means always 30% debt and 70% equity only. Proportions remains same. But for different levels of debt raising, cost of raising the debt and equity, when your project cost is changing, your equity, debt cost and equity cost is changing here. Look at this. When your project cost is above 5 lakhs, your KD is 9%, KE is 19%, sorry, 13%. Hello. But this is not after tax cost of debt. You have to apply what? Into 1 minus tax rate. Above 5 lakhs and up to 20 lakhs, 10% before tax cost of debt and 14% equity cost. Above 20 and up to 40, 11 and 15. Above 40 and up to 1 crore, 12 and 15.5. Assuming the tax rate is 50%, compute the cost of two projects A and B, whose fund requirement is 8 lakhs and 22 lakhs respectively. So we have to identify the cost of capital applicable to project A and project B, whose fund requirement is 8 lakhs. First one is 8 lakhs means second range, right or wrong? Next one is 22 lakhs means third range. If the projects are expected to yield after tax return of 11%, this is nothing but IRR. Okay. If the projects are expected to yield 11% yield only, determine under what conditions it would be acceptable. This is the question. First of all, for all these amounts, for these ranges, calculate cost of capital, KO. Look at this calculation of capital structure given 30%, 70% equity. Calculation of overall cost of capital at different investment outlays. Project cost up to 5 lakhs, 5 lakhs to 20 lakhs, 20 to 40, 40 to 1 crore. First they have calculated KD, formula, KD into 1 minus tax rate actually. For getting after tax KD, the formula is interest rate into 1 minus tax rate, right? Then they have taken KE. And then they have calculated KO. What is the formula for KO? I told you. This is another formula. Same calculation. Instead of calculating this cost of capital in the statement, you can write it in an equation. WDKD plus WEKE. Am I right? WDKD plus WEKE. So that you can get weighted average cost of capital when your project cost is up to 5 lakhs, 5 to 20, 20 to 40, 40 to 1 crore. Look at this. Can you compute these numbers or not? Let's take one number, 5 lakh to 20 lakh. Interest rate is how much? 10%. See this. 10% into 1 minus 0.5. I'll get how much? 5 only, right or wrong? Equity cost they've given. Now take your calculator. Debt proportion is how much percentage? 30%. Equity proportion 0.7. Take the calculators. 0.3 into 5 plus 0.7 into 14. In this way you have to calculate for all the sources, for all the amounts, ranges. Is that clear? My project evaluation of given projects. My project A and B, amount of investment is how much? 8 and 22 lakhs. For 8 lakhs, I am in the range of 5 to 20, right or wrong? Then cost of capital is how much? 11.3. That's what here we have written. Am I right? For project B, my requirement is 22 lakhs. This is in the range of third one, 20 to 40, right or wrong? There the cost of capital is 12.15%. 12.15 I have written here. Now tell me, for both of these projects, A and B, they said what project return is 11%. What is this? IRR. When IRR is less than cost of capital, will you accept these two projects? Hello? See, this one is return is less than KO, return is less than KO. Remember this, understand this, this is less than symbol. In between it is merged. They did some biryani. What do you say? Return is less than KE. This return is nothing but what? IRR. When IRR is less than KO, when IRR is less than KO, I won't accept these two projects. But under what circumstances you can accept the project? That's what they're trying to ask you. Hello? See, if both the projects A and B are not acceptable, as the cost of capital is more than the expected yield of the project, in order to accept the projects, the expected return means what? Cost of capital should always be greater than the expected return. In this case means IRR actually. The IRR should always be greater than cost of capital. You know that, right? In order to accept the project, IRR should be greater than cost of capital. Just they have done cost of capital computation for these ranges, and for the given projects they identified cost of capital and compared such cost of capital with IRR and decided. That's it. What's great in this problem? Hello? Nothing great. Can you handle this? Yes, sir. With this we have completed cost of capital chapter along with the additional problem also. Thank you.